Starting with your registration, let us try to understand first the basics of your registration. Quickly go through your basics of registration. GST registration is PAN based. It is based on your PAN number. You cannot have your GST number without PAN. If you want GST number, you should have a PAN. And the format of your GST number would be 15-digit number, which is first 2 will be your state code. Next 10, which is 3 to 12, will be your PAN. Will be your PAN. Then 13th will be entity number in that state, which means if you are registered in 2 states, 2 GST number, 13th number will be 1 in both the states. This will be increasing to 2, 3 only if you are having multiple registration in the same state. Only if you are having multiple registration in the, otherwise 13th number will be 1. And when you talk about 14th, as of now, the default alphabet is Z as of now. And 15th will be a random checksum digit. Random checksum digit. A random number generated by the system. So this is your 15-digit GST number. And it is very evident that without your PAN, you cannot have GST number. You cannot have GST number. But are there exceptions? Yes. When you talk about your GST TDS number, it is based on your income tax TAN and not on your income tax PAN. So your GST TDS TCS number is based on your income tax TAN. So TDS number TCS number is based on your income tax PAN and not based on your income tax TAN and not based on your income tax PAN. Second, you're talking about you'll be having GST number based on PAN of another person. There is a special person called as NRTP, non-resident taxable person. They will have their registration based on PAN of another person. Based on PAN of another person. Here it is based on PAN, but not your own PAN. PAN of another person. Who is that another person? Your authorized representative, who should be Indian resident and a valid PAN card holder. Indian resident and a valid PAN card holder. So first exception is for your TDS number. First exception happens to be for your GST TDS number. Second exception happens to be with your NRTP registration, where it is based on PAN but of authorized representative, who should be a Indian resident and a valid PAN card holder. Third, this third and fourth will come always. When you talk about your unique identification number and OIDRS supplier who is outside India. Right, when you talk about UIN, unique identification number, certain UIN will be there without your PAN number. It has got nothing to do with your PAN number. Right, when you're talking about international bodies, they'll have their UIN number without PAN. Obviously, certain Indian bodies will also have UIN. There it will be based on PAN. But international bodies, they'll have their UIN without linking to income tax PAN. They'll not have any even PAN. And one, when you're talking about a supplier of OIDRS services from outside India, where he has to pay GST for the supply made to non-taxable online recipient in India, they will take the GST number but without any PAN. So first two cases, TDS TCS number, GST TDS TCS number is based on income tax TAN. NRTP based on PAN but of another person. UIN, international bodies, no need of PAN. OIDRS, supplier outside India, no need of PAN. Now, second concept, your GST number will be linked to Aadhaar. Your GST number will be linked to Aadhaar. No GST number without linking to Aadhaar. Without linking to Aadhaar. Authentication means linking to Aadhaar. Your GST number should be linked to Aadhaar. So when you talk about GST number linking to Aadhaar, it is a bit different like PAN. Without PAN, you cannot have GST number. But without linking to Aadhaar, still you can have GST number. So if at all you decide not to link your Aadhaar, See, first is there's an exempted category where there's no need of linkage. Just like the exempted category of a ban. There's an exempted category where there is absolutely no need of any linkage. So when you talk about non-citizens of India, foreigner, which will even include OIDRS, and obviously UIN. See, OIDRS and UIN will always come in special. They don't need PAN, they don't need linking to Aadhaar. Now, what are the other categories who are exempted? Government exempts themselves. Department or establishment of central government, state government, local authority, statutory body and public sector undertaking. So, government is excluding itself from linking to Aadhaar. Right. So, you are talking about whom all being exempted? Non-citizens including OIDRS, UIN. Then the next category is government, that is central government, state government, local authority, public sector undertaking and statutory body. Now you may wonder that when you are not an individual, how can you have an Aadhaar? So for that you need to understand the concept of Aadhaar linking. If at all you are talking about a proprietorship concern, sole proprietor, what can be the categories? Sole proprietor, HUF, firm or LLP, body corporate, AOP, AOPBY and trust. For sole proprietorship concern, who has to link the Aadhaar? Proprietor. HUF, Karta. Firm or LLP, partners or designated partners. Body corporate, director. AOP, you are talking about members of managing committee of AOP. Trust, board of trustees. Anyone. Apart from that, if you have someone else appointed as authorized representative, then he also has to get his Aadhaar linked. If one of the partner himself is authorized representative, then no need to worry. One Aadhaar linking is sufficient. But if you have a director and you have someone else as authorized representative, or it can be even for a proprietorship concern. You are a proprietor, there are a lot of proprietorship concern across India where they are big shots. They will not like to get one-time password and all in their mobile number. So what they'll do, they'll appoint someone else as authorized representative. So whose Aadhaar will be linked? That proprietors or that the partners or the directors, etc., along with authorized representatives Aadhaar number. So there are two stages. So we are talking about linking. Now who are all exempted? Non-citizens, UIN, government category. That is central government, state government, local authority, statutory body and public sector undertaking. But what is the difference between PAN and Aadhaar that we are trying to understand? Then when you talk about PAN, without PAN you cannot have GST number. Forget about the exceptions. There are exceptions. But if you forget about the exceptions, without PAN you cannot get your GST number. Whereas when you talk about your Aadhaar, there are certain notified persons who are exempted from getting Aadhaar linking. But what about others? Assume that you are not covered in the category. See, that category will cover only few of them. Most of them are not covered in that exempted category. What about you? You can still get your GST number without linking your Aadhaar. All you need to do is tell that I am not interested in linking my GST number with Aadhaar. I am ready to go for physical verification of premises, and that physical verification of premises will be done before grant of GST number. So registration will be given only after doing physical verification. So physical verification will be followed by giving the registration. So you should be ready. I don't want to link my Aadhaar. I don't want to reveal my private and confidential information. Don't worry. You don't link with your Aadhaar. What you can do? You can tell that I am ready for physical verification of premises. Officers will come for physical verification of premises. They will verify all the details, documents along with the premises, and they'll give you the GST number without linking the Aadhaar. So that is possible. That is possible in Aadhaar. Right? Can you get your GST number without linking the Aadhaar? Yes. What you have to do? you have to opt for physical verification of premises, where they will do physical verification of premises, and after that only your registration will be granted. But even after getting your registration, at times government is very much interested in your Aadhaar authentication. So at times government tells that we are very much interested in your Aadhaar authentication or Aadhaar linking. You have got your registration number. You have got your registration number. But at times government will tell that normally government cannot force you for linking your Aadhaar. That's the concept. Supreme Court has said a lot of times that it cannot be a mandate that you have to link your Aadhaar. But government indirectly tells that okay, you have got your registration number without linking the Aadhaar. But if you are coming for refund application, normal refund under Rule 89, special automated refund under Rule 96, or if you are making revocation application under Section 30, RRR, revocation of cancellation, refund normal Rule 89, refund automated special Rule 96, then mandatorily you have to link your Aadhaar before coming for them. Mandatorily you have to link your Aadhaar before coming for any of them. But suddenly they tell that, a person may tell that, see, I want to go for revocation or normal refund 89 or special automated refund Rule 96. But I don't even have Aadhaar. For me to link my Aadhaar with GST number, first I should have Aadhaar. Supposing there is a person who wants to apply for revocation of cancellation. Government tells that you should link your Aadhaar, only then you can apply for revocation of cancellation. That person tells that I don't even have Aadhaar. And there is a time limit within which I have to apply for revocation of application, 30 days plus 30 days plus 30 days after cancellation. What to do? What to do? They will tell that okay, don't worry, as you don't have Aadhaar, do one thing. Go and apply for Aadhaar. Go and apply for Aadhaar. Give us the proof of Aadhaar enrollment ID slip along with one photocopy proof, either of your bank passbook with photograph, voter ID, which will obviously with photograph, passport or driving license. Give these two details before you come for RRR. Before you come for RRR. Give the proof that you have taken action to get your Aadhaar number. After you get your Aadhaar number, the moment you get your Aadhaar number, make sure that within 30 days of getting Aadhaar number, link your Aadhaar. Link your Aadhaar. This is after applying for RRR. Two conditions are there before you apply RRR. You are telling that you are not in a position to link your Aadhaar because you don't have Aadhaar. Go and apply for Aadhaar. Give us the proof of Aadhaar enrollment ID slip along with one of your photocopy proof, be it your bank passbook with photograph or voter ID or passport or your driving license. Do it before you apply for RRR. And after you apply for RRR, you will be getting your Aadhaar number very soon. The moment you get your Aadhaar number, it may take 10 days, 20 days, 1 month, 45 days, 60 days, whatever. The moment you get your Aadhaar number, from that time, within 30 days, come and link your Aadhaar number with your GST number. So this requirement is only for RRR. Otherwise, should you worry about linking your Aadhaar? No. You need not worry. And by the way, that RRR concept comes only after taking registration. You need not even worry about linking your Aadhaar. If you want to apply for GST number without linking your Aadhaar, can you do it? Yes. Can you continue with your GST number without linking your Aadhaar? Yes. When it becomes important, RR and R, revocation, refund, Rule 89, refund, Rule 96. Only in those cases, it becomes mandatory for you to link your Aadhaar. Now, the next concept, your GST number is state-based. It is PAN-based, it is Aadhaar-based, it is state-based. Now, for your state-based registration, please understand that there are two exceptions. Normally, if I tell that if you are working in 5 states, how many registration? 5 registration. 10 states, how many registration? But there are two types of exception. The first type of exception is, you may work in multiple states, but pan-India, you are required to get only one GST number. Who are they, by the way? We have been discussing this repeatedly. Who are they? They are OIDRs from outside India and certain UINs. Who are these certain UINs? International bodies having UIN. They will have one GST number or one UIN number across India. Across India. Normally the concept is one state, one registration. One state, one registration. But for this OIDRS from outside India, not a supplier in India. We are not talking about a supplier in India. If he is a supplier in India, one state, one registration. For this OIDRS supplier outside India, pan India, one registration. For certain international bodies who are having UIN, pan India, one UIN. Pan India, one UIN. This is the first type of exception. That is the second type of exception for this. What is the second type of exception? Within the state, you can get multiple registration. See, one type of exception is full India, one registration. Second type of exception is within the state, multiple registration. Can you go for within the state, multiple registration? Yes. Now, within the state, multiple registration has got two concepts. One is mandatory multiple registration within the same state. Mandatory multiple registration within the same state when you deal with special economic zone. When you deal with special economic zone, if in Tamil Nadu you have 10 branches, 8 in DTA, domestic tariff area is normal India other than SEZ, and 2 in SEZ. How many registration you have to take? 2, not 3. For all 8 domestic tariff area, 1 GST number. For both the SEZ, 1 GST number. Mandatory. Do you have an option? Do you have an option? No. You have to go for 2 GST number within Tamil Nadu. Within Tamil Nadu. And any supply between them will be treated as deemed supply and tax will be IGST, because if it is DTA to SEZ, SEZ to DTA, it is IGST. It is IGST. Now, for the same example, what is the maximum registration that I can take? 10. Maximum registration that I can take is 10. How? How many branches I have? 10. For each of them, I can take separate registration. Is this mandatory multiple registration or optional multiple registration? Optional multiple registration for each of the branch. For each of the branch. So if you look at this example where VJPJ Limited is working in Maharashtra and Delhi. In Maharashtra, it is having 4 branches in domestic tariff area, 2 branches in special economic zone. In Delhi, it is having 5 branches in domestic tariff area and 2 branches in special economic zone. What is the minimum registration that I have to take in Maharashtra and in Delhi? Maharashtra and Delhi, I cannot merge. For surely, I have to take separate registration. In Maharashtra, how many registration? In Maharashtra, how many registration? Minimum 2. 1 for 4 branches of domestic tariff area and 1 for 2 branches of SEZ. In Delhi, 2. 1 for 5 branches of domestic tariff area and 1 for 2 branches of special economic zone. Now, how many maximum registration I can take in Maharashtra? Total branches is 6. How many maximum registration I can take in Delhi? Total branches are 7. The first was a case of mandatory multiple registration. Thereafter, whatever you are taking is optional multiple registration for each of your place of business. For each of your place of business. Optional multiple registration. That is optional, not mandatory. It is optional. The moment you take multiple registration, they will be treated as distinct person. Any movement between them will be treated as deemed supply. Will be treated as deemed supply. You have to remember that. The moment you take multiple registration, they will be treated as distinct person. Any movement between them will be treated as deemed supply in terms of your schedule 1 para 2. Will be treated as deemed supply in terms of your schedule 1 para 2. That also you need to remember. So this is all about your basics of GST number. Adding to it, we have already discussed that there are 3 types of registration can be categorized into 3 types. One is normal GST number, taxpayer. One is tax distributor, that is your ISD. And one is tax debtor or collector, TDS, TCS. What do you think? Just think of the situation. Amazon, how many GST number it will have? One normal GST number for its own supplies. One GST TCS number for supply by others through Amazon. For its commission, it will have normal GST number. For supply by others through Eco, it will have GST TCS number. Assume if Amazon is also selling to government. No, TDS will be by government. TDS will be by when you can have all of them. Then you can have all of them. Government. How? Take an extreme example. Government is having its online platform. Government is having its online platform. Government will have normal GST number for its supply. It may be supply of goods or supply of services commission. Government will have TDS number for its receipt, not for its supply, for receiving the goods. Supplier to government. So government will be acting as recipient, GST TDS number. Government will have GST TCS number for the supplies made through government's website or government app. Don't worry, the government will have one more thing. Government may have ISD number. Because if it is having multiple Gs, not multiple GST number in this way, multiple normal GST number, multiple normal GST number, it may also have ISD. It may also have ISD. Amazon clearly has got 3 GST number. One, normal GST number in multiple states. One, GST TCS. One, ISD. One, ISD. Clear? So these are all the types of registration that you can have. Now, if at all you are taking the registration in the state of Maharashtra, should you register separately for CGST, separately for Maharashtra SGST or separately for IGST, or one registration will be sufficient for Maharashtra SGST, CGST, IGST and compensation cess? What is the concept? One registration is sufficient. Your GST number is not based on tax. If I am registering in Maharashtra, my registration is for paying all the taxes in Maharashtra, be it CGST, be it Maharashtra SGST, be it IGST, be it compensation cess. So GST number is not tax based. GST number is not tax based. So that is all about your basic principles or basic concepts of your GST number. When you talk about registration chapter, it can be divided into 4 parts. Basic concept of GST registration which we have discussed, taking GST number, amending GST number and cancellation of GST number. Now, when you talk about application for GST number, why will assessee go for GST number? Application can be by assessee or it can be suo motu given by the department. Why will assessee go for GST number? Assessee will go for GST number because he is liable for registration or he is taking voluntary registration. Either he is liable for registration under section 22, turnover based registration, section 24, compulsory registration, or he is going for voluntary registration. He is going for voluntary registration. 2 doors are there. You are liable because of that you are going. You are not liable but still you are going for voluntary registration. Why will department give suo motu registration to the assessee? Fraud category. Assessee is liable for registration but is not applying for registration. Assessee is liable for registration but is not applying for registration. What will department do? Give suo motu registration. Give suo motu registration. Now, the second stage is amendment. Once you are registered, there will be amendment of registration. Amendment can be done only and only by assessee. One is core field amendment and one is non-core field amendment. One is non-core field amendment, not the main amendment. Core field amendment. Amendment cannot be done by department. Either it is core field or non-core field. Both are done by the assessee. Core field amendment includes main changes. Your main changes. What can be your main changes? Your main changes can include changing the legal name of the company, which means changing the name which is there on your PAN card, not your trade name. Changing the legal name of your company. Change in the place of business. Adding additional place of business, removing additional place of business, changing the principal place of business. Change in the person. Change in the person. Adding partners, removing partners, adding directors, removing directors, changing the karta, adding authorized representative, removing authorized representative. That all comes in person. Legal name, place, person. Legal name, place, person. Non-core field amendment example is changing your trade name. You can have any of your trade name. You can keep any trade name for yours. Obviously, when you are trying to get it registered in terms of trademark registration, you have to take care of other things. But otherwise, you can have any trade name. Change in the trade name, or you're talking about change in your mail ID and mobile number. Even to the extent of changing the bank account is also non-core field, which should technically not be non-core field. It should be technically core field, but as of now, it is also non-core field. These are all examples of core field amendments and non-core field amendments, and both are done by assessee. And finally, you're talking about the last stage, which is cancellation. Now, cancellation, first category, which can be done both by assessee as well as department. Both can do it in 4 cases. Second category, where only department can do suo motu cancellation. Where assessee can do cancellation as well as department can do cancellation. There are in total 4 cases. What are the 4 cases? First scenario, where assessee has stopped the business. Assessee has stopped the business. Second scenario, assessee has sold the business, including death of a proprietor where the business is taken over by the legal heir. Sold the business. Stopped, sold. Stopped and sold. Third is a scenario where there is change in constitution of business with change in PAN. If PAN number is the same, no need for coming for cancellation. Go for amendment. Change in constitution with change in PAN. What about change in constitution without change in PAN? Go for amendment. Go for, if PAN changes, the old firm has to go for cancellation and the new firm has to go for new registration. But if PAN remains the same and only constitution is changing, few people are coming inside and few people are going outside, don't worry, go for amendment. And next, you're talking about a taxable person is no longer liable for registration. By the way, why you go for registration by default? Because you're liable for registration. Now you're no longer liable for registration. Have you stopped your business? No. Have you sold your business? No. Is there any change in constitution with change of PAN? No. You're still continuing your business, but your turnover has come down. You're no longer liable for registration under section 22 or 24. Therefore, you're cancelling your registration. Here, one funny point is also mentioned. You might have taken voluntary registration. See the entry doors. There are 2 entry doors. You are liable, you took. You are not liable, you voluntarily took. Now you voluntarily took. You are never ever liable for registration, but you voluntarily took the registration. Can you apply for cancellation? Yes. You can apply for cancellation. Here you cannot talk about liability. There was no liability for you to get registered. You got registered. Can you exit the doors? Yes. You came inside, though it was not required. You can go outside because it is not required. These are the 4 cases where both assessee and department can start. Now, what are the 10 cases where only department can start cancellation? Where only department can start cancellation. You are doing your business from a place which is not declared. From declared place of business, you are not doing any business. From a place which is not declared, a secret place, you are trying to do business. Fraud. Second, mega fraud, bada fraud, very big fraud. Fraud, cheating the government. You are giving invoice without supply, fake invoice, bill trading. You are giving invoice without supply. Third, you have obtained registration itself by way of fraud, willful misstatement or suppression of facts. The details of the documents that you have given are incorrect. Fraud, misrepresentation or willful misstatement of facts. It will be cancelled. Or you are violating Rule 10A. What is Rule 10A? Rule 10A tells that when you get your GST number, you might not have your bank account. So GST department tells that don't worry, you get your GST number without giving your bank account details. See, one of the mandatory details while getting your GST number is bank account. But now you are getting your GST number without bank account, because GST department tells that you get your GST number, go to a bank, open the current account, come back and give to us, come back and update us with your bank account within 45 days of grant of registration, within 45 days of getting your GST number or due date of your first return, whichever is earlier. This is the deadline given to you. You are getting GST number without giving your bank account details. Get your GST number, go to bank, open the bank account, come to us, update the bank account. Within how much time? 45 days from the date when you get your GST number. Grant of registration means get your GST. It may be applicable retrospectively, but when you get your GST number in your hand, grant of registration or due date of your first, you will be filing first return, which will be for a group of months together. Supposing you are liable in June, and you are getting registration in August. So you will be filing the return of August, including the transaction of June, July and August. In 1 month, you will be including 3 months transaction. Due date of that is 20th of September. So before that, 20th of September. 45 days from the date you get your RC, due date of your first return, whichever is earlier. See that date, update the bank account within that date. If not, your registration will be cancelled. You violate section 171, anti-profiteering clause. Not so relevant now. It was relevant when the GST was introduced. With GST, you get more credit, so your cost reduces. But you are not reducing your selling price, which means you are trying to get more profit. You are trying to get more profit. Anti-profiteering clause. Not so relevant today. Was very much relevant at the time when GST was born. You are trying to get extra profit. How? With GST, you will get more credit. More credit means less cost. Less cost means you should reduce your selling price, but you are keeping the selling price same, which means you will have a extra profit. You will have a, government tells that we will cancel your GST. Is it relevant today much? No. No, it's gone. It was relevant when GST was born in 2017. Not relevant much today. You are violating the provisions of Rule 86. There's a Rule 86 which tells that if your taxable supply excluding exempt supply and zero rated supply in a particular month exceeds 50 lakhs, minimum 1% you have to pay it by cash. Minimum 1% you have to pay by cash. If I tell that your output tax is 100 and input tax is 110, what is the amount that you will normally pay by cash? You will pay nothing by way of cash, rather ITC carry forward will be 10. But if you are covered by 86B, now I am explaining 86B also. What is 86B? When it is applicable? When it is applicable? It is applicable in a scenario where your sales, taxable sales, where your outward supply of taxable supply, do not count exempt supply, do not count zero rated supply, because anyways tax will be zero. Don't count exempt supply, don't count zero rated supply, don't count your exports, don't count your supply to SEZ, don't count your supplies which are exempt. Only taxable supplies you count. If it is more than 50 lakhs, it will be applicable. It will be applicable. When it is applicable, what will happen? Here we have assumed that 86B is not applicable. If 86B is applicable, your output tax is 100, your input tax credit is 110, but how much you can use? They tell that minimum 1% we want in cash. So minimum 1% of what? 1% of all your output tax. They want in tax. So they tell that you cannot use your 100. Here how much credit you have used? 100 in the previous case. Here how much credit you can use? You have to reverse work. First you have to find what amount you have to pay in cash. Then you have to decide, okay, I have to pay minimum 1 rupee by way of cash. So how much credit I would have used? Only 99. So what is the ITC carry forward? ITC carry forward. It will not be 10, it will be 11. You are not having any loss per se. You are paying something by cash. Simultaneously your credit increases. Your credit, government wants at least something in cash. At least something in cash. You are not following 86B. You are not following 86B that we have discussed. What is 86B? It is telling that at least 1% of your output tax paid by cash. Paid by, when it is applicable? Your taxable supply other than exempt supply, zero rate supply exceeds 50 lakhs. When you are applying 86B, you will not include RCM because RCM anyways you will pay by cash. So don't include RCM. RCM always you pay by cash. You see only your net output tax. You see only your net output tax. It should be minimum 1%. It is not applicable in certain cases. Let us even discuss and complete that. It is not applicable in certain cases. What are the cases where it is not applicable? It is not applicable for government, Department of Central Government, State Government, Local Authority, Public Sector Undertaking and Statutory Body. First, government removes itself from this applicability. Then it is not applicable for a case where you are going for refund of your GST input tax credit. Refund of your GST input tax credit. More than 1 lakh. More than 1 lakh. Your refund of ITC in GST is more than 1 lakh in last year. First is government sector. Second is your refund of GST ITC is more than 1 lakh in previous year. Third, your payment of income tax. Your payment of income tax is more than 1 lakh, but not in last year. In last 2 financial years for which due date of return has gone. So directly you will not see last 2 years. You are in financial year 23-24. Now in October 2023, what will be your last 2 financial years? It will be 21-22 and 22-23. Very normal. But if you are standing in April 2023, it will not be 21-22 and 22-23 because standing in April 2023, your due date of IT return for 22-23 has not yet come. So then it will be 20-21 and 21-22. Right. So what are we talking about? First, it's not applicable for what? Government. Second, your refund of, here it is not payment, refund of GST input tax credit, which is applicable only in 2 cases. Zero rate supply and inverted duty structure is more than 1 lakh in previous year, normal previous year. Third, your payment of income tax, not refund now, it is payment of what? Income tax is more than 1 lakh. How many years? Not 1 year, not that, 2 years. That too, how to calculate? Those 2 financial years for which the due date has gone. Wait, the point is not over here. When you are seeing this income tax payment more than 1 lakh, you will be seeing for whom? Either, let us think about a company. Either the company, let us talk about proprietor, HUF. Either HUF or the Karta. Partnership firm, LLP. Either partnership firm or 2 partners, 2 designated partners. Company. Either the company or managing director, sufficient, 1 managing director sufficient, or 2 whole-time directors. Trust. Either the trust or 2 trustees. AOP. Either the AOP or 2 members of managing committee. You have more benefits. If company has not paid more than 1 lakh income tax in 2 financial years, don't worry. Check managing director. He would have paid more than 1 lakh in last 2 financial years. If he has not paid, don't worry. Check 2 whole-time directors. Payment more than 1 lakh. So that way you have to see exemption. And the last exemption, you have to see cumulative applicability. In a particular month, you will not be paying 1%. But from April to, supposing you are standing in the month of October. In October month, you are not paying 1% by cash, therefore it is applicable. But if you see April to October, totally April to October, output tax minus input tax, how much you have paid by cash already crosses 1%. Then it is not applicable. These are all the points which are there for your rule 86B. All the points, we have touched all the points that are there in your rule 86B. Now, the next violation is you are violating the ITC provisions. If you have taken wrong ITC, finished. If you have taken wrong ITC, government can, very dangerous, just by taking wrong ITC, department is having the power to cancel your GST number. If your outward supply in GSTR1 is more than GSTR3B, logical. Your sale in GSTR1 where you are not making any payment is more than sale in GSTR3B where you are making payment. They may have doubt, they will give you a notice, it may be cancelled. Next is non-return filers. You are not filing your returns. If you are under MRMP scheme, continuous 6 months. If you are under QRMP scheme, 2 quarters. MRMP 6 months. QRMP 2 quarters. MRMP 6 months. QRMP 2 quarters. What if you are a composition taxable person? It's not 3 months and all. After the due date of your GSTR 4 is over, even thereafter 3 months are getting over. Even thereafter 3 months are getting over. Like, look at this way. Regular taxable person, casual taxable person. If you are under MRMP, 6 GSTR1 or 6 GSTR3B. If you are under QRMP, 2 GSTR1 or 2 GSTR3B. Non-resident taxable person, 6 GSTR5, 6 GSTR5. 6 months, they will be filing only monthly. Composition scheme dealer, only 1 GSTR4, which is not filed even after the due date, even after 3 months. Which means the due date of GSTR4 is 30th April of next financial year. Wait for May, wait for June, wait for July. Assuming that there is no extension, it is liable for cancellation in the month of August. Only 1 GSTR4. Only 1 GSTR4. And finally, you are talking about a person who went for voluntary registration, but he is not starting his business for the first 6 months. He came for voluntary, he is filing returns. Every month return, nil return, nil return, nil return. Are we talking about a normal person? No. He came for voluntary registration. Second, we are not talking about any 6 months. We are talking about the first 6 months. We are only talking about the first 6 months. He came for voluntary registration, which was not required, and his first 6 returns are all nil returns, liable for cancellation. So you will totally find here 10 cases. We have made it simple by bifurcating the 10 cases. 4 cases where assessee as well as department can go for cancellation. 10 cases where only department can go for cancellation. Where only department can go for cancellation. Now the time limits are not so important. Might be in your MCQs they'll ask when to apply, what department will do. We are not touching the time limits. Easily you can remember the recollect the time limits, and not at all important. Never you'll get a direct question on the time limits. If at all you get, you might get in your MCQ. So I'm not touching the time limit. What we are touching is another very important concept called as effective date. When assessee applies for registration, what is the effective date of registration? This 30 days is very important. Whenever assessee is liable for registration, he has to apply for registration within 30 days. If assessee is liable for registration, and he makes application within 30 days, his registration will be effective from the date he is liable, old date. If I am liable for registration on 1st of June, if I apply on 25th of June, I may get my registration in July, August, etc. But it will be effective from 1st of June. It will be effective from 1st of June. But if at all I did not apply for registration within 30 days, I applied for registration after 30 days of becoming liable, which means I was liable for registration on 1st of June. I have made application say on 15th of July. Is it made within 30 days or after 30 days? I get the registration on 20th of August. I get the registration on 20th of August. When I was liable? 1st of June. When I applied? 15th of July. Did I apply within 30 days? No. I get the registration on 20th of August. What is my effective date? 20th of August. Not even 15th of July. It is 20th of August. The date of grant of registration. If I apply in time, old date. If I don't apply in time, future date. If I apply in time, old date. If I don't apply in time, future date. And in case of voluntary registration, it is always grant of registration. Voluntary registration has no liability. So it is always date of grant of registration. This is when assessee applies for registration. When department gives suo motu registration, you are not going for registration, department is giving you suo motu registration. It is always date of grant of temporary registration, because the registration that department will be giving you is temporary registration. Temporary registration. This is when assessee goes for registration. This is when department gives suo motu registration. What about effective date for amendment? Core field amendment by assessee. Non-core field amendment by assessee. Non-core field amendment is very simple because it is automatic approval. There is no question of any approval. Automatic approval. Officer is not involved. It is automatic approval. So when that effective date is important, it is when you are talking about core field amendment. You will apply, officer will check and give it. Now, when you talk about your effective date of core field amendment, prima facie they tell that it is the date when change happened. Supposing you have added an extra branch on 1st of June. Initially they tell that it is effective from 1st of June. But later on they change the answer, they tell that effective date of amendment shall not be earlier than a date date of submission of application. And for amendment, the time limit for you to apply is 15 days. For registration it is 30 days. For amendment it is 15 days. 1st of June, you added a branch. You applied on 12th of June within 15 days. You applied on 22nd of June after 15 days. Whether you apply within 15 days or whether you apply after 15 days, here there is no change in answer. Here they tell that your amendment will be effective from the date of submission of application, which is 12th of June or 22nd of June, as the case may be, whether you apply within 15 days or whether you apply after 15 days. So what will be the effective date? Date when you applied for amendment. Date when you, not date when you are liable. It is date, not date when it is granted. It is the present date. Date when you apply for amendment. Date when you apply for amendment. So then what is the significance of old point? At times, if commissioner wants, he can make it retrospective. He can make it a date which is 1st of June. He can tell that this amendment is effective from 1st of June. In both the cases, whether you applied within 15 days or whether you applied after 15 days. Normally, what is the effective date of amendment? Date when you apply for amendment. Whether 15 days or whether after 15 days, it is date when you apply for amendment. Can it be made retrospectively from the date when change happened? Yes, commissioner can do it. Commissioner can do it. Whether you applied within 15 days or after 15 days, commissioner can do it in both cases. And finally, what is the effective date of cancellation where assessee goes for cancellation or department goes, or where only department can go? Understand that effective date of cancellation in all cases is the same. Cancellation is a very serious matter and effective date of cancellation will be decided only by the proper officer. It can be current date, it can be an old date, retrospective date. Officer can cancel your registration today, effective from today, or he can cancel your registration today, effective from a very old date. He can cancel your registration effective from 3 years old date. Who will decide it? Officer. Whether assessee applies for cancellation or whether department goes for cancellation, in both the cases, who will decide effective date of cancellation? Proper officer. Can it be present date? Yes. Can he make it cancellation effective from a old date? Yes. Can you make cancellation effective from a future date? Yes. He can tell, I am cancelling your registration as you have asked that you will be doing business during this month, not from next month. Your registration will be cancelled with effect from 1st of next month. Normally that will not happen, but he is having the powers to cancel from future date also. Normally what will happen? Either current date or old date retrospectively also possible. That will be decided by the proper officer. What we have seen now, we have seen when registration is required, amendment is required, cancellation is required, and what will be the effective date of registration, amendment and cancellation, and your cancellation. Yes, when you talk about persons who are liable for registration, you have to see 3 provisions altogether. Section 22, turnover based registration. 24, compulsory registration, read along with section 23, no registration. Now, before we see section 23 and 24, the first provision should be section 22, turnover based registration. Turnover based registration. Based on your turnover, you have to get registered. But which is more powerful? Compared to 22, 24 is more powerful. Compared to 24, 23 is more powerful. 22 is turnover based registration. Then your more powerful provision, section 24 compulsory. And the most powerful is section 23, which tells that no need of taking registration. Now, what is this turnover based registration? Remember the story where we have discussed about politics? Right. So you're talking about apni politics can be summarized in three things in India. One is money, next is land and Ram. And when you are a very small person, turnover based association means when you are a very small person, this entire exercise should be time pass for you. Politics should be time pass for you. Now, what is the full form of AP? Arunachal Pradesh. S, U, S, Sikkim, U, Uttarakhand, M, Meghalaya, Tripura, Manipur, Nagaland, Mizoram, and Telangana, Puducherry. Telangana, Puducherry. Obviously, you'll have your other states and union territory not being covered here. So when you talk about your apni politics summary and when you talk about Telangana and Puducherry, situation is different. We have to bifurcate now into three. When you talk about Tripura, Manipur, Nagaland and Mizoram, you need to understand that for them, the limit is always 10 lakhs. Be it supply of goods or be it supply of service or be it supply of goods plus supply of service. The limit is always 10 lakhs. Whether you are dealing only with goods or services or goods plus services, limit is always 10 lakhs. Now, when you talk about Arunachal Pradesh, Sikkim, Uttarakhand, Meghalaya, Telangana, and Puducherry, whether you are talking about these will come together, whether you are talking about supply of goods or supply of service or supply of goods and service, supply of goods and supply of service, the limit is always 20 lakhs. The limit is always 20 lakhs. Other states, if at all you are talking about supply of goods alone, then it is 40 lakhs. Supply of service, supply of goods plus service. So if it is supply of goods alone, only then you have this 40 lakhs. If it is supply of goods plus supply of service or only supply of service, the limit is 20 lakhs. The limit is 20 lakhs. But this 40 lakhs, which is applicable for other states other than the special states, and that too applicable only when there is supply of goods, has two special points to address. What are the two special points to address? What are the two special points that you need to address them 40 lakhs separately? One is the plus sign and one is a minus sign. Plus sign is normally it is applicable only for supplier of goods. But even if you are talking about supply of goods along with interest on loans or deposits, you will still take the benefit of 40 lakhs. Normally, the moment small service comes in, you forget about 40 lakhs. You go to 20 lakhs and lakhs. But they allow one particular service to be along with supply of goods. Still, you can get the benefit of 40 lakhs. Interest on loan is not excluded. It is included. But still, in aggregate turnover, you have to add interest on loan. Unlike composition scheme, you have to include it. But you can still enjoy the benefit of 40 lakhs. Supposing supply of goods is 30 lakhs. Interest on loan is 5 lakhs. So your aggregate turnover is 35 lakhs. Normally, if it is goods plus services, you will resort to 20 lakhs, which would have said that you have to take registration. But in this case, you are not required to take registration. Why? Your limit is now 40 lakhs. If at all assuming you are there in states other than the special states. Your aggregate turnover is 30 lakhs goods and 5 lakhs services being specifically interest on loans or deposits. This relaxation is not for any other service. It's only for interest on loans and deposits. If it is along with goods, if it is only service along with goods, then still you can enjoy 40 lakhs, need not go down to 20 lakhs. One minus, which means you cannot enjoy the benefit of 40 lakhs in certain cases. When? We have already covered this. When your supplier, be it a trader or be it a manufacturer of what? Pan masala, tobacco, ice cream and building materials. Aerated water will not come. Pan masala, tobacco, ice cream and building materials. If you are dealing with any of these items, pan masala, tobacco, ice cream and building materials, you will resort to 20 lakhs. You cannot go for the benefit of 40 lakhs. You cannot go for the benefit of 40 lakhs. So that is all about turnover based registration. Please remember that aggregate turnover includes exempt supply. Exempt supply includes non-taxable supply. When you are getting a question where you are working in multiple states, aggregate turnover is pan-India turnover. Aggregate turnover is, which means if I am working in 2 states, first I will check my aggregate turnover. I will check my, not individually, I will check my aggregate turnover in totality. Both the states turnover, I will add the number and I will see whether I am crossing this 40 lakhs, 20 lakhs, 10 lakhs or I am within this 40 lakhs, 20 lakhs, 10 lakhs. If I am crossing this 40 lakhs, 20 lakhs, 10 lakhs, I have to get registered in both the states. Checking the criteria of aggregate turnover is pan-India. It's not state-wise, it is pan-India. I will sum up the total of all the states and see whether the aggregate turnover is up to 40 lakhs, 20 lakhs, 10 lakhs. If it is below it, no need of registration in any of the states. If it is above it, I have to get registered separately in each of the state. Now that is not pan-India. Separately in step 1, aggregate turnover, not for each state, all the states put together. Step 2, based on step 1, registration, which will be separately for each state. Now few other points. If at all you are working in 2 states where there is a fight between 2 states, you are working in Tamil Nadu and Telangana. What is the limit? Tamil Nadu, Telangana, 40 and 20. You will resort to 20. So you are checking aggregate turnover will be 20 lakhs for both the states put together. So you are working in Telangana, Tripura. 2010. Who will win? 10 lakhs will win. So your aggregate turnover of both Telangana and Tripura should be less than 10 lakhs. If you are working in Tamil Nadu, Tripura, your limit now reduces to 10 lakhs. If there is a fight between 40 lakhs, 10 lakhs will win. The younger one, 10 lakhs will win. So your aggregate turnover means both the states turnover, Tamil Nadu and Tripura together should be less than 10 lakhs. But at times, it will go back to the higher limit. When you are working in 2 states where limit is higher limit versus lower limit, by default, which will limit? The lower limit will be the criteria for all the states put together. But at times, you will go back to the higher limit. When is that? When the lower limit state deals with only exempt supply or only non-taxable supply. Anyways, you are not going to get registered in that lower limit state because of section 23. You can go back to higher limit. So what is the by default condition? Whenever there is a fight between higher limit and lower limit, who is going to win? Lower limit. You are going to 40-20 means 20 lakhs. 20-10 means 10 lakhs. 40-10 means 10 lakhs. But there is an exception. What is that exception? When there is a fight between higher limit and lower limit, you might finally go back to higher limit. When is that criteria? If the lower limit state deals only and only with exempt supply or only and only with non-taxable supply. Only and only with exempt supply and only with non-taxable supply. Because anyways, it is not going to get any revenue. Anyways, there will be no registration in that state. So by default, this is the general thumb rule. This is a general rule. This is an exception. Thumb rule is high limit versus low limit. Low limit will be applied for all the states put together. At times, you will go back to high limit when the lower limit state deals only and only with exempt supply or only and only with non-taxable supply. So that is everything about your section 22 read along with 10 bar 2019 CT. There's a notification for this 40 lakhs. Now, as I said, what is more powerful than 22? 22, then it is more powerful is 24 and finally it is 23. Now we are going to see section 23 and 24 together. There are 3 situations where you will never ever get registration irrespective of your turnover. Section 23 will talk about no registration. 24 will talk about compulsory registration. If at all you are caught between 22 and 24, go with 24, compulsory. But if you are caught between 24 and 23, go with 23. Go with 23, no registration. There are 3 scenarios where you will never ever get any registration, irrespective of your turnover. What are those 3 scenarios? Where you have supplies which is exclusively non-taxable supply, or you have supplies which is only and only exempt supply, or where you have supplies which is only and only supplies which is taxed under RCM. You are not the recipient. You are talking from the angle of supplier. You are not the recipient. You are talking from the angle of supplier. In these 3 cases, where it is only and only non-taxable supply, only and only exempt supply, only and only RCM supplies, you are not talking from the angle of recipient, you are talking from the angle of supplier in all these 3 cases. In these 3 cases, what will happen? You are not required to take any registration irrespective of your turnover. Your turnover may be 10 lakhs, 1 crore, 10 crore, 100 crore, no worries. No need of registration. But when is it possible? Only and only exempt supply, only and only non-taxable supply, only and only RCM supply from the angle of supplier, not from the angle of recipient. Recipient means compulsory. From the angle of, I am making all the supplies, I need not pay any GST. My recipients will pay under RCM. It is as good as no tax for me. No need to get registered. No need to get registered. Then there is a point which tells that agriculturalists, to the extent of supply of agricultural produce out of cultivation of land. Agriculturalist means what? Only and only individual and HUF. No one else, not agriculture company. Only and only individual and HUF. Agriculturalists, to the extent of supply of produce out of cultivation of land. Now here they don't use the word exclusively. They use the word to the extent of. To the extent of. First thing, we are not talking about reseller of agricultural produce. We are talking about farmer, agriculturalist, who is actually cultivating the produce out of land and he is selling. Now, if at all, this agriculturalist turnover is 50 lakhs, 30 lakhs produce and 20 lakhs other supplies, he will get registered. Even after getting registration, on 30 lakhs, he will never pay GST. On this 30 lakhs, he will never pay GST. So this is more of no payment than of no registration. This is more of no payment than of no registration. So if you are talking about an agriculturalist who is having agricultural produce 30 lakhs and other supplies 20 lakhs, which means assume that this agriculturalist is in the state of Tamil Nadu. Has he crossed the registration limit? Yes. He has crossed the registration limit of 40 lakhs. Therefore, he is registered. Even after getting registration, assuming all the supplies are only of goods, that being the case, I have taken 40 lakhs. Even after getting registration, assume that agricultural produce is having 5%, other supplies having 18%. On this 30 lakhs, GST will not be paid by the agriculturalist, even though he is registered, even though there is a rate of tax on the agricultural produce. Obviously, he has to pay GST at 18% on other supplies. This is more of relaxation from payment than registration. So here you understand the word extent of. To the extent of agriculture. Are we talking about a reseller? If the same person is a reseller, he will pay tax both on agricultural produce as well as on other supplies. We are talking about an agriculturalist. To the extent of supply of agricultural produce, he will not pay GST. 2 important points. Though he is registered, though there is a rate of tax. Though he is registered, Though there is a rate of tax, still he will not pay anything on this agricultural produce. So that is for your agriculturalist. Now, all the other points that you have are for other cases. Are you talking about compulsory registration, and at times 23 will help you. As we have seen 4 cases where you will never take registration, 3 where you will never take, and 1 where you will never pay. 3 where you will never take registration, 1 where you will never pay on a particular portion. Fully tax, non-taxable supply, fully exempt supply, fully RCM supply from the eyes of supplier, and agriculture to the extent of supply of agricultural produce which is out of cultivation of land. He might be registered, there may be a rate of tax on produce, but he will still not pay GST on the supply of agricultural produce. On other supplies, he will pay GST. He will pay GST. Now, when you talk about RCM, you should also understand that what we have discussed was from the angle of supplier. What if you are talking about from the angle of recipient? From the angle of recipient has to take compulsory registration. From the angle of recipient has to take compulsory registration. Now we are entering 24, read along with 23, 24. We are entering 24 here and there we will be again seeing 23 relaxation. So you are talking about supplier only having supplies tax under RCM. I am the supplier, I am having all the supplies tax under RCM. I am never going to pay tax, I will never get registered. But my recipients have to take compulsory registration even if their turnover is less than 20, 40, 20 or 10 lakhs. So here recipient has to take this compulsory registration. But normally what will happen, there will be suppliers who will have partly taxable under FCM, partly taxable under RCM. They will not get the relaxation of no registration. They have to get registered, but they will not pay tax on the supply which is taxed under RCM. Recipient will pay tax after taking compulsory registration if it is not registered. If it is not registered. That is the first point. Now, other points on interstate outward supply. On interstate outward supply of goods or of services, be it interstate supply of goods or of services, you have to take compulsory registration, but you have certain relaxations. Now, how to remember? If at all you are having interstate outward supply, we are not talking about intrastate, interstate outward supply of goods of services. So what will be the normal answer for goods? The normal answer for goods will be you have to take compulsory registration under section 24. The normal answer for services will be, though by prima facie you are covered by compulsory registration under section 24, but section 23 gives you a relaxation and tells that you can go with turnover based registration. You can go with turnover based registration, but this time this turnover based registration relaxation is not given by section 22, it is given by section 23. Section 23. Why? The moment you have interstate supply, you don't see 22, you go to 23, you go to 24. Basically, section 24 tells us even if you have interstate supply of services, you have to take compulsory registration, but there is a relaxation given under section 23 for interstate supply of services. Interstate supply of, so this turnover based registration for services, turnover based registration means what? 20 lakhs or 10 lakhs is not by virtue of 22, it is by virtue of 23. Now there is an exception when you talk about goods. When you talk about goods, if you talk about notified handicraft goods, you talk about notified handicraft goods, even though there is interstate supply, of goods, even then you can go with turnover based registration. This relaxation is again given by 23, it is not given by 22, and for goods turnover based registration means what? 40 lakhs, 20 lakhs or 10 lakhs, depending on which state you are. For notified handicraft goods, you will still get the benefit of turnover based registration, that is 40 lakhs, 20 lakhs, 10 lakhs. But because of section 23, not 22. It was thrown outside 22. It went to 24. From 24, section 23 gave a relaxation for notified handicraft goods. Now, what is the normal answer for services? Even though you have interstate supply of services, turnover based registration. But there is an exception. When you're talking about job working sector for jewelry industry. Not other industry will come in general category. Job working sector for jewelry industry, you have to take compulsory registration under section 24. For goods by default, it is compulsory registration. For services, by exception, which is job worker for jewelry sector, that is compulsory registration. For goods, when you're talking about exception, notified handicraft goods, that is turnover based registration under 23, not by 22, because of 23, 40, 20, 10 lakhs as an exception. For services, generally there is turnover based registration because of 23 relaxation, 20 lakhs and 10 lakhs. It works in a very reverse manner. So that is for your interstate outward supply. If you have intrastate outward supply, don't worry, you are not even covered in 24. Forget about 23. You take the benefit of section 22, 40 lakhs, 20 lakhs, 10 lakhs. So when you talk about 40 lakhs and 20 lakhs, 10 lakhs, it is applicable only for your intra-state supply within the state. Now next compulsory registration is for your CTP and NRTP. But for CTP, you have a relaxation. But for CTP, you have a relaxation. What relaxation you have for CTP? Same notified handicraft goods. If you are dealing with notified handicraft goods, even though you are CTP, there is no need of compulsory registration. You can go with turnover based registration. So when you talk about your CTP and your NRTP is very clear. There is always compulsory registration under section 24. CTP by default is always compulsory registration under section 24. At times, as an exception, when you are dealing with notified handicraft goods, they tell that okay, you can go with turnover based registration as per section 23, which is nothing but 40 lakhs, 20 lakhs and 10 lakhs. Rather, both are interconnected when you talk about interstate supply of notified handicraft goods, turnover based registration, and casual textile person for notified handicraft goods, turnover based registration. And for both of them, there is an additional criteria when you talk about notified handicraft goods, that though you are getting relaxation from registration, you should be a valid PAN card holder and there should be compulsory e-way. You are getting relaxation from registration, but we still want to track you. So there should be compulsory e-way. There should be compulsory, even unregistered person can generate e-way. There should be compulsory e-way. Now, other areas that you have, all the other areas that you have. First, let us take simple areas that you have. If you are required to deduct TDS, or if you are required to collect TCS, or if you are required to pay tax under section 9(5), or if you are required to distribute your credit ISD, or if you are an OIDRS from outside India to India, or if you are talking about a special agent, as per schedule 1, all of them compulsory registration, no exception. Who are they? You will find them all in exception category. TDS deductor, TCS collector, ISD, OIDRS outside India. See, TDS, TCS, ISD, OIDRS from outside India, and ECO under section 9(5). ECO under section because it is going to pay tax on behalf of both supplier and recipient. So these 5 categories, it is always compulsory registration. Compulsory registration. Right. So eco under section, eco is required to pay tax under section 9(5) compulsory. Eco who has to collect TCS compulsory. ISD TDS compulsory. Now one more point we have left out. Schedule 1 special agent compulsory. So these 6 categories, ISD, TDS, TCS, 9(5) OIDRS from outside India, special agent. Always they are required to take compulsory registration. Always they are required to take compulsory registration. Now where is this relaxation? When we are talking about your supplier of goods or services through eco other than 9(5) category, because 9(5) category you may be registered, you may not be registered based on your turnover. 9(5) is a different category where eco will take the responsibility. Right, we have discussed passenger transportation, services, accommodation, housekeeping and restaurant, where we have seen that at times if it is passenger transportation services covered under 9(5), supply will never be registered. But if it is accommodation, housekeeping, he might have to get registered because he may not be covered under 9(5) always. 9(5) has a condition that you should not be liable for registration under section 22. And when you are talking about restaurant, you may be registered, still partly it is under FCM, partly it is under 9(5), not RCM. 9(5) is not technically RCM. 9(5) is neither FCM nor RCM. Clear? So you are not talking about 9(5) case. Supplier of goods or services other than 9(5) category where eco will collect TCS. So you are not talking about Amazon through whom you are supplying the goods. Amazon will take compulsory registration. Amazon will take compulsory registration. It has to collect TCS. It has to take compulsory registration. Amazon, no exception. Amazon has to take compulsory. But what about supplier of goods through Amazon? Or what about supplier of services through different online portals or websites? Now, supplier of goods through Amazon. Now, understand it this way. Understand this way. 9(5) section 9(5) is applicable. Section 9(5) is not applicable. Section 9(5) is applicable. Section 9(5) is not applicable. If section 9(5) is applicable, eco will take compulsory registration. Eco will take compulsory registration. Supplier of 4 notified services, because 9(5) covers only 4 notified services. I am not writing an answer. I will write it depends. It depends. What you are, who you are, it depends. Case to case you have to decide. When 9(5) is not applicable, when section 9(5) is not applicable, there may be TCS, there may not be TCS, correct? TCS may not be there, TCS may be there. Because for TCS to be there, there are 2 conditions. Supply is through eco and consideration is received through eco. TCS may be there, TCS may not be there. If TCS is not there, eco, supplier of goods who is supplying through eco, supplier of service who is supplying through eco, all of them have to take turnover based registration. No one is compelled. Turnover based registration. But when TCS is applicable, eco, you have to take compulsory registration, section 24. Supplier of goods through eco, you have to take compulsory registration, section 24. Supplier of services through eco, that person who is supplying the services through eco. Now there's a relaxation for service sector, just like the normal relaxation you had in interstate outward supply. Turnover based registration, but because of section 23. Initially it is compulsory, but who's giving relaxation? 23. You'll find a difference. Here also I wrote turnover based registration, but this was because of section 22. This was because of section 22. So when you have this entire understanding, wherever 9(5) is applicable, don't worry, eco will go for Eco will go for compulsory registration. Supplier of notified services, they may have to take registration, they may not have to take registration. It depends on each of the four cases. It depends on each of the four cases. Prima facie, first category will never take registration, passenger transportation service. Second, third and fourth, they might have to take registration if their turnover is crossing 20 lakhs and 10 lakhs. Now, when you talk about 9.5 not being there, when 9.5 is not there, you have to ask another question, whether TCS is there or TCS is not there. If TCS is not there, life is very simple, whether it is eco or supplier of goods or supplier of services, turnover based registration as per section 22. If TCS is there, then eco compulsory registration. Supplier of goods through eco, compulsory registration. But when you talk about supplier of services through eco, it is turnover based registration, but because of section 23, not because of section 22. Not because of section 22, it is because of section 23. And whenever I tell turnover based registration for service sector, it is 20 lakhs or 10 lakhs. It is 20 lakhs or 10 lakhs. So that's everything about your liability to get registered. Section 22 read along with section 24, read along with section 23. You cannot crack an answer without linking all these three provisions. Special registration for CTP, NRTP, casual taxable person and non-resident taxable person. Casual taxable person and non-resident taxable person. When you talk about CTP, NRTP, everything is very special. Why? They are having temporary registration. They are having temporary registration. Let us discuss the difference point first. CTP will make a normal registration application. NRTP will make a special registration application. Because NRTP registration will be based on PAN of another person. PAN of another person who should be an Indian resident and be a valid PAN card holder. Also, NRTP will give its own proof. If NRTP is an individual, NRTP will give self-attested copy of passport. If NRTP is a company, it will give some identification number that it is having in its country. In India, we have corporate identification number CIN. Outside India, there will be some identification number that that company is having outside India. So that its own proof also it will be giving. This is only peculiar for your NRTP. This will not be there for your CTP. Now, what is the concept of CTP and RTP? Your CTP means you're there and working in Gujarat as a regular taxable person. You want to come to Tamil Nadu to participate in a business exhibition or a trade fair. Come, participate and leave. You don't have any place of business in Tamil Nadu. I'm discussing the definition as well. You don't have any place of business in that state, Tamil Nadu. So, Adani Limited, which is there in Gujarat, when it is coming to Tamil Nadu for business exhibition purposes, not having any presence in Tamil Nadu, no branches in Tamil Nadu, it is regular taxable person in Gujarat, but casual taxable person in Tamil Nadu. For Tamil Nadu, it is CTP. It will come, participate in business exhibition. When the business exhibition gets over, it will leave. It will leave. So, Adani Limited will have two GST number. In Gujarat, regular GST number. In Tamil Nadu, casual taxable person GST number. If in the same business exhibition, if you are inviting Trump to participate, who happens to be a non-resident, he is not having any presence across India, be it place of business or be it residence, he is not having any presence across India. And by the way, he is also coming for temporary purposes. He is not coming here permanently. He will come, participate and he will leave. He will leave. He is called as NRTP. He will be taking NRTP registration in Tamil Nadu. That NRTP registration is not valid for across India. NRTP is state-wise. He will take NRTP registration in Tamil Nadu. In Tamil Nadu. That registration will not have long validity. It will have a very short validity. Maximum validity will be 90 days. We will be discussing that. Now, what are the special points? Normally, when you are talking about a normal person, you have to apply for registration within 30 days when you are liable. But they have to make advance application. At least 5 days before the commencement of business, which means before the starting of business exhibition or trade fair. Advance application. Normally, After you are liable within 30 days. These people, advance application. Normally, if you apply on time within 30 days, your effective date of registration is date when you are liable. If you don't apply on time, date of grant. But for them, they can make taxable supplies only after grant of registration, which means even though they might have applied 5 days before the business exhibition starts, but officer is taking time. Officer is taking say 15 days. Whether CTP and RTP applied 5 days before business exhibition, yes. Assume that business exhibition started on 1st of April. CTP and RTP have applied 5 days before. They have applied on 20th of March, well in advance. But officer takes time and gives the registration on 5th of April. Did CTP and RTP applied in time? Yes, they applied 5 days before. They applied on 20th of March, which is more than 11 days. Correct? But officer gave registration only on 5th of April. From when they can participate in business exhibition? Only from 5th of April. Their effective date of registration will be only 5th of April. 5th of, very strict for them. Now, normally, when you take registration, whether you are required to make any deposits? No. You are not required to make any deposits. You are not required to make any deposits. But CTP, NRTP, Tamil Nadu government fears that they will run away. Adani will run away to Gujarat and Trump will run away back to USA. So it will be difficult to catch hold of them. So they take advance deposit in cash ledger, which is based on estimated net tax liability, not gross. At least to that extent they are logical. Estimated net tax liability, which means output tax minus input tax. Estimated. Why estimated? They are yet to start a business. So only estimation will be working out. So they have to make your advance tax and income tax is also estimation, right? Just like that, here you are going to pay advance tax based on your estimated net output tax liability. Normally, when you get your GST number, it is valid till it is cancelled. But CTP and RTP, when they get the GST number, it is valid for maximum of 90 days or last date mentioned on the registration certificate, whichever is, what is the validity? Repeat that. 90 days from the date of grant of registration or last date mentioned on the register. Officer may write the last date. Officer may not give you permission for 90 days. Last date mentioned on the registration certificate, whichever is earlier. Whichever is maximum validity is 90 days. Not always. Officer can give you registration only for 35 days. Right? Can you extend your registration? Yes. Conditions for extending. If you are going to extend your registration, make sure that you have made application for extension before original validity gets over. Again pay advance tax on basis of estimated net output tax liability for the next period. In that case, it can be extended for another 90 days. Again, another 90 days is not clear cut 90 days. Another 90 days from the original validity or last date on the extended registration certificate, whichever is earlier. Whichever is earlier. So, one time extension is possible. What are the criteria for extension? Apply for extension before the original validity gets over. Again pay advance tax and the extension will be valid for what? 90 days from the original validity or last date mentioned on the updated or extended registration certificate, whichever is earlier. And finally, can you extend second time? No. Extension is possible only once. If you're talking about second time extension, office will tell, come, welcome to Tamil Nadu, get a branch, come for regular taxable person. Don't come as CTP and RTP, don't come as guest, be a person here. No CTP and RTP, come as a regular taxable person. Only second time, only first time extension is possible. Second time extension is not possible. Now, don't you think that once their registration is cancelled, they might have paid extra advance tax than their liability? There might be a possibility that advance tax that they have paid is more than their actual liability. Don't worry. Take the refund. Whatever balance is lying in your cash ledger, take the, in refund chapter, you will see that the criteria for them to take the refund is they should have filed all their returns. They should have filed all their returns. Take the refund. They should have filed all their returns. Take the refund of the excess amount which is lying in your electronic cash ledger. So that is all about your CTP and NRTP. When you talk about your payment chapter, basically the section is section 49 and the corresponding rules. 49A, 49B read along with 88A, it talks about your utilization of credit and the sequence of utilization of credit, which you have already seen in your ITC chapter. 50 is the most important provision here, which talks about your interest on delayed payment. And 53A is a situation where you end up paying excess tax and thereafter there is a refund, which we'll understand when we take a example while discussing this payment chapter. And by default, when you talk about your payment, the basics fundamentals of indirect taxes is it is presumed that you have shifted the tax burden to the next person unless you prove it otherwise. So whenever you are talking about payment of taxes, it is always presumed that if at all you are talking about your indirect taxes, you have collected and made the payment. So the shifted burden is shifted to the next person unless you prove it otherwise. And another important point throughout your indirect taxes, which is under section 170, whenever you get a number, you have to round it up to the nearest rupee 1, be it tax or be it interest. Penalty, late fees, generally you will not get in decimals, because the moment you calculate tax in a round off number, penalty automatically is there in a proper number. So whenever you get any number, you have to round it up to nearest rupee 1. So basically when you talk about your payment, there are three ledgers. One is your gross output tax, which is going to hit your electronic liability ledger. Then you are going to make your payment of gross output tax by way of input tax credit. First is input tax credit, which will be hitting your electronic credit ledger, and final payment net output tax you are going to make it by way of cash. So this will hit your electronic liability ledger. This is going to hit your electronic credit ledger, and this is going to be through your electronic cash ledger. This is the outer understanding of that. Now let us understand that how you are going to get your liabilities and how you are going to close the liabilities. So whenever you have your liability is created by two ways. Either liability is created by assessee himself or by way of assessment by proper officer. So when you are talking about your liability, either assessee himself creates a liability by filing the returns, or it is determined by proper officer. And what kinds of liabilities can be there? The liabilities can be either your tax, interest, penalty, late fees, any other amount. Tax, interest, penalty, late fees, any other amount. So whether it is self-assessed by the assessee by filing his returns, or whether it is determined by the proper officer at the time of assessment, it will be either tax, interest, penalty, late fees, or any other amount. This is your creation of liability. Now how to close the liability? Basically, when you talk about closure of liability, what would be the first step? What would be the first option that assessee would opt? Closes liability by way of credit ledger or cash ledger? So he is going to close the liability by way of credit ledger. So who is going to try maximum to close the liability by way of credit ledger? And if credit amount is not sufficient, he is trying to close it by way of cash ledger. So that would be the second priority. So first priority will be credit ledger followed by cash ledger. But you need to understand that credit ledger can be used only for tax payment, and that too you have some restrictions. So what are the payments that cannot be paid by way of your credit ledger at all, and that can be paid only by way of your cash ledger? When you talk about your interest, penalty, late fees, any other amount, paid only by way of cash ledger. When you talk about composition scheme tax, paid only by way of cash ledger, because they will not have any credit. When you talk about your TDS, TCS, GST, TDS, GST, TCS, paid only by way of cash ledger. When you talk about RCM, RCM has to be paid by cash in one hand and get the credit in credit ledger in other hand. So first payment will be made only and only by way of cash ledger. Then you will get the amount in your credit ledger. So all these payments, that is your interest, penalty, late fees, any other amount, composition tax, RCM tax, GST, TDS, GST, TCS, these amounts will be paid only and only by way of cash ledger. Right. So that is a liability created by the assessee or the proper officer, and now you're closing your liability by way of payment by way of credit ledger or cash ledger. Now, at times, your liability which is created by the officer will be reduced. So, when you create your liability, you will be paying for sure. But when officer creates liability, there is another option. Rather than payment, what assessee can do? He can go for appeals. So, whenever your liabilities has been created by the officer, that liability can be reduced when you go for appeals, either by appellate authority or appellate tribunal or high court or Supreme Court. So that is reducing the liability. That is not payment of liability, that is reducing the liability. That is one more way where your one specific liability will be reduced. In your section 73-74, specifically in section 74, there is a point where the earlier you pay, the penalty will be lesser. The earlier you pay, the penalty will be, by default, penalty under section 74 is 100%. But when you talk about earlier payment, it can be 15%, 25%, 50%. So, the second point is only and only talking about reduction of penalty. So, your penalty can be reduced partly or fully, if at all. Assessee makes the payment of tax, interest and the reduced penalty within the time specified therein. Right. So, these two are not payment of liabilities. These two are reduction of liability. This is all about payment of liability. This is all about payment of liability. This is all about reduction of liability. Either you can challenge your entire liability and go in appeals, and appellate authority or tribunal or court can reduce the liability, or you accept the liability. Still, your entire liability will not be reduced, but your penalty portion can be reduced. So, that is all about your liability ledger, and understand that there is a sequence to discharge your liability. There is always a sequence to discharge your liability. If at all you have multiple months liability, how to close the liability? First priority you will be giving to whom? If you have multiple months liability, what is the first priority that you are going to give? Whether it is going to be your self-assessed liability or officer-assessed liability. First, it is always going to be your self-assessed liability. Then it is going to be your officer assessed liability. So first, try to close your own liability that you have assessed. Then try to close your liability which is ascertained by proper officer. Though the proper officer's liability can pertain to a month which is earlier than your self-assessed liability. The proper officer can ascertain your liability for Jan 2023, and your self-assessed liability can be for say April 24, May 24, June 24. First, try to close your self-assessed liability of April 24, May 24, June 24. Then try to close your officer assessed liability, though it pertains to a period which is Jan 2023 or a very old period, say 1718 or 1819. Then try to close that. Now, when you're closing your liability, it is not only tax portion, it should be all the liabilities, tax and your other dues. When you talk about other dues includes everything else. Interest, penalty, late fees and any other amount. So, you have to close your liability, entire liability, then go to the next liability, not only your tax liability. In self-assessed liability, priority will be given to whom? Priority will be given to earlier period. So, in our example, self-assessed liability pertain to April 24, May 24, June 24. First, you have to create the clear the liability of April 2024. Then you have to clear the liability of May 2024. Then you have to clear the liability of June 2024. Right. So, sequence is self-assessed, then proper officer assessed. Within self-assessed, the first priority should be of old months, then the current months. Now, this is all about your liability ledger. When we see liability ledger, a part of credit ledger and cash ledger, we automatically see. Why? When you are making the payment of your liability, you are going to use your credit ledger, or you are going to use your cash ledger, as the case may be. Correct? When you are going to close your liability, what is the amount that you are going to use normally when you are going to make the payment? Either your credit ledger for only tax purposes, cash ledger for anything. For any dues, you can use your cash ledger. But the question is, how do you get the amount in? How do you get the amount in your credit ledger and your cash ledger? By default, first you need to understand how the amount is received in your credit ledger and your cash ledger. Now understand that you get the amount in your credit ledger by way of filing your return, by way of claiming ITC, by way of filing your return. Only when you file your return, you'll get the amount in your credit ledger. This has been discussed even in your ITC chapter, where one of the criteria for claiming the credit is file your return. Only then the amount will go and sit in your electronic credit ledger. Likewise, in your cash ledger, you basically get the amount by way of making deposits in your cash ledger. How you get amount in your credit ledger? By filing your return. Whatever ITC is there, it will be reflected in your electronic credit ledger. How you get the amount in cash ledger? By making deposits. So this is a basic default understanding. How you get amount in credit ledger? Return. Use it for liability. How you get the amount in cash ledger? By depositing. Use it for anything. You don't not restricted only tax liability. It can be used for anything. Unlike credit ledger, which can be used only and only for your output tax. It cannot be used for anything else. Now, special provisions. When you talk about both your credit ledger and cash ledger, you can apply for refund. You can apply for refund. But understand that cash ledger refund can be applied by anyone. It is your deposit. You can break your deposit at any point of time. Whereas credit ledger refund can be applied only in two scenarios. One is zero rated supply, other is your inverted duty structure. Only in two cases you can get the refund of your credit ledger. But understand that you can claim the refund. In credit ledger, it is only in two cases. In cash ledger, it is in all the cases. It is in all the cases. So when you make application for refund, what will happen? Your credit ledger, cash ledger balance will decrease or increase. We are trying to make the application for refund, whether it will decrease or increase. Application for refund. I have credit ledger balance, cash ledger balance 10 lakhs. I am making refund application of 8 lakhs. So your credit ledger balance, cash ledger balance will increase or decrease? It will decrease or increase. It will decrease. This is the decreasing amount. This area is the decreasing amount. You are going to decrease it. See, credit means you are getting it. This means it is going to decrease. So when you are going to make a refund application, what will happen? Your credit ledger amount or your cash ledger amount is going to decrease. So out of 10 lakhs, if you have applied for 8 lakhs refund, balance credit ledger, cash ledger balance will be only 2 lakhs. Assume that you have made a refund application of 8 lakhs, but you get the refund only of 4 lakhs. What happens with balance 4 lakhs? It is being rejected. It is being that rejected 4 lakhs will be added or decreased? Will be added back. So claim which is being rejected will be added back. The refund claim which is rejected will be added back. Right. So that is all about your refund. Now other special points. There are certain other special points. First let us try to understand the other special points in your cash ledger. Normally, we have seen that cash ledger payments can be used for anything, including payment of TDS TCS. But here, in your credit of cash ledger, you also find again TDS TCS. This is getting the amount in cash ledger, not using it for payment of TDS TCS. Now, what is the difference? One person will be deductor, one person will be deductee. One person will be collector and one person will be collectee. Let us understand from the angle of TDS. The person who has to pay TDS, in GST it is the government. They have to pay that TDS amount by way of cash ledger. There when they are going to make the payment, it is going to decrease from the cash ledger. The opposite person against whom TDS has been deducted, the supplier to the government. The supplier to the government. They are going to get the amount in their cash ledger. They are going to get the amount in their cash ledger. Let us understand this again. Government deducts TDS for the suppliers to government if the contract value exceeds 2,50,000. That's the provision of section 51. That's the understanding of GST TDS. Government and government undertakings. Not only government there, it is also government undertakings there. Now, the person, it's just like your income tax. The person who has to pay TDS will pay only by way of cash ledger. He cannot use credit ledger. For him, that amount will decrease from cash ledger. So government has to pay that TDS liability only after depositing in cash ledger, and when it is paying TDS liability, the amount will decrease. The opposite person against whom the TDS has been deducted, that is the deductee, the supplier to the government, he'll get that amount in his cash ledger. So that is the point which is given here. Now, certain other important special points which are left out, both in your credit ledger and cash ledger. Now, if at all you have made excess payment of tax in a particular month. Supposing your liability was 10 lakhs and you had credit of 9 lakhs. What you did? You made the payment of 1 lakh by cash. So this was your input tax credit and this is the payment which you made by cash and this was your gross output tax liability. Later on you found out that your actual liability was not 10 lakhs. By typing mistake 1 lakh was typed as 10 lakhs, which means how much excess payment you have made? How much excess payment you have made? The excess payment that you have made, excess payment of output tax that you have made is 9 lakhs. Clearly you are eligible for refund. By mistake you have made the payment of excess output tax, clearly you are eligible for refund. But understand that this entire 9 lakhs you will not get in your bank account. You are not going to get in your bank account. You are going to get in your, partly in your credit ledger and partly in your bank account, not cash ledger. If it comes in cash ledger, again you will apply for refund from that. So partly in your credit ledger and partly in your bank account. So first you need to understand that this refund partly will go in your credit ledger and don't write cash ledger. Partly will go to your directly to your bank, not to your cash ledger. Partly in your credit ledger, partly to your bank. Now what part will go to your credit ledger? Refund amount is 9 lakhs. What is the ratio of utilization of credit ledger and cash ledger? Though it was wrong, 9:1. So 9 lakh multiplied by 9 divided by 10 will go and sit in your credit ledger. 9 lakh multiplied by 1 divided by 10 will go and sit in your bank. So 90,000 will go and sit in your bank and 8,10,000 will go and sit back in your credit ledger. Right, this is to ensure that you are not misusing the provisions and converting your credit into bank. Right, if you told you have made excess payment of output tax, yes, you are very much eligible for refund. You are very much eligible for refund, but that refund will partly go in your credit ledger and partly sit in your bank. So this you will not find in cash ledger. This provision you will not find in cash ledger. What is the proportion by which you made the payment in that month? 9:1. So that in 9:1 ratio, it will go in your credit ledger and it will go in your bank account, not your cash ledger. So this provision has been discussed here. Wrong or excess tax payment from your electronic credit ledger in the ratio of payment by way of credit is to cash. By way of credit will go and sit back in your credit ledger. By way of cash will not go and sit in your cash ledger, directly it will go to your bank account. Because if it sits in your cash ledger, again you will make a refund application from the cash ledger. It will directly go and sit in your bank account, not in your cash ledger. So correspondingly, you will not find anything in your cash ledger because it will directly go and sit in your bank account. Now, there is another provision, special provision which is given here. If at all you are talking about erroneous refund. So there is a recredit of repayment through electronic cash ledger where there was an erroneous refund initially which was that of electronic credit ledger. Let us try to understand. There was an ITC excess. You claimed the refund of that. It was held that it was erroneous refund. You paid it by way of cash. Now you have to get it back in your credit ledger. You had credit. You are not eligible for refund. You applied for refund. So what happened when you applied for refund? Credit ledger balance decreased. You had your credit. You applied for refund. Credit ledger balance decreased. It was found that it is erroneous refund. You paid it by way of cash. Now, when you get the amount in your bank and you paid back, you got the amount in your bank account and you paid back, that is nullified. But initially what had happened? When I applied for refund, my amount reduced from credit ledger. Don't you think that it should hit back the credit ledger? That is given. There are 4 steps. There was ITC, I applied for refund, credit balance reduced. I got in my bank account. I paid it back through my bank account cash ledger. So I received in my bank, I paid it back to bank through my cash ledger. So that is nullified. But in the entire process, my credit has been decreased. Now it has to come back. It is just like rejection, but later rejection. Just like rejection, but later rejection. It will come back and sit in my credit ledger. And just like this, when you talk about erroneous refund of tax paid from credit ledger, repaid with interest and penalty. If at all there is an erroneous refund of tax which was paid from credit ledger, now it is repaid with interest and penalty. Interest and penalty is always paid by cash ledger. So interest and penalty will come back and sit in my cash ledger. Will again come back and sit my cash ledger. Whenever you talk about interest payment and penalty payment, they have to be paid only by way of cash. And finally, when it is decided that that is not that, it will come and sit in my cash ledger. These are all special aspects. So what you have to understand is, just understand the debits and credits, how you get the liability, how you pay your liability, how you get the amount in credit ledger, how you discharge it, how you get the amount in cash ledger, how you use it. So that completes your entire credit ledger, cash ledger and liability ledger. In credit ledger, there are some special points basically pertaining to utilization of credit, which you have already completed. Order of utilization of ITC, we have already seen in your ITC chapter. But yes, in cash ledger, there are certain things that needs to be discussed. How you get the payment in your cash ledger? How you get the payment in your cash ledger? By way of deposit. Deposit should be by way of online challan or offline challan. Deposit is always by way of online challan. Always by way of online challan. There is no concept of offline challan. Deposit is always by way of online challan. There is no question of offline challan. To the extent where even if you are unregistered person, then even then officer will create an online challan for you. So if you are a registered person, your online challan will be CPIN, Common Portal Identification Number. Common Portal Identification Number. If you are unregistered person, your challan will be called as Temporary Identification Number. So deposits are always made by way of online challans. Online challans. For registered person, it is CPIN, Common Portal Identification Number, which means that challan has to be generated on the portal and it will have an identification number called as CPIN, which is a 14-digit unique number. If at all you are not a registered person, even then you have to make the payment only after generation of temporary identification number again on, which means they are very clear that challan has to be generated online, only on the portal. Whether you are a registered person or unregistered person. Whether you are a registered person or unregistered person. The second step is payment of that amount in challan, which will result into hitting the cash ledger. First step is challan. Second step is actually making the payment of that challan. When we talk about the second step, the moment you make the payment, your CPIN or TIN will convert into CIN, Challan Identification Number. Here we are talking about payment. Here we are talking about payment. What is Challan Identification Number? It is nothing but 70-digit number, 14 digits generally is of CPIN and 3 digits will be of the bank's branch code. So 14 digits is of the Common Portal Identification Number and 3 digits will be of bank's branch code, and the validity of that challan will be 15 days. The validity of that challan will be within 15 days of creation of challan, you have to make the payment. If not, don't worry, create another challan. Create another challan. And understand that one challan is sufficient to discharge all your liabilities, be it tax, interest, penalty. And one challan is sufficient to clear your liabilities of multiple months. So there can be a single challan to make the payment for 3 months of multiple liabilities. If at all you have 3 months liability, different liabilities, tax, interest, etc. Should you create multiple challans or single challan is sufficient? Single challan is sufficient for discharging multiple liabilities of multiple months. discharging multiple liabilities of multiple months. Now talking about payment. Your payment can be either online payment or offline payment. Your payment can be either online payment or offline payment. The online payment facility is when you're talking about your UPI, internet banking, credit card, debit card of authorized banks. That is your online payment. Your offline payment can be by of NEFT, RTGS. Now even IMPS is added. It was already there, but they have added this UPI and IMPS now. It was already there. Online payment is by way of UPI, internet banking, debit card, credit card. Offline payment is by way of mainly NEFT, RTGS and your IMPS, irrespective of any amount. No limitation of any amount. But when you talk about the other mode of offline payment, which is your cash or check or demand draft, which is otherwise called as OTC, over the counter payment. So when you talk about OTC, that means cash, check or demand draft. That also can be made. This is another mode of offline payment that also can be made, but there's a limitation. The amount should be up to 10,000 per challan per tax period. The tax period is monthly, per month. If it is quarter, per quarter. 10,000 per challan per tax period. But this restriction of 10,000 per challan per tax period is not applicable in cases where the payment is to be made by government department, because government is also liable to pay GST. It is also not applicable for persons notified by commissioners. These two are the persons, government department and notified persons by commissioner. Plus, it is not applicable in cases where assessee is not going and making the payment on his own. The payment is forced by the department. So when you're talking about recovering outstanding dues by the officer, proper officer during investigation or enforcement is demanding the payment to be made, or there is an ad hoc deposit demanded by the proper officer. So when officer is asking you to make the payment, even though you're making the payment by way of cash, demand draft or check, there's no limitation of 10,000 per challan per tax period. If you yourself are making the payment, there is a restriction of 10,000 per challan per tax period. So for whom all this OTC restriction is not applicable? Person, situation. Person is government department, notified person. Situation. When officer is demanding the amount. When assessee is not himself paying the amount, when officer is demanding the amount, this restriction of 10,000 per challan per tax period is not applicable. This SWIFT payment, which was there for OIDR, now it is removed. There is no such facility now available for OIDRs. Initially it was available, but now it is not available for these special categories. Now when you look at all the categories, all the different points of your liability ledger, cash ledger and liability ledger, credit ledger and cash ledger, we are done with it, except for one point of your cash ledger. Credit ledger is a kind of flexible ledger because it has got a sequence. First use IGST credit for IGST output, then for CGST output, SGST output, any ratio, any proportion. Then CGST credit, CGST output, IGST output. Then SGST credit, first for SGST output, then for IGST. But when you talk about your cash ledger, there are totally 20 pockets, 4 major heads. What are the 4 major heads? IGST, CGST, SGST or UTGST as the case may be, and compensation cess. 4 main pockets. In each of these main pockets, you'll have tax, interest, penalty, late fees, any other amount. In each of these major heads. So totally there will be 20 pockets. Totally there will be 4 multiplied by 5. Totally there will be 20 pockets. So in IGST there will be 5 minor heads. CGST there will be 5 minor heads. SGST there will be 5 minor heads. Compensation says there will be 5 minor heads. But the difficulty here is you cannot cross utilize it. If at all you have to pay CGST penalty, the amount should be there in CGST penalty cash ledger. If you have to pay IGST tax, the amount should be there in IGST tax cash ledger. If after you pay SGST interest, there should be an amount there in SGST interest cash ledger. See, one is your liability and one is your cash ledger. It is 1-to-1 utilization. It is 1-to-1 utilization. your cross utilization is not possible. So your cross utilization is not at all possible. But government realized later on that though cross utilization is not possible, you have to give them a facility so that they can transfer from one pocket to another pocket and discharge their liability. So if at all you have amount in CGST, tax, cash ledger, and you have to pay SGST, interest, liability. Assume that this amount is say 1 lakh and you have to pay SGST, interest, liability of 80,000 or let us say 80,000. How you have to do it? Direct utilization is not possible. What is your step number 1? Transfer the amount from CGST, tax, cash ledger to SGST, interest. You cannot transfer it to SGST tax because even SGST tax cash ledger cannot be used for paying SGST interest liability. To that extent, even SGST tax cash ledger cannot be used for paying SGST interest liability. Even that is not possible. Even within the major head, utilization of minor heads is not possible. So you have to transfer to SGST interest cash ledger. How much you are going to transfer? You require only 80,000. The requirement is only 80,000. So you are going to transfer 80,000. So what will happen? The amount from CGST tax cash ledger will reduce from 1 lakh to 20,000, and suddenly there will be an amount which is there in SGST interest cash ledger, which is 80,000. Now, can I use SGST interest cash ledger for paying SGST interest liability? Yes. So step number 2. What is the step number 2 that I am going to do? I am going to use my SGST interest cash ledger amount, which is 80,000, to set off my SGST interest liability. SGST interest liability. I will set it off. Now, first step is not payment. First step is mere transfer from one cash ledger to another cash ledger. Second step is payment, or otherwise called as set off. Second step is discharge of liability. So what will happen finally? My SGST interest cash ledger will become 0. My SGST liability, interest liability will also become 0. I am going to make the payment of my SGST interest liability. And finally, I will have a balance of CGST tax cash ledger of 20,000. 2 steps. 1, transfer from one pocket to another pocket. Second, payment of your liability. But when you are transferring it, now comes the scenario of section 53A. That is transfer from one government to another government. Initially, you have paid this amount of 80,000 to central government. Let us not focus on 20,000 because 20,000 still remains. Initially, you have paid this 80,000 to the central government. But finally, this amount was set up for paying your state government liability. Now, state government is telling that my liability has become 0, but I did not receive anything. State government's liability has become 0. State government's SGST interest has become 0. But in fact, state government did not receive anything. So there will be a back end transfer by the central government to the state government of the amount of 80,000 rupees. That is nothing but section 53A. Why? Again, I will tell this logic, very simple logic. State government's liability of 80,000 has become 0. But the fact is, this 80,000 was never received by state government. This was received by central, will pay it to state. So this will happen when it is between CGST, SGST, or SGST, CGST, or IGST, SGST, or SGST, IGST. It will not happen when you are talking about CNI, because for the time being, CNI payments are always with central government. It will happen only when it is between C and S or I and S. CNS or INS. Not always in the first step there will be transfer. Only if it involves C and S or I and S, there will be back-end transfer. There will be back-end transfer. So that's all about this payment. Now they have brought out a new provision, an advanced version of this, telling that if at all you are having multiple registration, you can transfer cash ledger amount from one GST number to another GST number. From one GST number to another GST number. But that's a catch. The transfer can be possible only from C and I. S is not possible. C and I. S is not possible. See, if it is within, this was example, this was within the same GST number. Within the same GST number, you can transfer it from C to S, S to A, S to C, C to I to C, or you are talking about I to S, S to I. Anything is possible. Within the same GST number, transfer from any head to any head is possible. Yes, but back-end transfer will happen only if it involves CNS or INS. But anything to anything is possible. Transfer from any head to any head is within the same GST number. But if it involves two GST number, what is the restriction? Transfer is possible only between C and I. S cannot be involved. Are we talking about two GST number of multiple persons or two GST number of the same person? Two GST number of the same person. So you are talking about two GST number of the same person, say VP Limited. You are talking about distinct person. You are talking about distinct person. Even then, though there is a restriction that it can be transferred only between C and I, finally you can plan it. I am not going to elaborate the answer in detail, but if I am telling that you have SGST, this supposing GST number 1 is that of Tamil Nadu and this is that of Maharashtra. Supposing you have SGST tax cash ledger of 1 lakh in Tamil Nadu and you have to pay SGST interest liability in the state of Maharashtra, same 1 lakh. Directly S to S transfer is not possible. Between two GST number, it is evidently clear that transfer will be allowed only if it is C and I. C and I. So what are you going to do? First, in the same GST number, you will transfer it from SGST tax to CGST tax. Assume, or IGST tax, whatever it is. Assume that we have transferred it to CGST tax. So Tamil Nadu SGST tax to Tamil Nadu CGST tax. When SGST to CGST is happening, back end transfer will be there. Tamil Nadu state government will give to central government. Second, CGST tax of Tamil Nadu to CGST tax of Maharashtra. Nothing, no back end transfer. Third, CGST tax of Maharashtra to SGST interest of Maharashtra. SGST interest of, now when it is CNS, back end transfer. Central government will give to Maharashtra state. Initially, Tamil Nadu state gave to central government. Now, central government will give to Maharashtra state. Fourth, set off. Fourth, set off. Close the liability. Because finally, you have received the amount in SGST interest, cash ledger, that of Maharashtra. So, use that cash ledger to discharge your liability. So, there will be multiple steps. There will be multiple steps. What was the first step? Within Tamil Nadu, transfer it from SGST tax cash ledger to CGST tax cash ledger within first GST number, within GST number 1. So back end transfer will happen because it involves SNC. So Tamil Nadu state will make the payment to central government 1 lakh. Then CGST tax cash ledger of Tamil Nadu to CGST tax cash ledger of Maharashtra. No back end transfer. So now amount has gone to GST number 2. Then CGST tax cash ledger to SGST interest cash ledger of Maharashtra. Back end transfer. Central government will give to Maharashtra state. Finally, fourth step is set off. First 3 steps are transfer. First step is transfer within the state of Tamil Nadu. Second is Tamil Nadu to Maharashtra. Third is transfer within the state of Maharashtra. Fourth step is set off. Fourth step is set off. That is very much possible. So that is everything about your all the ledgers, be it your liability ledger or your credit ledger or cash ledger. For every item hitting your credit ledger, cash ledger or liability ledger, there will be a unique identification number created on the portal so that you can track it. If at all in case of any technical glitches, you can track the same. And if at all there are any charges by the bank for making the payments, that charges has to be borne by the taxpayer, not by the government. And finally, the most important provision of payment chapter, which is interest on late payment. Interest on late payment. If you see the provisions now, we are done with 49, 49A, 49B, 53A. All the other provisions are done with. The only provision which is left out is your section 50 interest liability. Now break your interest liability into two parts. One, interest is on late payment of taxes, delayed payment of taxes. Second is your wrong availment and utilization of ITC. The first provision is discussed in section 50 subsection 1 and section 50 subsection 2. The second is discussed in section 50 subsection 3. So when you talk about the first scenario, let us only focus on the first scenario. In the first scenario, if at all it is a case where officer has found out that liability in terms of section 73 or 74 notice, or it is a case where the liabilities of 1 month but reported in another month. Liabilities of 1 month but reported in another month. Not next month, we'll write it as another month. Third, balance. What is balance? Balance means it is neither 73 case nor 74 case plus in this scenario liabilities of 1 month reported in the same month. Reported in the same month. Reported in the same month. In the first two cases, your interest always involves three amounts, correct? Principal, rate and the period. So what is the principal amount? In the first two cases, your liability will be on gross output tax, which means without reducing your ITC. If your gross output tax is 10 lakhs and input tax credit is 8 lakhs, your interest will not be on 2 lakhs. Interest will be on 10 lakhs. Interest will be on 10 lakhs. Including a case where 1 month liability you missed out in that month and you're reporting in other month, interest will not be on, supposing April month's liability you reported in December month. April month you have output of 10 lakhs and input of 8 lakhs, but you report that in December month. Interest will not be on 10 minus 8 lakhs. That is 2 lakhs. Interest will be on entire 10 lakhs. So it is on gross output tax liability multiplied by 18% per annum multiplied by number of days of delay. What is the starting date of delay? From the next date of due date of payment. From the next date of due date of payment to the actual date of payment. To the actual date of payment. Due date of payment is generally your due date of return filing. Normal scenario. Your due date of payment is generally your due date of return filing. Whatever is your due date of return filing will be the due date of payment. There are only two exceptions. Composition scheme and QRMP scheme opted by RTP and CTP. In that scenario, for composition scheme dealer, your due date of payment is quarterly payment after within 18 days, which means for April to June, July 18th. Interest will start from 19th July. For July to September, 18th October. Interest will start from 19th October. So there payment is quarterly, but return filing is yearly. Second, QRMP scheme. There payment is monthly, but return filing is quarterly. QR, quarterly return. MP, monthly payment. There payment for the first month of the quarter and second month of the quarter will be on 25th of the next month, which means April means 25th of May. May means 25th of June. And June month it will be 22nd or 24th of the next month, which means June month it will be either 22nd of July for the southern part of India and 24th of July for the northern part of India. Right. So only in these two cases, your due date of return filing is different from due date of payment. All the other cases, whatever is your due date of return filing is your due date of payment. Right. So what is your interest liability on? Gross output tax multiplied by 18% multiplied by period. So it will start from the next date of due date of payment till the actual date of payment. Now, what is the only change in the last scenario? When it is a normal case, it is not a case started by officer, and 1 month liability you report in the same month but after due date. Very normal case. April month liability you are reporting in April month, but you have filed your return and made your payment late. You have made your payment of taxes and filed your return late. It is not filed within the due date. It is the due taxes is not paid within the due date. Then interest is on net output tax liability, which means if your gross output tax is 10 lakhs and input tax credit is 8 lakhs, interest will be only on 2 lakhs. Interest will be only on multiplied by tax rate of interest 18% per annum multiplied by the period. Again same, next date of due date of payment till the actual date of payment. You'll have to find the number of days divided by 365. That is your interest. That is your interest when you talk about your delayed payment of taxes. Delayed payment of taxes. When you have made the payment of taxes belatedly. Right. Normally, it will be your net output tax liability, because normally what will happen? It is not a case started by officer section 73-74 case. It will not be a case of 73-74. Plus, it will be a case where 1 month liability you report in the same month. 1 month liability you report in the same month. You file that transaction in the same month return. April month transaction are reported in April month return, but they are reported after the due date. You have missed the deadline. Lot of associates will miss the deadline, right? So they will come in which category? They will normally come in the net output tax category. That is net output tax multiplied by 18% per annum multiplied by the period. Next date after the due date of payment till the actual date of payment. Now, what if there is wrong availment and utilization of ITC? What in that scenario? What in that scenario? Understand that in that case, your interest will be there not because of wrong availment, it will be because of wrong utilization. It will be because of wrong utilization. So, the principal amount will be ITC which is wrongly utilized. Supposing I avail wrong ITC and utilize in the same month, interest will start in the same month. Interest will start in the same month. Supposing I have taken wrong credit of 10 lakh of my car which is not eligible. But I have excess credit anyways. I don't utilize in the same month. I utilize after 4 months or 5 months or 9 months or a year or 2 years. Interest will not start from the date of wrong availment. It will start from the date of wrong utilization. Wrong utilization. The maximum interest rate is 24%, but the applicable interest rate here also is 18% per annum. 18% per annum. Now the from date. What would be the from date? From date depends. To date is simple. To date is simple. Till date is actual date of payment or actual date of reversal by whatever name you call. So till date is always simple. Actual date of that payment or reversal. Actual date of that payment, or what is the from date? What is the from date? From date will be depending on how you have taken that particular credit. It will be depending on different situations. Right? When that wrong utilization happened. If that wrong utilization happened by filing a particular return, then that is a different answer. If that wrong utilization happened by discharging your liability through a challan, then that will be a different scenario. See, understand that from date is something based on utilization when you have wrongly used. Correct? Correct. Assume that April month you have wrongly availed the credit, but that was utilized while filing December month return. That was utilized while filing your, what is the meaning of that? From April to December, you had credit balance more than what you have wrongly availed. You had credit balance more than what you availed. Only in December month, your credit balance was lesser than what you wrongly availed. So, if at all it is because of filing your December month return, April month you have wrongly availed your credit, but utilization happened while filing your December month return. So, if it is because of, if utilization happens while filing your return, then it is actual date of that return or due date of that month's return, whichever is earlier. Whichever is earlier. Which means, in our example, if I have taken wrong credit in the month of April, but that was wrongly utilized only in the month of December, it means December month's actual date of return filing or due date of return filing, whichever is earlier. Whichever is earlier. If that could be other scenario. I did not file my December month return. There was a notice served on me by the officer. I wrongly availed the credit in the month of April. Let us keep the same. But I utilized it. When I got the notice, I accepted my liability and I am making the payment. I am discharging the payment now by filing a challan, voluntary challan, DRC 03 challan. Say for example, I am making the payment by way of DRC 03 challan, voluntary payment. Voluntary payment. Now, somewhere in the month of December or Jan, I am paying the old dues. I am paying the old dues because of the notice being served and I am accepting my liability. While making the payment of old dues, I utilize that wrongly availed credit. Because my old dues also I can pay it by credit ledger. If you remember when we have discussed your liability ledger, all your liability, whether assessed by assessee or assessed by officer. If it is tax liability, I can use my credit ledger. So while discharging my old liability, by filing my when filing my DRC 03 challan, I have utilized that wrongly availed credit. So if a utilization happens because of voluntary payment, then it is date of voluntary payment. Date of voluntary payment. One thing you clearly need to understand is wrong availment is not an issue. What is an issue? Wrong utilization. Government will lose the revenue if you have wrongly utilized the credit. If you have taken credit of 1 crore rupees wrongly have taken credit of 1 crore rupees, but you don't use it, government is not having any problem. We will stick to our example where wrong availment happened when? Wrong availment happened in the month of April 2023. Wrong utilization happened in the month of December 23. So, problem is only December month. Interest will start somewhere in December month. If that wrong utilization happened in December while filing a December return, then interest will start from actual date of December month return filing or due date of December month filing, whichever is earlier. If in December month I wrongly utilize the credit while making the payment of old dues by a voluntary challan, which is DRC 03 challan, voluntary payment challan, DRC 03 challan, then interest will start from the date when I made the voluntary payment of old dues. Voluntary payment of, so what is the two time? Till date is very simple. Till date is actual date of payment. Till you actually close that reversal. Till you reverse that wrong ITC. Interest will continue till you correct your mistake. So, till I do the reversal, I may do the reversal somewhere in November 2024 or somewhere in Jan 2025 or somewhere in the month of November 2025. So, interest will continue till that. And one more thing, please understand. Once I have wrongly utilized it, otherwise you will think once I wrongly utilize it and again my credit balance comes up, nothing will happen with interest. Interest will continue. That coming down and going up has got no impact. Once it has come down, interest will start. Thereafter, immediately in the next month, the credit balance again shoots up. That will not change my interest. That will not change my from date is freezed. At times, interest will be calculated in two parts. I wrongly availed the credit of 1 lakh. 25,000 utilization happened somewhere in December. And balance 75,000 utilization happened somewhere in April. So 25,000 interest calculation will be separate. 75,000 interest calculation will be separate. So that also you need to understand. So this is about your interest on late payment. Three parts you need to remember. Principal, then your rate of interest, which is always 18%, and then the period. The issue or the challenging portion in this entire discussion was all about section 50 subsection 3. You need to understand that when you're taking wrong credit, that is not a problem. Issue is only when you wrongly utilize your credit. So principal amount is ITC wrongly utilized. Rate is 18% per annum. And period, your from date will be depending on when you have utilized it. If the utilization happened while filing your return, it is actual date of that month's return. In our example, December month return, or due date of December month return, whichever is earlier. If the wrong utilization happened because of voluntary payment of old dues, then it is the date of voluntary payment, because you have closed it. There is no if and but. You have closed your voluntary payment. So from date is that. And always remember that your to date in any of the cases is always actual date of payment. Your to date in any of the case is always actual date of actual date of payment. Always. Any case, till date is actual date of payment. Your till date will always remain the same. Be it your section 50 subsection 1 and section 50 subsection 2, where it depends whether it is on gross output or net output. Till date is always actual date of payment. Or be it section 50 subsection 3, wrong availment and wrong utilization of ITC, it is always actual date of payment. In ITC case, it may not be actually payment, it may be reversal. If you have credit, you will reverse it. If you don't have credit, you will make the payment. So till date is not a problem. Problem is the from date, and problem is the from date only specifically when you talk about your wrong availment and wrong utilization of credit. So that's it about your interest. A very important concept, interest, in this entire chapter. This happens to be a very important concept, and repeatedly ICAI keeps asking questions about your interest. So when you're talking about return filing, what we'll do is we'll see a master summary chart. We'll be splitting that into two discussions. There will be two master summary charts, and we'll try to see most of the concepts of all the different types of your return filing. Now when you talk about your regular taxable person and your casual taxable person, for return filing purposes, they'll be having the same types of returns. Basically, they'll be filing their GSTR1 or IFF if they are under QRMP scheme, and followed by the main return called as GSTR 3B. 2A, 2B, as already discussed in your ITC chapter, I will not be spending again the same time in 2A, 2B. They will be getting their details of input tax credit in GSTR 2A, which is dynamic, keeps changing, and ITC will be availed not on the basis of 2A, it will be availed on the basis of 2B, which is a static report. Right? They will not file it, it will be coming automatically on their portal, and they have to verify and take the credit based on GSTR 2B. 2A will be used when they are filing their annual return. So what are the returns that will be filed by your regular taxable person and your casual taxable person? GSTR1, at times IFF if you are under QRMP scheme for the first 2 months of the quarter, and GSTR 3B. GSTR 3B. So when you talk about GSTR1 and GSTR 3B, in regular taxable person and your casual taxable person, you have two options. Either you can go for the normal scheme, which is MRMP scheme, monthly return, monthly payment, or you can go for QRMP scheme, which to my understanding will be scrap spoon, because it is of no use, no benefit, though they think that they are giving a benefit. But in fact, if you see, the work is more in QRMP compared to your MRMP, because again and again you have to reconcile what you have done already in the first 2 months. Nevertheless, for your exams, you have two schemes, QRMP and MRMP. Now, when you talk about your different returns and payments in MRMP scheme, you won't have IFF, but still I'll be writing what is the due date of IFF. Then you'll have GSTR1. Payment will be always there, followed by GSTR3B. Here also let us write IFF, GSTR1, payment which is followed by GSTR3B. In your MRMP scheme, there's no concept of IFF. Let us take the months as say April, May and June to understand the concept as well as the due dates. April, May and June. So when you're talking about April, May and June, in your MRMP scheme, you will not have any IFF. So for April month, GSTR1 will be 11th of May. Payment and GSTR3B both together same due date, 20th of May. So you have to first make the payment followed by GSTR3B. May month, GSTR1 your sales report. 1 is only a sales report, a outward supply report. 3B contains your sales details with output tax, purchase details, that is corresponding ITC and the net payment. So final details are contained in your GSTR 3B. So May month GSTR1 11th June and payment and GSTR 3B is 20th June. June month again there is no IFF, 11th July and payment and GSTR 3B 20th July. For your QRMP scheme, which not everyone can opt, only certain assessees can opt. When you're talking about your QRMP scheme, what is the criteria? What is the limit? Now understand that limit is 5 crores. If you're lesser than 5 crores, you can go. What will be the due dates first? Understand that you will have now IFF also. So April, May and June. April month you will have IFF, the due date of which will be 13th of May, not 11th. There is no GSTR1. Payment will be there, but it will be on 25th of May. There is no GSTR3B. May month, there is no GSTR1. There will be again only IFF. IFF invoice furnishing facility is nothing but mini GSTR1. Mini GSTR1. So it will be 13th June. There will be no GSTR1. Payment is 25th June. There is no GSTR3B. Then in June month, there will not be any invoice furnishing facility. For the entire quarter, you will file GSTR1, which is 13th July. Whatever was not reported in IFF or missed in IFF, or you might not even file IFF, everything will be again finally reported in GSTR1 if not reported. If already reported, it will not be repeated again here. And when June is over, this is for entire quarter. When June is over, you will be making the payment and 3B. Again, this will be happening for the entire quarter, both payment and GSTR 3B. This will be there on 22nd or 24th of July, both payment as well as 3B. Whatever payment you have made, if there is a balance payment, that will be made and 3B will be filed for the entire quarter, 22nd or 24th July, 22nd for the southern part of India, 24th for the northern part of India, both payment and GSTR 3B. Here it is both payment and GSTR 3B, 22nd or 24th of July. Again, it is for the entire quarter. Right. These are the due dates for your GSTR1, IFF, GSTR1, payment and GSTR 3B. Payment and GSTR 3B. Now, let us complete the small aspects of QRMP scheme here itself. Now, can everyone enter QRMP scheme? Who can enter QRMP scheme? Who can enter QRMP scheme? First, let us talk about QRMP scheme, entry point and exit point. QRMP scheme, entry point and exit point. Is this scheme open for everyone? No. It is applicable only if your Previous year, aggregate turnover is up to 5 crores. Pan India turnover, aggregate means Pan India turnover is up to 5 crores. Right. So that is the first criteria for the entry scheme. There's another criteria. You have to opt in a particular time. What is that particular time? What is the particular time? First day of the second month of previous quarter. Last day of the first month of current quarter. Supposing you want to opt for QRMP scheme for October to December 2024. So what is the opt-in time? First day of second month of previous quarter. So previous quarter is July to September. What is the second month? August. So 1st August 2024 to what is the last date? What is the last date? Last day of the first month of the current quarter. What is the last date of the first month of the current quarter? It is 31st of October 2024. That is the opt-in time. In this period you have to opt in. In this particular period you have to opt in. And that does not stop here. When you are opting in, you should not have any pending returns. In this time gap, whenever you are opting in, supposing you are opting on 25th of October, your September return should have been filed. Supposing you are opting on 5th of August. 5th of August, whether July return has become due? No. So your June return has to be filed. If you are opting on 5th of August, what return has become due? On 5th of August, whether your July return is due? No. But whether your June return is due? Yes. Your June return should have been filed. Supposing you are opting on 25th of October, whether your September return has become due? Yes. You should have filed your September return. This is your opt-in time. In that opt-in time, whenever you are entering it, make sure that you don't have any pending returns which are due. The due date of which is crossed. So when I am opting on 5th of August, my July return need not have been filed because due date is yet to come. But my June return should have been filed. Right. So these are the three criteria for entry. These are the three criteria for entry. What are the three criteria? Previous year aggregate turnover should be up to 5 crores. There is an opt-in window. That opt-in window tells that first day, second month, previous quarter, last day, first month, current quarter. In that opting period, you have to select. And when you select, make sure that you don't have any pending returns. Make sure that you don't have any pending returns. Now, also other special points that you need to remember that if at all you are opting for QRMP scheme, one GST number, you can go for QRMP. Another GST number, you can go for MRMP. Please do not confuse this with composition scheme. You are under regular scheme. You are under regular scheme because QRMP scheme is only available for regular scheme dealer being RTP and CDB, regular taxable person and casual taxable person. So for one GST number you can go for QRMP scheme, another GST number you can go for MRMP scheme. MRMP scheme. Second special point. This opt-in is there only for the first time. Thereafter, by default, you're inside. Every time you need not tell. Even if the year changes, by default, you're inside. Only for the first time entry, this is applicable. These two conditions are applicable only for the first time entry. Thereafter, by default, you're under QRMP scheme. You need not do it every quarter. Even if the year changes, by default, you're inside QRMP scheme. By default, you're well within the QRMP scheme. That is the entry point. All the special points of entry. 3 conditions of entry, 2 special points of entry. What are the 2 special points of entry? When you are entering, it is not necessary that you have to enter for all GST number. One GST number, in one state you can go for QRMP, another state you can go for MRMP. Second special point is opting in criteria. That second and third condition, that you have to opt in a window and make sure that there are no pending returns. That is only applicable for the first time. Thereafter, by default, you are under. If you have gone for QRMP once, by default, you are inside QRMP scheme. By default, you are inside QRMP scheme. Now your exit, either it will be voluntary exit, you don't like the scheme, you're going outside, or your current year aggregate turnover has crossed 5 crores. Current year aggregate turnover has crossed 5 crores. Whenever you are going outside, again, whether it is a voluntary exit or whether it is your current year aggregate turnover has crossed 5 crores, make sure that you opt out. You opt out in a particular window. Supposing this is happening from, exit is to be done from, say, July 2025 to July 2025 onwards. It is not September now. July 2025 onwards. What is the window? Opt-out window. What is the opt-out window? Same window. First day of second month of previous quarter. What is the previous quarter? April to June. So, 1st of May 2025 to last day, first month, current quarter. 31st of July 2025. 31st of July 2025. But there is a special point. Whenever you are opting out, whether it is voluntary opt-out or forceful opt-out, because your current year aggregate turnover has crossed 5 crores. That's a window you have to opt out. But remember that if your turnover has crossed 5 crores in a particular quarter, you are thrown out from the next quarter. Not immediately. Not immediately. When your current year turnover, supposing your current year turnover crosses 5 crores somewhere in May, initially itself it crossed. You are not thrown out immediately. You will be thrown out from the next quarter. You will be thrown out from the next quarter. Not immediately you are thrown out. Next quarter. Again, it is not like composition scheme that immediately you have to go outside. You are thrown out from the voluntary opt-out means from you have decided that from next quarter you are not interested. Compulsory opt-out means your turnover has crossed 5 crores. But when your turnover crosses 5 crores, not immediately you are going outside. Supposing your turnover crosses 5 crores in say November. So October to December you can still be under QRMP scheme. You are going outside only from Jan. Only from next quarter. Only and only from your next quarter. These are all the points for entry and exit. Entry and exit. The conditions as well as the special points. Not only the conditions but also the special points of the entry and your exit from your QRMP scheme. Now, when you are inside QRMP scheme, what are the returns that you are going to file for your outward supply? Only for your outward supply. IFF versus GSTR1. Those are the returns that you file for your outward supply. Now, what is the difference? In IFF, first of all, is optional. GSTR1 is mandatory. IFF cannot be filed after due date. GSTR1 can be filed even after due date. As IFF cannot be filed after due date, there cannot be any late fees. Obviously, GSTR1 can be filed after due date, there will be late fees. There will be late fees. Even after due date, you can file and therefore there will be late fees if you are filing after the due date. IFF is there only for what all months? It is there only for the first 2 months of the quarter. GSTR1 is for the entire quarter. GSTR1 is for the entire quarter. In IFF, you can report only B2B supplies, and that too with a limit of 50 lakhs. That too with a limit of 50 lakhs. Here you can report B2B as well as B2C. Obviously, there is no limit. Unlimited. No limit. See, IFF is basically given so that your customer can take the credit. Your customer will get that in GSTR2B and he can take the credit. So it is only for B2B. That too there is a restriction 50 lakhs. I don't understand why they have put this restriction. It makes sense to report only B2B. But it really does not make sense to have a limit of IFF. Only up to 50 lakhs. Only up to, supposing B2B in first month, April month is 60 lakhs. You have to select among the customers who will disturb me, who will not disturb me. Then you have to select 50 lakhs and put. And exactly 50 lakhs will not be used. Because your invoices will never count exactly to 50 lakhs. It might be say 49 lakh 95,999 or 45 lakhs 95,695. It will never touch exactly 50 lakhs. Correct? Up to 50 lakhs. You will never get a number exactly 50 lakhs. Maybe at times it will be 47 lakhs, 95,000 because the next invoices are all more than 3 lakhs. You cannot select them. You cannot select them. Right. So this is only up to 50 lakhs. So whatever, now your question will come. So what if it is not reported in IFF? Don't worry. Whatever is left out, report in GS7. Will you be repeating those what is reported in IFF? No. Whatever is reported in IFF will not be again reported in GS7. But whatever was left out in IFF, B2C was totally left out in IFF. It will be fully reported in. So B2C for all the 3 months will come in GS7. But B2B, whatever was reported in IFF will not come in GS7. Whatever was not reported in IFF will come to. You may have decided for a particular month you are not going to file IFF, or you have crossed the due date, because after due date you cannot file IFF. After the due date has gone, you cannot file IFF. In that case, you cannot do anything, and you have to wait for GSTR1 and then file at the time of GSTR1. So whatever was left out will be then reported in your GSTR1. So these are all the differences when you talk about your IFF versus GS. Both of them can be amended. Amendment is possible in both of them. Some mistake is there, you can amend it. So amendment is possible in both of them. The differences between your IFF and your GSTR1. And obviously, needless to say, IFF is only available for a person who is going for QRMP scheme. Obviously, GSTR1 is there for QRMP scheme, quarter or MRMP scheme. So it is not for entire quarter always. It can be for that month. If you are under MRMP scheme, it will be only for a month. This I have compared IFF versus GSTR1, thinking that you are only under QRMP scheme. Right. Now, we have discussed first about your entry and exit. Then we have discussed about your output supply, difference between IFF and GSTR1. Now comes the final part. What is the final part? Payment and GSTR3B. Payment, GSTR3B is simple. Finally, you will report everything in your final GSTR3B. But what about payment? Payment. What are the due dates for payment? What are the due dates for payment? Supposing you are talking about the month of April, May and June. And supposing you have output tax in April, output tax in your April is say 10 lakhs, ITC is 8 lakhs. In May month, output tax is 6 lakhs, ITC is 3 lakhs. In June month, output tax is say 7 lakhs and ITC is say 6 lakhs. For the first 2 months of the quarter, what is the due date, by the way? What is the due date? We have already discussed the due date. For the first month, 25th of May. For the second month, 25th of June. For the third month, 22nd for the southern part of India, 24th for the northern part of India, July. 22nd or 24th of July. So due dates we have discussed. Now we are talking about options of payment. Options of payment. Now understand that when you talk about your first and second month, you have two options. Either fixed sum method or self-assessment method. Either fixed sum method or self-assessment method. You can opt either or. Either or. Now for this I need to have an information that what I was doing in the previous quarter. What I was doing in the previous quarter. Assume, what was my previous quarter, by the way? My previous quarter is Jan to March. Assume that in my previous quarter I was working under QRMP scheme and my total cash payment, my total cash ledger payment is say 6 lakhs. Is say 6 lakhs. Total payment by way of cash is say 6 lakhs. Now, that is required because I need to understand how I am going to work out an fixed sum method scheme. In fixed sum method scheme, it tells that if under your previous quarter, and it should be a complete quarter, special points we'll discuss finally. If it is in your previous quarter, you are under QRMB scheme, the calculation will be 35% of what amount you paid by cash in the previous quarter. 35% of what amount you paid by cash in the previous quarter. For the last month, you don't have fixed sum method. This option is available only for the first 2 months. Now, what is the amount that you'll get? 35% of cash paid in previous quarter. What is the amount that you have paid in previous quarter? 6 lakhs. What is 35% of that amount? 6 lakhs multiplied by 35%? 2 lakh? 2 lakh? 2 lakh 10,000, or what is the self-assessment method answer? 10 lakhs minus 8 lakhs. What is the answer? Which one you are going to select? Self-assessment method. So obviously you have an option to select any one of them, but logically speaking you will go for 2 lakhs. What about the second month? What about the second month? What is 35% of 6 lakhs? 2 lakh 10,000. And what is the other self-assessment method? It gives you 6 lakhs minus 3 lakhs, which is now which one is beneficial for you? Correct. Because now this payment is lesser. This payment is lesser. For the first 2 months, you have an option to go under fixed sum method or self-assessment. Self-assessment method is nothing but output tax minus input tax credit. What is fixed sum method? That's a percentage. If in your previous quarter you are under QRMB scheme, then it is 35% of cash payment in the previous quarter. If in your previous quarter you are under, this is applicable in your previous quarter, you are under QRMB scheme. If I tell in your previous quarter you are under MRMB scheme, then this answer would have been 100% of cash paid in last month of the previous quarter. So what was the last month of your previous quarter? March month. Because in your previous quarter, if you are under MRMB scheme, you would have made the payment on monthly basis. What is the last month of the previous quarter? March month. What is March month cash payment? Take the March month cash payment. What was the amount? Take 100%. Why? Your foundation is month and your payment is also month. But in this example, I have taken your foundation, your base is quarter, but you are making the payment for when your base is month and you are making the payment of month, 100% of cash payment made in last month of the previous quarter. But when your base is quarter, but you are making the payment for a particular month, be it April month or be it May month, it is 35% of cash payment what was done in your previous quarter, because you have paid for the entire previous quarter. Right. Now understand that this fixed sum method depends, the percentage depends on what you did in the previous quarter. Previous quarter it was under QRMB scheme. Then for first 2 months of the current quarter, that is in our example April month and May month, you have to work out both the times independently. It is 35% of cash payment which was what was done in your previous quarter. If in your previous quarter you are under MRMB scheme, then for April month and May month you have still option to go for fixed sum method. It is 100% of cash ledger payment made in March month, that is last month of the last quarter, last month of the last quarter, because the base is month and the working out is also for a month, right? But you don't have an option to go for FSM for the last month of the last month of the current quarter. This option is available only for the first 2 months of the quarter, not available for the last month. In the last month, you will be doing self-assessment method for the entire quarter. For the entire quarter. What is your entire quarter output tax? What is your entire quarter output tax? 10 lakhs plus 6 lakhs plus 7 lakhs minus what is your entire quarter input tax credit? 8 lakhs plus 3 lakhs plus 6 lakhs. So output taxes, output tax, total output tax 23 lakhs, total input tax credit 17 What is the balance payment? What is the balance payment? 6 lakhs. How much you have already paid if at all you have gone for beneficial point? How much? In assuming in April month you went under SAM method and you paid 2 lakhs. And in May month you paid 2 lakh 10,000. How much is already paid? How much is already paid? 4 lakh 10,000 is already paid. What will be the balance payment to be done in cash? What will be the balance payment to be done in cash? This 4 lakh 10,000 is paid in the month of April and May. What is the balance payment to be made? 1 lakh 90,000 is the balance payment that is to be paid by way of cash. If at all you have ended up making more payment, don't worry, apply for refund. Cash ledger refund you can apply anytime. Anyone can apply anytime. Clear? Clear? This is how you are going to do the working. And if at all April month payment, what is the due date? 25th May. If you have made the payment on 28th May, 3 days delay. Interest will be on 2 lakh multiplied by, because you have opted for 2 lakhs. So 2 lakhs multiplied by 18% multiplied by 3 divided by 365. What is the due date for your May month? 25th of June. If at all you have made the payment on 30th of June, so interest will be for on what? 2 lakh 10,000 multiplied by 18% multiplied by 5 days divided by 365. What is the last date for the entire quarter GST or 3BN payment? Assuming southern part of India, 22nd. What is the payment that is to be made? So what was the due date? 22nd July. Assume that you have made the payment on 28th of July. 28th of July. Interest will be on what? 1 lakh 90,000 multiplied by 18% multiplied by 6 divided by. With all they ask this complicated questions, it's very simple. Okay, this is how you have to calculate the interest, because due dates have been freeze for them. Accordingly, you have to calculate the interest. Are you guys clear with this understanding? Now, certain special points. Fixed sum method is applicable only if you have a clear cut full month or a clear cut full quarter. When I tell clear cut, it should be full, complete month. If in the previous quarter you are under MRMP scheme, or complete quarter if in the previous quarter you are working under QRMP scheme. Which means, assuming that you have taken registration in Feb, but you are going for, so assuming that you took registration somewhere in July, somewhere in your January 25th, in mid of a quarter, you took registration on Jan 25th. So do you have a complete quarter? No, you don't have a complete quarter. Assuming you took registration on Jan 25th and you directly opted for QRMP scheme, do you have a complete quarter? No, you don't have a complete quarter. You don't have a complete quarter. Therefore, you cannot go for fixed sum method, because fixed sum method has an assumption that the reference base, either the entire quarter or the entire month of the last quarter, is a complete tax period. Assume that previous quarter you are working under composition scheme. Assume that in the previous quarter you are working under, you cannot go for fixed sum method, because the base that you have is not a proper base. You are now under regular scheme, but previous quarter you are working under composition scheme. You don't have a proper base. So when you talk about fixed sum method, you should have a proper complete tax period, and it should be under regular scheme. Full tax period, whether it is full quarter or month. If the previous quarter was under QRMP scheme, entire quarter. The previous quarter was under MRMP scheme, entire last month of the last quarter. It should be full. Second criteria, the base should not be that of composition scheme. It should be full plus regular. It should be full. The base should be full plus regular. The base, whether the quarter or the month, should be full, and it should be under regular scheme, not under composition scheme. Otherwise, this assumption of percentage will defeat. That's everything about your QRMP scheme. How we made this simple? We first spoke about your entry exit, then your IFF and GSTR1, and finally about your payment and your GSTR3B. Now your entire QRMP is over. So what we have seen was written filing by a regular taxable person and a casual taxable person. All the concepts, be it MRMP and be it QRMP, we have done with your concepts of your MRMP scheme and your QRMP scheme, which is by your RTP and CTP. Then you are talking about a composition taxable person who basically will file two returns. One is CMP 08, which is quarterly payment, which is quarterly. It's not a written filing, it's quarterly payment, and quarterly payment will happen when? After the end of the quarter. So it has got nothing to do with your written filing, it has got everything to do with your payment. So it will be this quarterly payment will be done after the end of the quarter within 18 days. Within 18 days. So CMP 08 is all about payment. There's no question of any late fees. If this is done late, interest will come. Late fees will not come. So April to June, 18 July, July to September, 18th October, and so on. And they have to file a yearly return. That is a quarterly payment. And there's something called as your yearly return. Yearly return, which is GSTR 4. This will be, don't call it as annual return, call it as yearly return. After the year end is over, they have to file a yearly return GSTR 4, which is within 30 days, which means for a financial year, say for example 23-24, it is 30th April 2024, 30th April of the succeeding financial year, 30th April of the next financial year. So quarterly payment and yearly return, quarterly payment and yearly return. They'll have their purchases like RTP and CTP get their purchases automated, auto-populated in GSTR 2A and 2B. We have discussed the difference between 2A and 2B. These people will get in GSTR 4A, but for them it is of no much use because anyways they cannot take any credit. Right. That is all about your composition taxable person. One important point that you need to remember is even if they are working for part of the quarter or part of the year, the due dates will remain the same. It might happen that you switch over from composition scheme to regular scheme in between of a year. Say for example, on 12th of November, between a year, you decide to switch over from composition scheme to regular scheme. You can go outside composition scheme in between a year. Don't worry. So when you are going outside composition scheme, 12th November. Now, you have 1st October to 12th November, 1st October to 11th November composition scheme, 12th November onwards. So, 1st October to 11th November, still the due date for CMP 08 will be 18th of Jan. 18th of, even though it is part of the quarter, 1st October to 11th of November, still it will be 18th of Jan. Though, for the balance part of the November, you will be under regular scheme. You might make the payment for the balance part of the month of November, which is 12th November to 30th November, on or before 20th of December, assuming that you are under MRMP scheme, but that will not change the situation. Even though you are working for the part of the quarter under composition scheme, CMP 08 due date will remain the same. The same way, in this scenario, when you are going out from composition scheme on 12th November to regular scheme, you still have to file GSTR 4 for 1st April to 11th November. For the transaction between 1st April to 11th November, your GSTR 4 yearly return due date will remain the same, 30th April of next financial year. So that is a special point that you need to remember. Even though it is part of the quarter, CMP 08 due date will remain the same. Even though it is part of the year, GSTR 4 due date will remain the same. Now, we are done with the written filing by RTP, CTP and written filing by your composition taxable person. The next person in chain is your NRTP, non-resident taxable person. They have a separate written filing. They have something called as GSTR 5. GSTR 5. Please understand that now onwards, whatever is the due date of written filing is the due date of payment. There are only two cases where due date of written filing and payment differs. What are they? One is for composition scheme, that is quarterly payment, yearly return. Other is for RTP, CTP when they are under QRMP scheme. When they are under other cases, whatever is the due date of written filing is the due date of payment. So I am not going to touch both. Same thing. Now what is the due date for NRTP? The due date for NRTP both for payment and written filing is 13th after the end of the month Earlier it used to be 20th, now it is 13th after the end of the month or 7 days from the last date of registration, whichever is earlier. 13th after the end of the month or 7 days from the last date of registration, because they'll have temporary registration just like CTP, whichever is earlier. But there's a difference. Both CTP and NRTP will have temporary registration, but CTP will always go as per GSTR 1 and GSTR 3B due dates, but NRTP will have a separate due date. What is that due date? 13th after the end of the month or 7 days after the last date of registration certificate, whichever is. It is highly possible for the last 2 months you have the same due date. For the last 2 months you have the same due date, which means if at all your registration is from say 1st of April, valid from 1st of April to say, for example, say 5th of June. 1st of April to 4th of June. 1st of April to 4th of June. So if your registration is there from 1st of April to 4th of June, what is the April month's due date? April, May, June. For CTP, it is all about 1 and 3B. For NRTP, it is different. But first, let us understand for NRTP. For April month, what is the due date? 13th May. For May month, it is 13th June or 7 days from the last date of registration certificate, which will be 11th June, whichever is earlier. For June month, 13th July or 7 days from the last date of registration, which is 11th June, whichever is earlier. Whichever is. So you see for May month and June month transaction, that's the same due date. This will not happen with your CTP and NRTP because CTP, this will not happen with your CTP because it is going to file your GSTR 1 and GSTR 3B regular due date. For April month 1, it is 11th of May. GSTR 3B and payment 20th May. For May month, GSTR 1, 11th of June. GSTR 3B and payment 20th June. For June month, GSTR 1, 11th of July, though it is only for 4 days. And payment and GSTR 3B 20th of July. No change. No change. This is changing only for NRTP, and these due dates are not only for written filing but also for the payment purposes. There is no change in the understanding of your CTP. The due dates are just like what you are discussing in your 1 and 3B, assuming that CTP is going for MRMP scheme. The due dates we have discussed. Exactly same. No change. One more difference you need to appreciate and understand is CTP will have to file something called as final return, GSTR 10, whereas NRTP is not required to file final return. NRTP will not file GSTR 10, final return. Only CTP has to file final return. Both of them will not file annual return. Both of them will not file annual return. For both of them, annual return concept is not applicable. Though CTP and NRTP have a common concept called as temporary registration, but the written filings are separate. For CTP, it is GSTR 1 and GSTR 3B, the normal due dates, even though it is part of the month. For NRTP, it is different, GSTR 5. And the due date is 13th of the next month or 7 days from the last date of registration certificate, whichever is earlier. There is very high possibility for the last 2 months, the due date is it's not always the same, possibility is that. There is a possibility where it might be the same. Now, when you talk about the other returns, we are talking about GSTR 5A, which is applicable for OIDARS, who is working from outside India, who is supplying online information and database access and retrieval services from outside India to non-taxable online recipient, which means unregistered non-business persons. Unregistered non-business persons. Right. GSTR 5A will be the written filing, and the due date of payment and written filing will be the same as already discussed. It is now the same. It is always the same. 20th of the next month. For April month, 20th of May. May month, 20th of June. July month, 20th of July. So on, so forth. So it will be 20th of the next month. Both for written filing as well as for the payment purposes. But if at all you're supplying online information and database access and retrieval services from within India, you're supplier in India. For you, it is GSTR 1 and GSTR 3B. So that is all about your GSTR 5A. GSTR 6 happens to be for your input service distributor, where head office, which is ISD, will distribute the credit to the branches. It will take the credit of common input services, then distribute to the branches on basis of pro rata basis. The concept of which is there in your ITC chapter. Take the credit, distribute the credit. Take the credit, distribute the credit. This concept is common when you have multiple GSC number and you have common input services pertaining to multiple GSC number. So you have to take another registration called as ISD. Take the credit of common input services and distribute the credit to the branches. Distribute the credit to the branches. So it has to file a return. Please understand that ISD will never ever make any payment. It will never ever make any payment. It will take the credit, pass on the credit, take the credit, pass on the credit, take the credit, pass on the credit. So there's no question of any due date of payment. It is only due date of return filing. Due date of return filing, which happens to be GSTR 6 after the month is over 13 days. So for April month, 13th of May. May month, 13th of June. June month, 13th of July. The only purpose of ISD is to book the credit of common input services of that company and distribute to its branches different GSC number. Take the credit, distribute the credit. Take the credit, distribute the credit. There's no question of any payment, and they'll distribute the credit on or before 13th of the next month. So for April 13th May, May 13th June, so on, so forth. And their purchases, they will distribute the credit. How they'll get the credit? They'll get it from the supplier. Those suppliers, when they are filing their GSTR 1 IFF, that will come and sit in ISD's GSTR 6A. ISD's GSTR. If you are a regular taxable person, casual taxable person, your purchase information automatically will come and sit in 2A, 2B. 2A, if you are a composition taxable person, it will automatically come and sit in 4A. If you are ISD, it will come and sit in automatically in 6A. Right. So that is the information. You are not going to do anything. You are going to get that information automatically. Then you have a concept called as TDS and TCS. TDS is to be filed by government or government undertakings. TCS is to be filed by electronic commerce operator through whom the supplies are being made by the supplier. TDS by government, TCS by electronic commerce operator, and their written filings are GSTR 7 and GSTR 8 respectively. And for them, due date of written filing as well as due date of payment. They are not like ISD. They'll make the payment. For them, you'll have both payment and written filing. For ISD, there is only written filing because they take the credit, pass on the credit, take the credit. But for TDS and TCS, you have payment and written filing. And the due date for them is 10th of the next month. 10th of the next month. So for April month, 10th of May. May, 10th of June. June, 10th of July. So on. The person who's making the payment of TDS and TCS has to pay it by cash. The opposite person will get that in his cash ledger. The opposite person will get that in his cash ledger. Then you have something called as your annual return, which is GSTR 9, 9A, which is a ghost no one has ever seen. So don't expect any questions on 9A. GSTR 9, 9A, 9B. 9 is for a regular taxable person, 9A is for composition taxable person, but it is not effective. No one has ever filed GSTR 9A till date, because composition taxable person anyways file yearly return. But still, there's something called as GSTR 9A. 9A is for regular taxable person. CTP is not coming here. Annual return is not applicable for CTP as well as NRTP. So 9 is only for regular taxable person. 9A is for composition taxable person theoretically, but practically no. Then finally, 9B is for electronic commerce operator who's collecting TCS, who's already filing GSTR 8. Who's already filing GSTR 8. So you're talking about concept of 9, 9A and 9B. 9, 9A, and please understand that for them there's no concept of due date of payment. Though you may make the payment while filing your GSTR 9, but it's not mandatory. It's only a reporting mechanism. Payment you may make, you may not make. If you want to stop interest calculation, if you're very clear that you missed out some dues, and if you want to stop your interest calculation, make the payment. But payment is not mandatory while filing your annual return. So there's no question of due date of payment. It is only due question of due date of filing your annual return. 9A are technically called as annual return. 9B technically is called as annual statement. Annual statement. Name difference is there, and the due date of that is 31st of December of succeeding financial year. 31st of December of succeeding financial year. Be it 9 or 9A or 9B, 31st of December of succeeding financial year. Now please understand that along with 9, there can be a reconciliation statement. This is only specific to 9. Along with 9, there can be a reconciliation statement, which is GSTR 9C. 9 along with 9C. That reconciliation statement is required to be filed when? This reconciliation will reconcile the figures of your annual return GSTR 9 and annual audited financial statement, which means your GST records and your books of accounts. That will reconcile. Reconciliation will be there. So GSTR 9C is not a separate return, it is an attachment to GSTR 9. It is only an attachment to GSTR 9 which will reconcile the figures of your annual return GSTR 9 and annual audited financial statements. Annual audited financial statements. Please understand this is required only and only in scenario. Your GSTR 9C is required only if your aggregate turnover is more than 5 crores. If your aggregate turnover is less than 5 crores, only 9. More than 5 crores, 9 along with 9C. Also understand that when you're talking about GSTR 9C, there is no requirement of any signature by CA, CMA, which was initially there. So self-certification. Self-certification. A regular taxable person will always file GSTR 9. And if at all his aggregate turnover is more than 5 crores, it will be 9 along with 9C. 9 along with 9C. What is 9C? Reconciliation statement. What reconciliation will be done? Your GST annual return figures, GSTR 9, compared with annual audited financial statements. And you have to write the reasons for the differences. So reconciliation statement will be there. Now understand that there is some relaxation both when you are talking about 9C. Relaxation. We'll complete all these points here itself. This is all about your annual return. Now certain special points. 9 as well as 9C is not required to be filed by government, that is central government, state government or local authority, if their books are already been subject to audit by CAG or any other statutory auditor. If the books are already been subject to audit by CAG or any statutory auditor, then for government there is no need for GSTR 9, no need for 9C. No 9, no 9C. So if you are talking about OIDARS from outside India, government, that is central government, state government and local authority, where the books are already subject to audit by CAG or any other statutory auditor. Finally, you are talking about foreign airline company. Foreign airline company. Now, OIDRs from outside India, initially if you see the provision, you will find that they have to file their annual return. But finally, you have a relaxation. No need of 9, no need of 9C. Central government, state government, local authority, if their books are already been subject to audit by CAG or any statutory auditor, no need of 9, no need of 9C. Foreign airline companies, there are conditions. If they satisfy the condition, they have to file 9 but not 9C. What are the conditions for the foreign airline company? It should be properly complying with the Companies Act provisions and making sure that it is preparing statement of receipts and payments for their Indian operations, not for entire operations, global operations, only for their Indian operations, only for their Indian operations, certified by a chartered accountant, no CMA, certified by a chartered accountant and submitted that on or before 30th of September of next financial year for each of the GST number. For each of the GST number separately. Foreign analytic company which is satisfying the criteria of Companies Act, Red along with companies rules, and submitting the statements of receipts and payments not for the global operations but for the Indian operations GST number wise. GST number, not one, it is GST number wise, and it should be certified by ACA and submitted on or before 30th September. If all these things are satisfied, no need of 9C. If the conditions are not satisfied, 9 and 9C. 9 and 9C. Right. These are the special relaxation that you have in your annual return. Annual return. OIDRS, no condition, no 9, no 9C. Government local authority, if their books are subject to audit by CAG or statutory auditor, no 9, no 9C. But that's a condition. You have a condition. Foreign airline companies, file 9 but no 9C, but you have conditions. If you are not required to file 9C, please satisfy the conditions. Please satisfy the conditions. Right. That is all about your annual return and annual statement 9, 9A and 9B. Then you have something called as your final return, which is to be filed by regular taxable person, casual taxable person, even OIDRS from outside India. RTP, CTP and OIDRS from outside India. Final return. Final, this will come at the time of cancellation. There's something called as first return, but it is not a separate form. First return is this normal return that you file, be it 13B, be it CMP 08, normal return that you file, or be it even GSA file, for a group of months together. For a group of months, this will come, first return will come at the time of new registration and revocation of suspension. That's something called as first return, which will come when? New registration and revocation of suspension. New registration and revocation of suspension. Birth and rebirth. New registration and revocation of suspension. But it is not a separate return. You will not find any mentioning of that because it is a return that you file for a group of months. Supposing you are liable for registration on 1st of June, but you are getting registration on say 15th of July. When you are filing your first return, it will be for June and July month together, the due date of which will be 20th of August for GST 3B and for GST 11th of August. It is a normal return that you file for a group of months together. Group of months, when first return is applicable? New registration, revocation of suspension, birth, rebirth. When final return will be there? Death, cancellation. Only one scenario, cancellation. But final return is a separate return. Final return is a separate return. Who are required to file that final return? RTP, CTP, OIDRS from outside India. Basically RTP, CTP, OIDRS will not have any stock. RTP and CTP. Now, in the final return, what are they going to give? The details of stock and the ITC taken. Because when you are cancelling your registration, this has been discussed a lot of time. VJ registered is different from VJ unregistered, which means there will be deemed supply. There will be on the stock that you have. The stock details that needs to be mentioned in GST 10. You are required to make the payment. You are required to make the. So along with final return, you will find payment also being there. Correct? On the stock, you have to make the payment. Deemed supply. Deemed supply. Now what is the due date for that? The due date for that is within 3 months. It is only one time return within 3 months. Both for GST 10 and payment is within 3 months. Either from the date of cancellation or effective date of cancellation or order of cancellation, whichever is later. Whichever is, I get the registration cancellation order on 10th December, but it is effective from 1st April. So it is 10th December or 1st April, whichever is later. Whichever is, from that you have 3 months time. So from 10th December, I have 3 months time. 10th Jan, 10th Feb and 10th of March. So I have to file my final return on or before 10th of March in our example. I get the cancellation order on 10th December, but it is effective from 1st April. So first decide what from where you are going to start 3 months. Whichever is later, 1st April or 10th December, whichever is later, 10th December. From there you have 3 months time to file your annual return. Sorry, to file your final return. To file your, along with final return, will there be payment? Yes. Stock information will be there because it is deemed supply, and on that you have to make the payment. Then you have something called as GSTR 11, which is filed by international bodies having UIN, unique identification number. Unique identification number. Remember, international bodies having UIN, unique identification number. They will file their GSTR 11. Please understand that they will never make any payment. So there is no question of any due date of payment. And understand that their return filing is very special. Only when they want refund, they will file GSTR 11. If at all they are not interested in any refund, there is no requirement of filing GSTR 11. There is no requirement of filing the GSTR. So when GSTR 11, there is no due date for GSTR 11. GSTR 11 needs to be filed when they are making their refund application, or at times when it is demanded by the proper officer, which is very rare. So they will file GSTR 11. There is no due date. When they are making refund application of tax paid on their inward supplies, they don't have any outward tax. They don't have any output tax. Input tax they have, but they cannot take the credit. ITC cannot be taken, but they can apply for refund of that input tax. They cannot take the credit. So it is not refund of ITC. It is refund of input tax, not input tax credit. Refund of input tax, which is there on their inward supplies. So they'll make the refund application. So if you are supplying to international bodies, you will pay output tax, and UIN will have input tax. Can UIN take the credit? No. Because when you don't have any output tax, you cannot take the credit. Now UIN is having the burden of input tax. What UIN will do? Will go and make the refund application of the input tax. When it is making refund application, file GSTR 11 to show what all inward supplies you have and what all input tax you have. What all inward supplies you have and what all input tax you have. So that is GSTR 11. And finally, there is a return which is there in your ITC chapter called as job worker return, which is to be filed by the principal. Which is to be filed by the principal. And that return is called as ITC 04, to give the details of the goods which have gone to job worker and which have come back from job worker. That will contain the details of delivery challan given to job worker and received back from job worker. Received back from job worker. Now that due date is either half yearly or it is yearly. We are talking about half yearly return or yearly return. If I am not wrong, the limit for that is 5 crores. You can cross verify that limit for that is, take your ITC chapter and see the limit for that. It is 5 crores. If at all your turnover, aggregate turnover is up to 5 crores. Is it 5 crores? If your aggregate turnover is up to 5 crores, then what will happen? You are a small person. You file yearly ITC 1, ITC 04. You file yearly if your aggregate turnover is more than 5 crores in the preceding financial year, then you are a big person. When you are a big person, you file half yearly ITC 04. If you are a big person, 2 ITC 04 half yearly. If you are a small person, 1 ITC 04 yearly. It is yearly. So aggregate turnover of preceding financial year. What will be deciding criteria? Aggregate turnover of preceding financial year. Preceding financial year. Right. What is the due date? After the half year is over, after the year is over, 25 days. You will have time limit of 25 days. Which means if you are a small person, if your aggregate turnover in preceding financial year is up to 5 crores, you will file only yearly ITC 04, which is after the year is over, 25th of April. If you are a big person, if your preceding financial year, previous year aggregate turnover is more than 5 crores, you will file 2 ITC 04 half yearly for the first half of the year, April to September, 25th October, October to December, second half, 25th April. 25th? Obviously, there is no question of any payment because it is only an information return. It is only an information return that the goods that I have sent, whether they have come back within the time. It's only an information return. Information return. These are all the different types of returns. Now, for all these different types of return, there are 5 questions that you need to ask. 5 simple questions that you need to ask and assess whether What will be the different answers for all these different types of returns? All the different types of returns and their due dates, be it payment and return filing, and also the special points, we are done with it. Now we are trying to understand what? We are trying to understand different concepts in all these return filings. Can you rectify your mistake? If at all you have committed a mistake, all these returns, right from IFF, you will find all the returns being given here. Can you rectify your mistake? Yes, rectification of error is possible. Can you rectify your error? This is the first question that you need to ask. Yes, revision of return is not possible, rectification is possible. If there is some error or omission in April month return that you find in December month, you cannot revise your April return, but you can rectify that while filing your December return. While filing your December return, rectification is possible, revision is not possible. Rectification is possible, revision is not possible. And when you talk about your rectification, we already discussed there's a deadline which is there, same deadline for three things. One, for ITC, second, for credit note, third, for rectification of return. What is the deadline? 30th November of succeeding financial year or actual date of filing of annual return, whichever is earlier. 30th November does not mean November return. The last return in which you can rectify is October of next financial year. That too should be filed on or before 30th November of next financial year. Now there's one more special point in rectification which was not that. Rectification is possible if you find out your own mistake. Rectification is not possible if at all this error was found out by officer, whether by your scrutiny, audit, enforcement, investigation, inquiry, etc. etc. Simple concept. If you find out your own mistake, rectification is possible. If officer has found out that mistake, even though you have time, you cannot rectify. You cannot. Fairly logical. If you have found out your mistake, rectification is possible. If officer has found out your mistake, rectification not possible. Deadline, time limit is there. But the time limit is when? When you find out your own mistake. If officer has found out that mistake, forget about time limit. You cannot rectify. You cannot rectify. Now, rectification of all the types of returns is possible. But rectification is not possible when you talk about your GSTR 9, 9A, 9B, that is your annual return and annual statement. It is not possible when you talk about your, even your 10, 11 and ID0. 10 actually question, why I have put not applicable, because 10 you will be filing only once. There's no question of filing it again. So rectification is not there in 9, 9A, 9B. 10, it is not even possible. 11, not there, you cannot rectify, and even in your ITC 04, you cannot rectify. See, there are certain things law does not allows you, but practically you have to rectify. Law does not permits you. So what we are discussing is about law. 9, 9A, 9B, 10, forget about it. It is not all a possibility. 11 and ITC 04. In all other cases, rectification is possible. Now, second concept. Can you file your return of June month without filing May month return? If you have to file your June month return, you should have filed your previous month return. Return filing goes in this way. If you have filed your return for a particular month, only then you can file your return for the next month. 2. You cannot file your return for the next month without filing return of the previous month. That's a very simple concept. True for all the cases, but not true for IFF. IFF is optional. I can ignore for April, file for May. It is not true for TDS and TCS. Why? Because TDS and TCS, if it is nil return, I am not going to file it. We are going to see the next concept. If there are no transactions, I am not required to file any nil return for TDS and TCS. So, I may not file TDS return, TCS return for April month. I may still file for May month. So, this concept that I should file my previous month return for me to file my current month return is not true for IFF, not true for TDS and TCS, that is GSA 7 and 8, not true for 9, 9A, 9B. I can file my annual return of current year without filing annual return or annual statement of the previous year. Again for 10, this question will not come because it is filed only once. It is not possible. It is actually possible when you talk about your 11 and ITC04. In all these cases, I can file my GSTR 7, 8, 9, 9A, 9B, 11, ITC04 without even filing the previous period's corresponding returns. Without even filing the previous period's corresponding returns. Which means without filing April month 7 and 8, GSTR 7 and 8, I can file May month's GSTR 7, May month's GSTR 8. Without filing annual return or annual statement for financial year 22-23, I can file annual return, annual statement for 23-24. Which means without filing GSTR 11 for April month, I can still file for May month. Which means without filing half yearly or yearly ITC 04 for the previous half year or the previous year, I can still file ITC 04 for the current half year or the current year. In all these cases, I can do that. In all these cases, I can do that. They are all exceptions. Next question. Should I file my nil returns? Even if I don't have transaction, I am required to file my nil returns. I don't have an option. Even if I don't have transaction, I am required to file my nil returns. But there are exceptions. Exception being your IFF, because it is optional. If you don't have transaction, there's no question of going for any nil IFF. That really doesn't make any sense. So IFF, no need to file nil return. And then you're talking about your 7 and 8. TDS return and TCS return. If you don't have transaction, just like your income tax, you're not required to file GSTR 7 and GSTR 8. But wait, this time, when you talk about your 9, 9A, 9B, annual return, even if you don't have transaction, you have to file your annual return. You have to file your annual return. Don't look at the current provisions and tell that, sir, up to 2 crores has no requirement of filing. See, that is all yearly relaxation. It is not a provision which is permanent. It is a provision which is temporary for each year. It is a provision which is temporary for tomorrow. If they don't give this relaxation for the next financial year, you have to file your GSTR 9, 9A, 9B even if your turnover is 0. So please don't go. I have never touched that 2 crores because that 2 crores is a yearly relaxation, not a permanent relaxation. Are you guys clear with this understanding? So filing nil return is not required when you talk about your IFF, GSTR 7, GSTR 8, but for GSTR 10 it is mandatory. Even if you don't have any stock, you have to file GSTR 10. For GSTR 11, not required. ITC 04, not required. So in which all cases nil return is not mandatory? IFF, GSTR 7, GSTR 8, GSTR 11 and ITC 04. And is it mandatory for annual return, annual statement? Yes. Is it mandatory for GSTR 10? Yes. Even if you don't have stock, you have to file your final return GSTR 10. It is not like other concepts. Next, every concept will have a different answer. So you have to remember all the concepts for different points. Next, wait, by the way, before moving on to the next point, when you are going to file your nil returns, in all the other cases apart from the exceptions that you discussed, in 3 cases, you have an option to file your nil return through SMS. What are those 3 cases where you can file your nil return through SMS? GSTR 1, GSTR 3B and CMP 08. Not for GSTR 4. 1, 3B, CMP 08. 1, 3B. All the other nil returns, I have to go on portal and file it. But these 3 nil returns, 1, 3B and CMP 08, I have an option. Either go on portal and file nil return or through SMS, I can file nil return. This facility of filing through SMS is only for nil returns and that too only for 1, 3B and CMP 08, not even for GSTR 4. 1, 3B and CMP 08. Next, late fees concept. If you are filing your return late, you should pay late fees. If you are filing your return late, you should pay late fees. That's true for all the returns, but it's not true for IFF. Very simple logic. After due date, you cannot even file IFFs. You cannot even file. So question of late fees is not there. So for IFF, it is not there. For CMP 0, it is not there. Logically, this you already discussed. CMP 0 is about payment, not about return filing. If you have filed CMP 08 late, you are going to pay interest. You are going to pay. CMP 08 is for quarterly payment. It is for quarterly. So if you are filing CMP 08 late, there won't be late fees. There will be interest. There will be interest. And it is not there when you talk about your GSTR 11 and ITC 4. All the other returns, whenever you are required to file, and if you don't file on time, whenever you are required to file, and if you don't file on time, there will be late fees, including your 7 and 8. Nil 7 and 8, you are not required to file. If at all nil transaction, GSTR 7, GSTR 8, you are not required to file. If there are transactions, you should file GSTR 7, GSTR 8. And if you file that late, you have to pay late fees. You have to pay late fees. So when you don't have the concept of late fees, IFF, because you cannot file after due date. CMP 08, because for late CMP 08 there will be interest, not late fees. GST 11, because you will file that only when you want refund. Government is not bothered. And ITC report, logically speaking, there should be late fees, but as of now, there is no late fees. As of now, there is no late fees. 4 cases where there will not be any late fees. And the fifth concept, if you don't file your return, you might get a notice which will ask you to file the return within next 15 days. If you don't file even after that, your case will be taken up for scrutiny. Your case will be taken up for scrutiny. Best judgment assessment may be there. So that is the possibility that you get a notice if you don't file your return. If you don't file your return, you might get a notice. But this notice will not come for your IFF and GSTR1. Government is telling that we are not bothered about your GSTR1. If you file your GSTR1, we don't get anything. If you don't file your GSTR1, your customer will call you and tell you good words. So we are not bothered about your IFF and GSTR1. So even if you don't file your IFF and GSTR1, we are not bothered. For CMP 08, why government is not bothered? Because CMP 08 is not for return filing, it is actually for payment purposes. And there's no notice for your GSTR 11 and ITC 04. See, all the concepts are not applicable for GSTR 11 and ITC 04 and ITC 04. So when you will not get a notice under section 46, even if you don't file your returns, what are the cases? IFF, GSTR 1, CMP 08 and GSTR 11, ITC 04. In all these cases, even if you don't file your return, you are not going to get any notice under section 46. Section 46. So that is all about 5 different concepts. Now if you see your note 2 and note 3, there's a special principle interlinking your GSTR 1 and GSTR 3B. This principle or this concept is connected to your second concept. If you don't file your previous month return, you cannot file your current month return. Now they are interlinking 1 and 3B. They are interlinking 1 and 3B. If you don't file GSTR 1 of April, you cannot file GSTR 3B of April. If you don't file GSTR 3B of April, you cannot file GSTR 1 of May. If you don't file GSTR 1 of May, you cannot file GSTR 3B of May. So this goes in this sequence. So this is the sequence. First for the previous month file 1, then 3B will open. Then for that particular month, say April month, file 3B, only then May month's GSTR 1 will open. Then file GSTR 1 of May month, only then GSTR 3B of May will open, and so on. And rather than reading complicated 4 provisions, different provisions, interlinking all of them, simple provision is this. April month, first close it, then target May month. In April month, first target 1, then 3B will open. Only when you target 3B of April month, GSTR 1 will open of the. You cannot tell, I already filed GSTR 1 of April, I can file GSTR 1 of May. No. After you file 1 plus 3B of April, only then GSTR 1 of May will get open. And after you file GSTR 1 of May, only then GSTR 3B of May will get open. So this is the sequence. This is the sequence. This sequence you have to follow. Interlinking the previous month and the next month between 2 types of returns. Now, there's a new provision that is added. That provision tells that in case a registered person This is the last provision. In case the registered person gets an intimation under Rule 88C, which tells that there is a difference of liability, output liability in your GSTR1 compared to GSTR3B, which means your GSTR1 output is more than GSTR3B. Your GSTR1 or IFF, mini GSTR1, output liability is more than GSTR3B, you might get an intimation. The moment you get that intimation, what will happen is you will not be allowed to file GSTR1 or IFF from the subsequent tax period. If you get that intimation, what is being barred? Filing of GSTR1 of the subsequent tax period is being barred. Now understand, if I cannot file GSTR1 of the subsequent tax period, I cannot even file GSTR3B of the subsequent tax period because of provisions that we have discussed just now. So what is happening? They are telling that if at all you get an intimation under Rule 88C, which tells that your output tax liability in GSTR1 or IFF is more than GSTR3B, then automatically the moment you get that intimation, what will happen? What will happen? From the subsequent month, your not from the same month, from the subsequent month, you will not be in a position to file GSTR1. But when I tell you cannot file GSTR1 of the subsequent month, it is implied that you cannot even file GSTR3B, because without filing GSTR1 of that month, you cannot file GSTR3B. But they give an exception. What are the exceptions? Either you reply to that intimation, or you accept the difference and tell that I have made a mistake, pay that amount. If you agree that there is a mistake, pay that amount. If you don't agree, reply to that intimation. If you have paid or if you have replied, this will not be applicable. If you have paid or if you have replied, this restriction will not be applicable. Right? The moment you get this intimation, they are expecting you to take action. What is action? Either reply, explain the difference, or deposit. There can be genuine reason for the differences. Actually, there can be genuine reasons. You would have made a mistake in GSTR1 of earlier months where it was lesser. Now we are adding that. In 3B, it was right in the earlier months. Now you are not doing anything in 3B. So there can be genuine reasons. Either reply or make the payment. Then this restriction will not be applicable. If you don't take any action, then from next month onwards, your GSTR1 and 3B, they tell that your GSTR1 IFF will be blocked. The moment it is said that your GSTR1 IFF will be blocked, it is implied that you cannot even file GSTR3B from the next month. So that is all about your different types of returns and the different concepts therein. Now, certain special other points which we did not discuss. Late fees concept. Late fees concept. So when you talk about your late fees, understand that late fees is different for different types of returns. So first you are talking about your GSTR1, GSTR3B, GSTR4. 1, 3B and 4. In case of 1, 3B and 4, you need to understand that if at all you have a nil return, that's a different late fees. If you have a normal return, that's a different late fees. If there is a nil return, what are the late fees? If there is a nil return, what are the late fees? Irrespective of your aggregate turnover, it is rupees 100 per day or 250, whichever is, everywhere it is whichever is not higher, everywhere it is whichever is lower. The maximum late fees will be 250. And all these late fees that we are discussing is CGST late fees. Copy paste amount will be SGST late fees. So we are discussing only CGST late fees. Our discussion is restricted to your CGST late fees. Copy paste amount will be there for SGST. So when you are talking about normal GSTR 1, 3B and 4, then you have to ask a question. What is your previous year aggregate turnover? What is your previous year aggregate turnover? If your previous year aggregate turnover so and so, late fees will be so and so. If at all your previous year aggregate turnover is up to 1.5 crores, then the late fees is rupees 100 per day, subject to a maximum of 1000, subject to maximum of whichever is lower. If it is 1.5 crores to 5 crores. Then it is rupees 100 per day of delay. Per day means per day of delay. If there is 2 days delayed, 100 multiplied by 2 days. If there is 3 days delayed, 100 multiplied by 3 days. Or rupees 2500, whichever is lower. How to find out the delay? Check the due date of return and check the actual date of return. Find out the delay. If at all your previous year aggregate turnover is more than 5 crores, then it is rupees 100 per day or rupees 5000, whichever is lower. So in your text you need to make it very clear that everywhere it is rupees 100 per day or 250, whichever is lower. Rupees 100 per day or 1000, whichever is lower. Rupees 100 per day or 2500, which is lower. Rupees 100 per day or 5000, whichever is lower. Here also rupees 100 per day for composition scheme GSTR 4 or 250, whichever is lower. Rupees 100 per day or 1000, whichever is lower. I have mixed composition scheme along with this scheme because when you're talking about composition scheme, obviously your previous year aggregate turnover will be only up to 1.5 crores. So you need not remember it separately. In this chart itself, you can easily find out the answer. Obviously, it will always be up to 1000 only. It cannot go beyond it. Your composition scheme dealer, your previous year aggregate turnover cannot be more than. So obviously, you'll stop in the first slab itself. Will not go to second and third slab. You'll not obviously go to second and third slab. And by the way, late fees is separate for GSTR 1, late fees is separate for GSTR 3B because their due dates are separate. I may file GSTR 1 on time, no late fees. I may file GSTR 3B after time, there will be late fees. This is for GSTR 1, 3B and 4. There is another late fees for GSTR 7, which is for government themselves. Government will be filing TDS return. Government will be filing. Look at the irony. Government tells that how can we pay extra late fees for us? Late fees is not rupees 100 per day, it is rupees 25 per day or rupees 1000, whichever is any case. Obviously, nil GSTR 7 is not required. Normal GSTR 7 is required. So it is rupees not 100 per day. It is rupees 25 per day or 1000, whichever is lower. Right. Then you have your annual return. Annual return. GSTR 9, 9A. Rather, 9B is not covered here. 9B will go in other place. 9B is not covered here. It's only annual return, not annual statement. It's only annual return, not annual statement. In that case, forget about nil and normal. See, only for 1, 3B and 4, there's a differentiation between nil and normal. For all of the cases, whether it is nil or normal, the answer remains the same. Now, when you're talking about GSTR 9 and 9A, what is the late fees? Again, it depends on your aggregate turnover. This time your aggregate turnover is of current year. You are going to file your annual return only after the year gets over. You are not required to see that year's aggregate turnover. If you are going to file annual return for 22-23, you see aggregate turnover of 20-23. There is no requirement of seeing 21-22 aggregate turnover. You are getting that point. Why your annual return is filed after the year gets over? So that year's aggregate turnover. And the late fees. So that year's aggregate turnover, if I am not wrong, 5 crores, 25 crores and more than 25 crores. Yes, 5, 25 and more than 20, up to 5 crores. 5 crores to 25 crores and more than 25 crores. Up to 5 crores, the late fees is very special here. It is rupees 25 per day or 0.02 percentage of state turnover. Please understand when to use aggregate turnover, when to use state turnover. Whenever it is a concept, aggregate turnover, pan India. Whenever it is a calculation, finding a number, be it late fees. Now, concept was whether you are big or small. So, you have used aggregate turnover. 5 crores, 5 to 25 crores, 25 crores. And computation was calculating the number. Whenever you want to calculate the number, including when you are calculating the number under rule 42, 43. Any place where you calculate the number, even under composition scheme where you calculate the number, the moment you start calculating the number, you go with state turnover. When you talk about payment for composition scheme, you go with state turnover. You go with state turnover. The moment you start calculating the number, you go with state turnover. Inner limit for state, you go with state turnover. The moment you want to find out a number, go with, no need to buy art. Calculation, state turnover. Conceptual thing, whether you are big or small and all, aggregate turnover. Pan India, aggregate turnover. If at all you are in the second slab, rupees 50 per day of delay or 0.02 percentage of that state turnover. If it is 25 crores, more than 25 crores, aggregate turnover in that year, it is rupees 100 per day or 0.25 percentage. Now it is not 0.02, 0.25 percentage of state turnover. 0.25 percentage of state turnover. It depends on the slab. And all the other returns. All the other returns. What are the other returns that you are required to file? Are you required to file IFF? No. There is no late fees for IFF. What are the other returns that are? One is gone. IFF not relevant. 1 is gone, 3B is gone, 4 is gone. CMP 08, late fees will not come, interest will come. Then what are the other returns that you have? GSTR 5, GSTR 5A, GSTR 6. 7 is not there because 7 you have a special late fees. GSTR 8, GSTR 9, 9A special late fees. 9B is there. GSTR 10, yes, you have late fees. 11 and ITC 04, you don't have any late fees. These are all the other returns. For them, it is rupees 100 per day or 5,000, whichever is lower. This was a basic provision actually. The main provision is rupees 100 per day or 5,000, whichever is. All the other things that we discussed for 1, 3B, 4, for GSTR 7, for 9, 9A, they are all special relaxation. The normal provision is rupees 100 per day or 5,000, which is lower. Obviously, for annual return, it was rupees 100 per day or 0.25 percentage of state turnover, which was lower. Then there came a relaxation of slabs. Right. So, this is the summary of late fees for different types of returns. 1, 3B, 4, 2 categories, nil and normal. Nil and normal. 7, only 1 category because nil is not required. Only normal will be there. Very lesser, 25 per day. Suddenly they come with the concept of 25 per day or 1000, which is lower. 9, 9A. 9, 9A. No 9B. 9B will go in last category. 9, 9A. They come with again the slab. Whether it is nil or normal, it is the slab. 5, 5 to 25 and more than 25. They come with the slab. And if you see the slab, it is very special. It's very, very special. It is rupees 25 per day or 0.02 percentage of state turnover, first slab. Second, 50 per day or 0.02 percentage of state turnover, second slab. Third, rupees 100 per day or 0.25 percentage of state turnover, third slab, whichever is lower. And finally, all the other returns. So that is all about your late fees for different types of returns. Late fees for your different types of return concept. So when you see your return filing concept, we have seen the concepts of different types of return filing as well as the late fees principle. Other small aspects, understand that whenever you are filing anything, there is no mandatory DSC. You have to authenticate it. Whether it is written or any other document that you file on portal, you have to authenticate it. You have an option to authenticate by way of digital signature certificate or electronic verification code. Even if it is companies and LLB, they have an option, DSC or EVC. There's no mandatory. So you have to cancel that. There's no mandatory point. E-signature is only theoretically, not practically there. So they have only two options, DSC or EVC. DSC or EVC. There's no mandation for anyone. Even if it is companies or LLP, they can still go for EVC. One time password that will get in registered mobile number and mail ID. Now, there's something called, how many portals are there by the way? Other small concepts will complete. How many portals are there? 3. Main portal, www.gsc.gov.in. You will do all the functions there, right? Starting from taking registration, making payment, filing returns, filing appeals, etc., etc. Everything being done there. Everything else which is not covered in other 2 portals will be done here. Then there is e-waybill portal, www.ewaybill.gsc.gov.in. Only work is generating e-waybill. Then you have e-invoice portal, 10 portals, www.einvoice1.gsc.gov.in. Starting from 1, it will goes to 10. You can access only 1. 2 to 10 will be accessed by GSP, GST Suvidha providers. Alright. The only work of e-invoice portal is generating invoice. Now, when you talk about your main portal and e-invoice portal, they are managed by GST network. They are managed by GST network. So, GST network manages your 2 portals, main portal and e-invoice portal. What about e-waybill portal? It is managed by National Informatics Center. National Informatics Center. Your e-waybill portal was brought out in emergency because government failed to understand that they will manage e-waybill. They can manage e-waybill on the same portal. So it was now managed. It was then managed by National Informatics Center, NIC, National Informatics Center, Ministry of Information and Ministry of Information Technology and Communication. That is under that ministry. So NIC will manage your e-waybill portal. Now, what is GST network? It is a non-profit company, Section 8 company, having major control of government. Even banks are part of it. Now, normally you can contact directly to the portal. Second option, you can contact to the portal by GST Suvidha providers. Classic example, Tally. You need not contact, go to the portal. You can contact by way of GSP, GST Suvidha providers. They are IT companies, fintech companies, IT companies. You can contact via them, right? So, first option is directly talk to GST portal. Second option is via GSP, Third option is have even ASP, but ASP cannot talk to portal. Few information shared to application service provider. Say for example, sales information in restaurants is there in POS machine application service provider. That application service provider will give the sales information to GST Suvidha provider, and other information you directly enter into GST Suvidha provider, and finally GST Suvidha provider will talk to the portal. So you give part information to ASP, which will directly give it that to GSP, and balance information directly to GSP, which will in turn talk to portal. Why you go for application service providers? Because you can have lot of customized programs or codings with your application service provider. The role of ASP is now reduced because GSP tries to give as much as customization as it can. But even at times, the level of customization that GST Suvidha provider, big IT companies, big fintech companies, whatever they try to give, they cannot give it at the root level, because they are all big companies. They will solve the common issues, not specific issues. Now, specific issues will always be addressed by ASP, application service provider. So you will see a lot of websites, lot of apps, not websites, lot of apps that you see might not be technically GSP. They will be technically ASP. They will be talking to GST Suvidha provider. So that is all about your different portals and GSP and ASP. This completes your entire written filing chapter. When you talk about your TDS and TCS in terms of section 51 and 52, please understand that GST, TDS and TCS is different from your income tax TDS and TCS. Let us see the differences between your GST, TDS under section 51 versus GST, TCS under section 52. Now, when your GST, TDS is applicable, when your GST TDS is applicable. Applicability of GST TDS. It is applicable only for notified recipients, which means the recipient should be government or government undertakings. It is applicable only for your notified recipients. Now let us see who are all notified recipients. Notified recipients are department or establishment of central government, state government, local authority, which means you're talking about central government, state government and local authority. Then you're talking about government agencies. You don't even stop there. You're talking about other notified persons where you're talking about an authority or body or authority or board or any other body which is set up by an act of parliament or state legislature or which is established by government, either by an act of parliament or by an act of state legislature or established by government directly with a common condition. What is that common condition? The ownership of the government is 51% or more by way of equity or control. By way of equity or control. In simple language, government company, government body or government company or government authority. Right, 51% control with the government. Or you're talking about society established by the government, be it central government, state government or local authority under Societies Registration Act. Or talk about public sector undertakings. Public sector undertakings. Public sector undertakings clearly means government company. The previous point was not necessarily a company, it may be even an authority or a board, but the control is that with government. Right, so basically you're talking about whom? If you consolidate all these points here, basically the discussion is all about whom? Government, government agencies, governmental authority or board, governmental society, government companies, that is public sector undertakings. Can we call it as government or government undertakings? Government or, if the recipient is government or government undertakings, plus additional criteria, the value of the supply under contract is more than 2.5 lakhs. The value of supply under the contract is more than 2.5 lakhs. Contract value, not the transaction value. You might supply to the government 1 lakh 5 times under contract. Contract value should be more than 2.5 lakhs. Transaction value may be 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh. But contract value should be more than 2.5 lakhs. Contract value should be more than 2.5 lakhs. Excluding GST. Don't take GST into picture. Contract value other than GST should be more than 2.5 lakhs. Now, when government TDS, that is GST TDS, is not applicable. If there are two scenarios and this GST TDS is not applicable. Location of supplier and place of supply is in one state. The supplier and the place of supply is in Tamil Nadu. But location of recipient is Karnataka. Location of supplier and place of supply is Tamil Nadu. But location of recipient is Karnataka. Now, in that scenario, TDS will not be working out. Why? The type of transaction where it is CGST, SGST, intrastate. CGST, SGST. But the government is located in Karnataka. It actually cannot deduct TDS. Because if it can deduct TDS, it can be only IGST. This is only one special situation because the transfer cannot happen. They have said that it is not applicable. Location of supplier, place of supply in one state. Location of supplier, place of supply in one state. And recipient in another state. Now, typically speaking, it is an intrastate supply transaction where the tax should be CGST, Tamil Nadu SGST. But the recipient is located in Karnataka, which means government or government undertaking is located in Karnataka. If it can deduct TDS, it cannot be CGST and Tamil Nadu. It can be only. Therefore, they have said that it is not that. Don't forget about it. Don't have TDS. But if any of these things are changing, then it is applicable. I am not trying to tell that IGST TDS cannot be there. It can be very much there. Assume that location of supplier is Tamil Nadu, place of supply is Karnataka, recipient is Karnataka, then it is IGST. Whether TDS would have been there? Yes, it would have been there. It would have been very much there. This is first situation. Second situation. if the transaction is within these government undertakings, if the transaction is within these government undertakings, supplier is government or government undertakings, recipient is government undertakings, no TDS. Both supplier and recipient are government and government undertakings, no TDS. So when this TDS is applicable, there are actually multiple criteria to understand. It has to pass multiple criteria. Recipient is government undertaking. Contract value is more than 2.5 lakhs. Supply should not be government undertaking. Supply should not be government undertaking. Location of supplier, place of supply in same state, location of recipient in another state, that should not be that. That should not be. If all these are satisfied, then you'll have GST TDS. Then you'll have GST TDS. When you'll have GST TCS, when you are making supply through, ECO and payment is also routed through ECO. Supply happened via electronic commerce operator. You supplied via Flipkart, Amazon or Meesho. Payment also is via Flipkart, Amazon, Meesho. You did not get the payment in your bank account. Supply is via ECO. Payment is also received via ECO. And it should not be a case which is covered under section 9.5. If it is 9.5 case, neither the supplier will pay tax nor the recipient will pay tax. Tax will be paid by electronic commerce operator. So what are the three criteria? Supplier should supply the goods or services through ECO. Payment is again routed through ECO. Supplier does not get the payment directly in his bank account. Who will get? ECO will get. ECO will deduct his commission, GST, etc., and remit the balance payment. Third, it should not be a section 9.5 case. Now, what is the rate? TDS rate is fixed in the section itself, 2%. If it is CGST, SGST, 1 plus 1, IGST, 2, at the time of making the payment. It's very peculiar. It is at the time of making the payment. Government will deduct TDS at the time of making the. See, normally you don't find this relaxation at the time of making the payment. Why they give this relaxation? Who has to make the payment of this TDS? Government. So government may not see the invoice on time. They may make the payment after 3-4 months or 5-6 months or 7-8 months. At the time of making the payment, TDS will be deducted by the government. What is the rate? 2%. Now TCS, section tells the maximum rate can be 2%, but the applicable rate is as of now is 1%, which means CGST 0.5, SGST 0.5, if it is IGST 1%. 1% on the net value of taxable supplies when it is made. 1% on the net value of taxable supplies when the same is made. When you are making that supply, you have to collect that TCS, not at the time of payment and all, when the supply is being made. Now, what is the annual return, monthly return and payment due date that we have already discussed? 10th of the subsequent month. For TDS, it is GSTR 7. For TCS, it is GSTR 8, 10th of the next month. Whether there is any annual statement for TDS? No. But there is an annual statement for TCS, which is GSTR 9B, 31st of December of succeeding financial year. Whether any certificate needs to be given? Yes. Government is required to give a certificate GSTR 7A on the portal. Government is required to give a certificate GSTR 7A on the portal. Actually, in the long run, the certificate concept should go away. If you are getting in the portal, that is more than sufficient. So, government will be giving GSTR 7A certificate on the portal, but that certificate concept is not there in TCS. And whether there will be any matching of information, and calling for information, matching of details and calling for information, yes, that will be there in the case of TCS, not here. What is this matching of information? Supplier, when he is supplying through ECO, this particular supplier who is supplying through ECO will file his return GSTR 1 and 3B. The focus is more on GSTR 1. He'll give the details of the sales made through electronic commerce operator. Correct? Correct. He'll also file GSTR 3B. He'll also file GSTR 3B. But we are not focusing much on GSTR 3B. Our focus is only on GSTR 1. Now, at the same point of time, this electronic commerce operator, as discussed, will file monthly GSTR 8 and yearly GSTR 9B. This monthly GSTR 8, this monthly GSTR 8 will contain what? The details of supplies made by the supplier through ECO. That should match. That should match. It should match. Matching will be done of the value, state, place of supply, everything. That should match. So matching will be done in case of TCS. Because the same information is reported by both supplier and electronic commerce operator. So obviously that should match. Obviously supplier will give only his details. Electronic commerce operator will give the details of multiple suppliers. Will give the details of multiple suppliers. But that information should match. That information should match. And if it is matching, need not worry. If it is matching, need not worry. You might ask, what if it is not matching? Two possibilities. Supplier said, I have sold through Amazon 1 lakh. But Amazon tells, no. You have sold through me 1.5 lakhs. You have sold through me 1.5 lakhs. Who's going to have a problem? Supplier. Government will tell that when Amazon is selling that you have sold 1.5 lakhs to Amazon, why are you telling you have sold only 1 lakh? So what will happen? First of all, this discrepancy will be informed both to supplier and electronic commerce operator. And if it is not rectified, that difference of 50,000 will be added to output tax liability of the supplier. In the next month, it has to be paid with interest. But that is only one problem. How? Supplier said 1 lakh, Amazon said 1.5 lakhs. Government tells supplier, come here, pay GST on 50,000 with interest. If at all it is rectified, okay, because the information will go to both. If it is rectified, the matter closes that. If it is not rectified, supplier, pay GST on that 50,000 with interest, because Amazon has said that you have sold 1,50,000. You are telling you have sold only 1 lakh and no one is ready to rectify. Which means now you pay GST of 50,000 plus interest in your next return. Ulta case. Supplier is telling that I have supplied through Amazon 1.5 lakhs. Amazon is telling that this person has supplied only 1 lakh. Now who's going to have a problem? Government does not leave. Government is government. Government tells that Amazon, come sit here. You have short collected TCS. You have short collected TCS. So for not collecting TCS or short collecting TCS or collecting and not paid, you are going to pay a penalty, which is that TCS amount which is not collected or short collected or collected and not paid, or 10,000, whichever is higher. So if supplier is showing less, the action is against the supplier. If Amazon is showing less, that is electronic commerce operator is showing less, the action is against the electronic commerce operator. Either ways, government is going to take an action. But they give an opportunity. They forward the discrepancy to both. If you rectify it, then nothing. If you don't rectify, then these actions will be taken. Right. So you will find this matching of information is there in case of TCS. Also, there is calling of information. If you recollect, if at all I am supplying my goods to Amazon, Flipkart or any such places where the supply is happening through their warehouses, I have to add their place as my additional place of business. Proper officer not below the rank of deputy commissioner can serve a notice to Amazon. For example, we have taken Amazon as an example for electronic commerce operator, telling that give me the information. What was the stock of goods that this associate had in your place? How much receipt was there? How much supply of goods or services was there through you? And how much stock is still there with you? How much you received? how much was sold through you, how much still is left out. How much still is left out. We'll cross verify that information with the assessee. This is third party confirmation, external confirmation. The action is initiated against the registered person. Now, officer is taking external confirmation because assessee is telling that I have goods supplied through Amazon also, and there are some goods which is even there in Amazon's warehouse. So now officer is giving notice to Amazon and asking that, okay, he's selling that, he's having your goods there. Please give us the information that how much stock was received, how much was supplied through you, and how much is still left out. How much is still left out. If Amazon is not sharing this information within 15 days, Amazon has to pay a penalty of up to 25,000. Amazon is under obligation to share this information. By the way, in accounts and records, we have already discussed that this information will be with Amazon owner-wise, item-wise. Owner-wise, item-wise. Amazon has to share this information. Amazon has to share this particular information. So that you need to understand. You have to make a small correction and rectification. Rectification, the due date is now 30th November of the next financial year or actual date of annual return, whichever is earlier. It's not rectification. 3 cases, the due date is different. Same, rather 3 cases, the due date remains the same. What are the 3 cases? ITC, credit note, rectification. Rectification of return is of returns including the TCS return. What is the due date? 30th November of next financial year or actual date of filing of annual statement, because they will be filing annual statement whichever is earlier. So this is not 30th due date of September return. It is 30th of November of next financial year or actual date of, not due date, actual date of filing of annual statement whichever is earlier. Now, if you see all your concepts here, rather the same penalty which is there for not collecting TCS or short collecting TCS or collecting and not paying TCS is equally there for TDS. Not collecting TDS, not detecting TDS, short detecting TDS, detecting but not paying TDS, same penalty, higher of 10,000 or we are talking about that TDS amount whichever is higher. What is that TDS amount? Non-deduction, short deduction or deducted but not paid. Now, when you see this entire differentiation chart, major points of TDS and TCS are getting over. Now, what are the leftover points? Let us see the leftover points point by point. Please understand that if at all you are talking about TDS or TCS, it is only on a taxable item, not on the exempt item. You don't include exempt item. Let us see for TCS. If at all you have supplied goods item A which is attracting 5% through eco, electronic commerce operator will collect TCS. If you have supplied an exempt item, through eco will not collect TCS because there is no tax. Eco will not collect TCS. So what is the understanding here? If a product is exempt, there is no question of any TCS. Now let us understand TDS for the same point. If at all you are supplying item A which is having 1 lakh as the value with GST 5,000 along with item B which is having value as 3,50,000. The contract value is not crossing 2,50,000 because you are not going to include exempt item. So contract value is still 1 lakh. GST don't include it. Contract value does not include GST. Does not crossed 2,50,000. If you add taxable plus exempt, it has crossed 2,50,000. But actually it has not crossed 2,50,000 in the second case. 2 lakh 50 item A, GST 12,500 on item A and 50,000 item B. Again, the contract value is still 2 lakh 50. Again, no TDS. Why? For TDS to be there, the contract value should be more than 2 lakh 50, not more than or equal to. Should be more than 2 lakh 50. Now, in the third case, where there is an item A with TDS 15,000. Now, your contract value is 3 lakhs. TDS will be applicable. What is the summary of both? You do not include exempt item. You don't include exempt supply. You don't include exempt supply. Next concept here. If at all, the supply is by unregistered person. If at all, the supply is by unregistered person, which is possible in one scenario, supplier of service. Which is possible in one scenario, supplier of service through eco. Not possible for supplier of goods through eco. It is possible for supplier of service through eco. This possibility that supplier is not registered is only in case of supplier of service through eco. Supplier of, when we see registration, we'll find that supplier of services through eco, they need not take registration till their turnover is crossing 20 lakhs, 10 lakhs. So there is a possibility. If at all supplier itself is not registered. Supplier itself is not registered. Again, there's no question of any TCS. There's no question of any TCS. The same way, when you are making the supply to the government, you can be unregistered person. You can be unregistered person because your turnover is not crossing 40 lakhs, 20 lakhs, 10 lakhs. This is possible for both supplier of, this possibility is for both supplier of goods as well as supplier of services. In TCS, that possibility is there only for supplier of service. This possibility is both for supplier of goods as well as supplier of service. If you are not registered, if supplier is not registered, no TCS by eco, no TDS by government. No TCS by eco, no TDS by government. Because if they deduct it, the opposite person will not get that in their portal because they are not registered. Clear? Second concept. If the supplier is not registered, no question of TCS by eco, TDS by government. Now the next possibility here. If at all you are talking about a scenario where the transaction is taxable under RCM. Supplier is making a supply through eco, but it is taxable under RCM. Again, there is no TCS. You may be registered, but there is no TCS. Why? Because if TCS is being collected, it will be against the supplier. But who's going to pay the tax? Recipient. Who's going to pay the tax? By the way, eco is not recipient. Recipient will be a third person. Likewise, in the same way, if you are making supply to the government and government is liable to pay under RCM and government is liable to pay under RCM, which is very rare, not possible normally. Assume it is there, then there's no question of any TDS. See, who has to pay? GST, government has to pay. Now, government cannot deduct TDS. Right? Now, if you look at all these points, they are not clearly given in the provisions. They are given by FAQs. FAQs released by CBIC. So, if at all you are having an exempt supply, don't count it. Both for TCS as well as for TDS. If supplier is not registered, no TCS, no TDS. If it is under RCM, no TDS, no TCS. Now, that's a difference finally. If at all you are talking about a supply where supply is made by a composition scheme dealer. Through eco, where TCS is there. This situation will never come, not applicable. Because if supply is made by a composition scheme dealer through eco where TCS is applicable, he will be thrown out from composition scheme. So this will never ever practically come. I have not written yes or no, not applicable. Because if supply is made by a composition scheme dealer through an eco, he can make supply through eco. But where TCS is applicable, he'll be thrown outside composition scheme. He'll be thrown outside because he has to go out from composition scheme to regular scheme. Whereas you can be a composition scheme dealer and you can be a composition scheme dealer and you can supply to government where the contract value is more than 2,50,000. Whether TDS will be there? Yes. Don't worry. Government will deduct TDS. Composition scheme dealer will get that amount in its cash ledger. He'll use it. That's the only difference. Exempt supply don't include both for TDS, TCS. Supplier not registered, no TDS, no TCS. RCM, no TDS, no TCS. Composition scheme dealer, where TCS is applicable, it cannot be that. That situation cannot arise. Composition scheme dealer supplying to government, don't worry. If other conditions are satisfied, TDS will be there. So you'll have all these situations here. Now, if you look at your entire TDS and TCS, we are done with it. And there's a small point of refund given in your TDS. In case of excess or erroneous deduction by government in terms of TDS, refund will be given to the deductor or deductee except in a case where it has gone to the electronic cash ledger. See, normally if at all, just like your income tax, if I have deducted extra TDS and if the opposite person has claimed it, no worry. Why are you worrying? There was an excess deduction and payment and the opposite person has taken that in his electronic cash ledger. Then no refund. Why? He'll use it. But if that excess deduction was made and paid, but the opposite person did not get in his electronic cash ledger, then you can go for refund. Refund either can be applied by the government as a deductor or can be applied by the supplier deductee. Because government would have said that, see, I have deducted extra TDS. I'll be deducting and giving you. You please make an application for refund. That is possible. That is very much possible. So when you see this entire TDS thesis, the first area was all about your registration part, which is there in your registration chapter. So I'm not touching that. It's all about your registration. Who will take registration, eco, etc. That is in your registration part. Now, if you see your entire TDS and TCS, we are done with it. There is a circular, interesting circular for TCS now. And this will make your concept of TCS more clear. What was happening in that case is T Board of India is the operator of e-auction where the trading of tea is being done. The participants are buyers, sellers and auctioners. The buyers pays to Tea Board of India, who then pays to the sellers. So it will all be routed through TBI. For sale of goods. And buyer will also pay to the auctioneer for brokerage, which means there are two things involved. There are two suppliers, by the way. One is supplier of tea and one is auctioneer. One is the actual supplier of tea who has to get the price of the tea. One is the auctioneer who is helping out the supplier of the tea to sell it. But everything is happening through Tea Board of India, which means this Tea Board of India is acting as electronic commerce operator. There are buyers. There is seller of tea and there is auctioneer of tea. All the transactions are routed through the electronic commerce operator Tea Board of India. Buyer will finally pay an amount. What Tea Board of India will do? Tea Board of India will give price to the seller and will give brokerage or commission to the auctioneer. The entire amount will be collected from the buyer. Now there are two supplies happening. One is supply of tea, which is supply of goods. One is supply of services because it is brokerage commission. And both the supplies are happening through Electronic Commerce Operator, T Board of India. Now whether TCS will be there? Yes. One or two? Two TCS. That will be two TCS. So T Board of India for the payment of price to the seller of tea, that will be TCS on the selling price of the tea. That will be Tea Board of India again collecting TCS against the auctioneer on the brokerage. On the brokerage. Right. So this circular tells that, this circular clearly tells that there will be two TCS, not TCS. Okay. TCS collection. TCS deduction, T2 TCS. Both on sale of tea against the seller of tea as well as on commission against the auctioneer. Because both the supplies, be it goods or be it services, is happening through. What are the two criteria, main criteria for your TCS to work out? Supply should be through eco. Don't you think that it is satisfied? Second, payment should be routed through. Both are satisfied. Simple. Both are satisfied. Therefore, there will be TCS both on sale of tea as well as on the brokerage of the auctioneer. Brokerage of the auctioneer. So that is explained in this particular circular. So that's everything about your GST TDS section 51 and GST TCS section 52. Basically, your IGST Act 2017, as discussed in the basics of GST, deals only with two parts. One be the first being your place of supply. To find out your place of supply and thereafter find out whether it is interstate supply or intrastate supply. And the second thing is only about distribution of IGST revenue. So if you see your provisions of IGST Act, the moment initial provisions are not relevant, the moment you talk about the main provisions, section 7, 8, 9, finally decides whether it is interstate supply or intrastate supply. 10, 11, 12, 13 read along with the special provisions. 14 will talk about your place of supply. So this portion would decide whether your supply is interstate supply or intrastate supply, thereafter deciding whether it is CGST, SGST or IGST. Then surely you have certain special aspects where they talk about international tourist, what type of transaction will be there and refund will be there, and zero rated supply. The next part of this chapter deals with your distribution of revenue. Distribution of revenue, mainly IGST revenue. Distribution of revenue, mainly it being your IGST revenue. So the first part of this chapter entirely focuses on your place of supply. Rather, even you can tell that to the extent of section 15 and section 16 in a way decides whether it is interstate supply or interstate supply. They do tell that if you are supplying to international tourists, if it is goods, it will be treated as interstate supply only. They do tell that if it is zero rated supply, that is exports and supply to special economic zone, it will be treated as only interstate supply. So, right starting from your section 7 till your section 16, it focuses only on one basic question: interstate or intrastate. Thereafter, 17, 17A, 18 and 19. If you find these four provisions, out of this, 17A is discussed when we have discussed section 53A in your payment chapter. One government to another government, transfer between cash ledger. Transfer between, if it is C to S, central will transfer to state. S to C, state will transfer to center. I to S, center again will transfer to state. If amount is transferred from IGST cash ledger to SGST cash ledger, central government will transfer to state. S to I, state government will transfer to central government. So this is already completed. Even if you see section 19, this is already seen in another chapter called as your demand and recovery, where you talk about section 77 read along with section 19, wrong determination of your liability. Wrong determination of your liability. So when you talk about your wrong determination of liability, step number 1, pay the correct tax without interest. Step number 2, take the refund of wrongly paid tax. And the time limit of refund 2 years will start from payment of the correct tax. So that part is already discussed in the other part, other chapter. So it's only basically section 17 and section 18. Now, when you talk about certain definitions, supplier by default means a person who's supplying the goods or services and includes his agent. Includes a person who's acting as his agent. But recipient basically prima facie means a person who's liable to pay consideration, not the person who's receiving, who's liable to pay the consideration. Mostly the definition of recipient is 99.99% there will be consideration except for Schedule 1 cases. So who's liable to pay the consideration includes his agent. Only in Schedule 1 cases, only in Schedule 1 cases where there is no consideration, recipient means a person to whom the goods are delivered or made available or to whom the possession of the goods are given. In simple language, who receives the goods, who finally gets the goods. For services, who finally gets the services. For goods, the person who finally gets the goods. For services, the person who finally gets the services. Why are we discussing this definition is supplier and recipient is different from your location of supplier and location of recipient. Because when we are finding out your transaction type, interstate or intrastate, two things are essential. One is location of supplier and the other is place of supply. Now, location of supplier is not exactly equal to supply. Yes, you first fix out who's the supplier, who's the recipient. Then decide what is the location of the supplier and what is the location of the recipient. Most of the sections or definitions here are taken from your section 2 of IGST Act. Obviously, when we have discussed this definitions of supplier and recipient, they have been taken from your CGST Act. Now, when you talk about location of supplier, location of recipient, they are discussed in section 2 of IGST Act. Both prima facie starts with the same angle. When you're talking about basic definition, where a supply is made or received, let us think from the angle of supplier first. The moment you understand the point of view of supplier, the same thing is for the recipient. Supplier, it will be supply, and recipient, it will be receipt. So, where the supply is made at a registered place of business, the location of that place of business. Where the supply is made at a place of business other than registered place of business, which means a fixed establishment. In simple language, a branch. Then it is location of that branch. If you read both together, they are telling that we don't give any priority. If it is made from your head office, it is the head office. If it is made from your branch, it is your branch. And what do you mean by a fixed establishment? Fixed establishment is exactly the term, nothing but branch, but we are calling it as fixed establishment. Now, what is essential for fixed establishment? A place which is not the main place of business, principal place of business, but it is having sufficient degree of permanence, which means it is a permanent place. Second, it is having sufficient human and technical resources either to supply the goods or services or to receive the goods or services. Nothing but your branch. Nothing but your branch. So, if you see the first two parts, in a simple language, it tells that it is either the principal place of business or the fixed establishment which is more directly concerned. Which is more, rather, that is exactly the next point. Where the supply is made or received from more than one establishment, be it the main place of business or a fixed establishment, be it the head office or the branch office. To whom are you going to give preference? The moment the question is about your head office or branch office, to whom are you going to give the preference? Then they tell that we are not going to give preference to your head office or your branch office. You select that establishment, whether it is a principal place of business or it is a fixed establishment, which is more directly related to that supply. Which is more directly related to that supply. Go with that. This will be a very big issue or challenge when you talk about services. A CA firm having presence in multiple locations. and the main branch say is there in Bangalore. The entire assignment is taken care by the Bangalore team except for one or two people from Coimbatore branch. Then which is more directly concerned? Bangalore. So it is talking about more directly concerned. It does not give preference to your principal place of business or place of business which is referred here, or your fixed establishment. That is, it does not give preference to either head office nor the branch office. Go with that establishment which is most or more directly concerned. Now, in absence of any such places, in a case where you don't have your head office or branch office, which at times is possible, think of an agent. He might not have any place of business. Correct? You're talking about a person who might not have any place of business. In his registration certificate, he might given his residential address. He's not having any place of business. Now, for him, what is the location of the supplier from the angle of supplier? What is the location of the recipient from the angle of the recipient? It is the usual place of residence. And that is exactly what you will be giving at the time of taking registration. At the time of taking, this becomes more important from the angle of location of recipient. Recipient may not be registered. See, from the angle of supplier, it is not a big challenge. But from the angle of recipient, when you are supplying some services to a recipient, where you find that the recipient is not having any head office nor any branch office, neither place of business nor a fixed establishment. You have to find out place of supply, which in one of the formula tells that it is location of recipient. So you have to find out where is our location of recipient. So he is not having an establishment. So what to do? It is the usual place of residence. Usual place of residence. So that is the definition of location of supplier of the service as well as location of recipient of the service. This difficulty will come only when you are talking about service. You won't find this difficulty when you are talking about your goods. Correct? For goods, this difficulty will not be there. Where is the location of supplier of goods, from where the goods are starting the movement, or under whose control the goods are starting the movement? What is the location of recipient of goods? Where mainly the destination of goods is there, where or otherwise who's controlling where the goods should finally go. Which means I am the supplier from Tamil Nadu, but the goods are moving from Kerala. The recipient is located in Maharashtra. He is asking the goods to be dispatched to Delhi. Where is the location of supplier of goods? Tamil Nadu or Kerala? No, it is Tamil Nadu. Supplier. Movement is instructed from Tamil Nadu starting from Kerala. Location of supplier of goods is Tamil Nadu. Right, he will be going with bill from, dispatch from. Bill from, dispatch from. Obviously, we are not talking about the other person. There will be place, location of supply and place of supply even for the person in Kerala. Forget about it. Talk about my transaction. Each of the transaction will have a separate location of supplier and place of supply. From angle of the person in Tamil Nadu, where is the location of supplier? Tamil Nadu. Where is the location of recipient? The goods are given to which customer? The customer is located where? In our example, where we fix the customer? We fix the customer in Delhi, but the goods are going to Maharashtra. We fix the customer at Delhi, but the goods are going to Maharashtra. So where is the location of the recipient? Location of recipient is Delhi, not the destination. The control. Why I am sending the goods to Maharashtra, by the way? Because my customer sitting in Delhi tells me that please dispatch the goods at so and so address. I am not dispatching on my own. He is instructing me. So where is the location of the recipient of goods? Delhi. For this transaction, I am not talking about the other transaction between Kerala person and Tamil Nadu person or Delhi person and Maharashtra. For this transaction, supplier, location of supplier of goods is Tamil Nadu and location of recipient of goods is Delhi. It will be nothing but bill to, ship to, bill to Delhi, ship to Maharashtra. Rather, it will be a combination of both. Bill from, dispatch from, bill to, ship to. Bill from Tamil Nadu, dispatch from Kerala. Location of supplier of goods is Tamil Nadu. Bill to Delhi, ship to Maharashtra. Location of recipient of goods is Delhi. This difficulty, this is the highest complicated level that you can have in goods. Even there it can be easily addressed. Therefore, they have not said anything about location of supplier of goods and location of supplier of recipient of goods. What is the fixed establishment that we have discussed? Now, they talk about distinct person. What do you mean by establishment? Explanation to section 8 of IGST Act. Establishment. In simple language, they are talking about distinct persons. They are talking about distinct person that you had in your CGST Act. This is an extended version of distinct person. This is an extended version of distinct person. Now, it talks about an establishment in India or outside India, in one state or other state, in a state or other establishment registered in the same state. What is the extended point that they have said? That establishment can be in India or outside India. See, in your IGST Act, they will start talking about even places outside India. The second and third point was already discussed in your CGST Act when we discussed distinct person. Persons having separate GST number normally in different states, which is the second point. At times it can be even the same state if you opted for multiple registration in the same state. If you opted for multiple registration in the same state. What is an extended extra point given here? It includes an establishment of branch in India as well as outside India. They will be treated as establishment of the same person. Establishment of the distinct person. Establishment of the distinct person. And whenever you are working through any branch or agency or representation offices, that shall be treated as an establishment. They are trying to tell that whether you call it as a branch or agency or your representation office, it will be treated as an establishment. Now, this becomes very important, very, very important when you talk about your export of services. Because for export of services, one of the criteria is the transaction should not be between establishments of the same distinct person. It will not be treated as export. Right? It is an extended version of distinct person that you had in your CGST Act. Now, in explanation to section 8 of IGST Act, they are clarifying that establishment of distinct person will also include branches or agency or representation office, one in India and one outside India. One in India and one outside. All the definitions that we are discussing here basically are from section 2 of IGST Act. But this is given an explanation to section 8 of IGST Act. Now, what is export of goods? What is export of import of goods? What is export of services? What is import of services? Export of goods is taken from your Customs Act. Export of goods means taking goods outside India to a place outside India. Copy from your Customs Act. Export of services means, import of goods means bringing goods into India from a place outside India. Goods part. Export means taking from India physically to a place outside India. Import means bringing from outside India physically the goods should come in India. That is export and import of goods. What is import of services and export of services? Import of services has got three criteria. One, the location of supply should be outside India. Place of supply should be India. And location of recipient should be India. India. From outside to India. So, supplier, LOS, outside India. LOR, in India. POS, in India. Only when all these three conditions are satisfied, it will be called as import of services. Import of services, which will attract RCM. Generally, which will attract RCM. Most of the times, there are exceptions, but generally, which will attract RCM. What is export of services? Exactly ulta of that, but with an additional points. Right? Exactly ulta. Export means from India to outside India. So, location of supply should be India. Location of recipient and place of supply should be outside India. Then they suddenly tell us, no, we are interested also in forex. So, payment should be made in convertible foreign currency. If permitted by RBI, only in that case, Indian rupees. If permitted by RBI with certain countries where it is permitting, say Nepal, Bhutan and all, then you can bring in INR. Otherwise, it should be in convertible foreign currency. And the last point that we were discussing some time back, the transaction should not be between establishments of a distinct person, that we have just discussed in terms of your explanation to section 8 of IGST Act. It should not be between branches of the same company. But for import, this one point is not there. Import, even with the transaction is between establishment of distinct person, it will be still treated as import. Import is all about government getting the revenue. Therefore, they don't put this condition. Last two condition. Export is all about refunds, zero rating, which means government will give you something. Therefore, you find these two extra conditions, which is not there in your import of services. And finally, when you see place of supply, you will find a term called as intermediary. Intermediary is nothing but a broker. They will try to tell that you may call it as a broker, agent, etc., who arranges or facilitates a supply of goods or services between two parties. Right? Why we are discussing this definition, particular definition? Because in place of supply, you will be finding a term called as intermediary. Now, intermediary, they are very clear that it will not include a person who is directly supplying goods or services on his own account. For example, you are in fact acting as an intermediary, but you are invoicing on your own account. You are invoicing on your own account. A tour operator, most of the times he acts as intermediary, but he might decide to tell that no, I will take the services of all the, say, hotel or food or say guide, but finally I will be billing to the customer, the person who is going for a trip. He is billing on his own account. He will tell that I will be charging entire amount. I will be charging this entire amount. I will not be giving the payment. All the apps, Make My Trip, etc. Do you think technically they are intermediary? Not technically. Common parlance, they are intermediary. If you understand by common parlance, you will think them as intermediary. But technically, they might not be intermediary because they are invoicing on their own account. They are invoicing on their, they are not telling that, see, this is the charges that you have to pay to hotel and this is our service charges. They are not giving that breakup. Right? So, technically, they might not be intermediary in most of the cases. And that was only an example. You can apply it for all the types of intermediaries, whether it is for facilitating supply of goods or whether it is for facilitating supply of services. To put it in a simple language, the special agent that we have discussed in Schedule 1 is not intermediary. The special agent that we discussed in Schedule 1 is not. Why? He is having the authority to raise invoice under his own name. Obviously, he is not called as an intermediary. Right? Now, before seeing all the provisions of your section 10, 11, 12, 13, which talks about place of supply. Now, one thing is very clear that you have to find out two things: location of supplier and place of supply. Location of supplier, location of recipient, we already discussed in the definition. Right? Now, the focus will be entirely on your place of supply. You have freeze location of supplier. The focus will be entirely on place of supply. Now, before taking a place of supply, what does your section 7, 8 and section 9 clarify? Section 7, 8 will define something. Section 9 will clarify. Now, section 7 and 8 will tell that which is interstate supply and which is intrastate supply. This we have discussed long back when we have started our marathon session, when we talk about the first or second chapter. What is interstate supply and what is intrastate supply? What was understanding that? In which case it was intrastate supply? If at all you are talking about a scenario where location of supplier and place of supply is in the same state, then it is intrastate supply. Then it is intrastate supply. Correct? And that's why I said that all the scenarios will be treated as interstate supply. In this situation, it is treated as intrastate supply. When LOS, POS, same state, same union territory, it is intrastate. LOS, POS, different states, union territory, it is interstate. That is when both LOS and POS are in India. Now, what about the exceptions? In all other cases, you will find interstate supply. All other cases, the answer is very clear. In all other cases, it is interstate supply. By default, it is interstate supply. If at all you are talking about import of goods. till they are reaching the customs border of India? Interstate supply. If at all you are talking about import of services, interstate supply. Interstate supply. Place of supply will be there in India, because we have discussed that for import of services, place of supply should be three conditions: LOS outside, POS in India, and LOR in India. So here we are required to first find POS, then decide that it is import, then decide it is interstate supply. Now, if at all I tell that supplier of goods and services is in India and place of supply is outside India. Supplier of goods or services is in India and place of supply is outside India. The moment I tell this, I need to find out your place of supply. I have to find out. Only then I will decide that the place of supply is outside India. In that scenario, you need to understand that it is interstate supply, but not necessarily exports. Not necessarily exports. Just think of the scenario. LOS, India, POS, outside India, LOR, outside India, but you don't get foreign currency. It is still interstate supply, but it is not export of services. It is still interstate supply, but it is not export of services. So here also, first you are required to find place of supply. It will be interstate supply. It is not necessary that supplier is in India, POS is outside India. Therefore, you decide and conclude that it is export. No, it may be export, it may not be export. If at all it is export, there will be zero rating. If at all it is export, there will be zero rating. Next, the transaction can be to special economic zone or by special economic zone. The moment you purchase from SEZ or sell to SEZ, it is interstate supply. Long back we have discussed, it is interstate supply. Now carefully look here. You are not required to find out place of supply. Do you find place of supply point there? You are not required to find place of supply in this case. You see, in few places, I am circling place of supply to tell you that there you are required to find out place of supply. In the first case, I did not circle. When it is import of goods from up to customs border of India, by default it is, you are not required to find any place of supply. Likewise, when you are supplying to SEZ or when you are purchasing from SEZ, by default it is interstate supply. You are not even required to see your place of supply provisions. It is interstate supply. It happens to be interstate supply, but whether zero rating will be there always? No. If it is by SEZ, no. But if it is to SEZ, there will be zero rating. Your entire taxes in India will be given back to you. You don't have to pay output tax. Your input tax credit will still be there, and that also will be refunded back to you. Now, supply of goods to a tourist as given in section 15. Supply of goods to a tourist as given in section 15. Again, there it is by default that the moment you are supplying a goods to an international tourist. What is meant by international tourist? What is meant by international tourist? A person who is coming to India for legitimate non-immigrant purposes and his stay in India is less than 6 months. Two conditions: legitimate non-immigrant purposes and his stay in India is less than 6 months. Then he is an international tourist. If you are supplying goods to him, you have to always charge IGST. You have to always charge. You are not required to find place of supply. You are not required to find. It will be by default. It will be by default interstate supply. Why? You will be charging IGST to the international tourist. And when the international tourist is going outside, back to his own country, outside India, back to his own country, he will show the invoice along with the goods that he has purchased, and he will get the refund of IGST. Not the price, get the refund of IGST portion. Get the refund of IGST portion, so that when the goods are going outside India, they are tax free. When the goods are going outside India, they are, technically it was not export, because physically you did not send the goods outside India. You gave the goods to a person who was standing in front of you in your shop. So technically it is not export. Still you charge IGST, so that the tourist when he is leaving India, he show the copy of invoice, show the goods. Goods should not be used in India. If goods are used in India, finished. Refund will not be given. Tax will be IGST, but refund will not be given. So there are two steps. First, what tax to be charged? IGST. Second, whether refund will be there or not, it depends. If the goods are not used, still intact, and invoice is there when the international tourist is leaving India, he can show the copy of invoice and the goods physically, which is not yet consumed in India, and take the refund of IGST portion. So refund may be there, may not be there. But do you find out place of supply here? By the way, you find out place of supply here. You don't find out any place of supply here. You are not required to find out any place of supply here. Directly it is interstate supply. So what we have discussed now is this special provision where it is applicable only for supply of goods. Where it is applicable only and only for supply of goods when international tourists. Supply of goods when international tourists. And it is clearly mentioned that when he is leaving India, it will be refunded as per your refund chapter, subject to the conditions that I have said. Show the invoice so that the goods are not consumed in India, you get the refund. There are two things. IGST will be charged per se. You may or may not get the refund when you are leaving India. If you show the invoice and the goods which are intact, you will get the refund. You will get the, that's everything about your section 15 per se. That's all. So section 15, which is referred there, by default, it is IGST. Do you find out place of supply there? No. You're not required to find out place of supply. But yes, when the supply is happening within India, when the location of supplier and place of supply are within India, when the location of supplier and place of supply are within, there obviously you are required to find place of supply. Obviously you are required to find. So you see a few cases where you never touched place of supply, but you decided that it is interstate supply. Be it SEZ, be it international tourist, or be it import of goods, you decided that it is interstate supply. Now finally, if your transaction is not covered anywhere, supply made in a taxable territory, but you are not able to find out whether it is interstate supply or intrastate supply. Possible. You are not in a situation to find. You are not covered in any of the situation. If you are not able to find anything, it will be treated as interstate supply. You are not even able to find out place of supply. Here you are not required to find out place of supply because you are not in a position to find. You are not in a position to find. One of the classic example which is discussed in your RCM, which can be taken as the classic example for this. There are other examples as well. But this is a classic example when you talk about security lending scheme. Security lending scheme which is covered under your RCM. Lender and borrower will not know. I may be the lender and Praveen sir may be the borrower. We may meet each other daily, but we will not know that I am the lender of Shaz and he is the borrower of Shaz. So it is not at all possible to find out place of supply. By the way, it is supply of service. I am getting the lending charges via the stock exchange. Correct? Now, is it possible to find out place of supply in that case? Not possible. I will not know the recipient. Forget about the location of recipient. Technically, Praveen is the recipient, but I don't know he is the recipient. I cannot find out location of recipient. What is the answer? IGST. What is the answer? IGST. When you are not in a position to find out anything, take the answer as IGST. So there are places where by default the answer is IGST. In other places you have to find out place of supply, then it may be IGST again by default, or it may be CGST, SGST. So in this entire case, there is only one place where it is CGST, SGST, which is highlighted in your yellow shade. This is the only place which is CGST, SGST. All other cases are that of IGST. Now, actually section 7 and section 8 are more than sufficient. There was no need of section 9. It acts as a clarification. They tell that if at all your location of supplier or place of supply is in a territorial water. So what to do? Take the nearest point. See which state is the nearest. That would be the location of supplier, or that would be the place of supply. If your LOS or POS is there in sea, now that sea level will be, you can take the nearest point to 2 or 3 different states, compare which is nearest, that would be the state. So that is only a clarification. That is mere clarification given in section 9. Right. So this gives you a picture. So what we have understood? We have understood when it is interstate, when it is intrastate, for which we require at times LOS and POS. At times. There are cases where we don't require, we finally decide that it is interstate. But at times we require LOS and POS. Now, the next part is when we require that POS, LOS we have discussed. What is LOS? When we require POS, in that cases, wherever I have said that you need to find out place of supply. In certain cases, I have said that you are required to find out place of supply. There only you are going to see section 10, 11, 12, 13. Otherwise, in the other cases where you are not at all required to find out place of supply, by default the answer will be interstate supply. So at times, not always. So if someone asks you where to decide whether it is interstate supply or intrastate supply, whether section 10, 11, 12, 13 is mandatory. No. There are certain scenarios where you don't need, there is no requirement for you to touch 10, 11, 12, 13 right along section 14. By default, it will be IGST transaction. I need not go there and validate whether it is CGST, SGST transaction or IGST transaction. Now, when you require to see your section 10, 11, 12, 13, then we are talking about it. 10, 11 deals with goods, 12, 13, right along with 14 deals with services. The same thing that is given in your QR infographics. I have just given a comparative analysis. Comparative analysis so that it is easy to recollect. Both your QR infographics will be giving only the summary points, but this is the comparative analysis. Now, when you talk about section 10 and section 11, now the entire focus is only on finding out place of supply. Whether you will be using POS in all cases, no. Where required, you are going to find out place of supply. There are certain cases where you don't require place of supply. Directly you will give the answer as IGST. If at all it is required, then you will evaluate LOS and POS. LOS we have already discussed what is LOS. Now we are trying to find out POS. When you talk about goods, categorize goods into two parts. One, other than import and export of goods, section 10. Second, import and export of goods, section 11. One is, if at all it is goods movement, which is physically not going outside India, physically not coming inside India, moving within India, you will resort to section 10. If it is physically going outside India, physically coming in India, which means technically export and import, you will resort to section 11. Section 11 is very simple. If at all it is physically coming in India, import of goods, place of supplies, location of importer, not location of the customs port where it is coming. I may be sitting in Coimbatore. I may import the goods at, say, Visakhapatnam port, or say a port which is not there in Tamil Nadu. Right? I may be importing goods. I may be importing goods at Mumbai port. At Mumbai port. Where is the place of supply? Mumbai or Coimbatore? Coimbatore. So place of supply is location of importer for import of goods, that is Tamil Nadu. What if I am talking about export of goods? Export of goods, they tell in a very loose language, telling that place of supply is location outside India. Location, they are not very specific. They tell that it is location, you take any location, we are not worried. Why? Anyways, it is zero rated, anyways we are going to refund you. So we are not worried, it is location outside India. But technically speaking, when the goods are going from say India to USA, your place of supply is USA. They tell that it is location outside India. So for import of goods, it is location of importer, not where the place where it is imported. And for export, it is location outside India. That is for import of goods and export of goods in terms of section 11. Now what about the goods moving within India? Moving within India. If at all there is supply of goods which involves movement of goods, whether that movement is caused by the supplier, recipient or any other person. I can ask some other person to start movement on my behalf. Example we have discussed. I may be in Tamil Nadu, but I can ask my Kerala job worker or Kerala supplier. He may be anyone. He may not be my supplier. He may be my job worker. I may ask him to start the movement. I may ask him to start the movement. Now, in that case, where is the place of supply? Place of supply is the location of goods at the time where the movement of the goods terminates. Where the movement of the goods terminates. Right. Now, you may wonder in our example where movement is instructed from Tamil Nadu and it is starting from Kerala. It is to go to Delhi, but final destination is Maharashtra. The answer will not be Maharashtra. Why? Then you have to read both these provisions together. The second provisions also. Section 10.1a read along with section 10.1b. Now read section 10.1b, then you'll have more clarity. Goods are delivered to a recipient or any other person by supplier on instruction of the third person. On instruction of the third person, whether as agent or own account, before or during the movement, which means it happens during the movement, not when the termination is there. Whether or not there is transfer of title. It may be a scenario where title may be transferred, there may be a second supply, or title may not be transferred, there may not be any second supply. It may happen that the Delhi customer of mine has asked me to send the goods to Maharashtra, not because he is selling to Maharashtra, but because he is having a job worker in Maharashtra. Title may be transferred, title may not be transferred. In that case, place of supply is the principal place of the business of the third person. Principal place of the business of the... Now, there is a problem with this provision. They use the terms interchangeably. This third person is technically the recipient for me. This third person is technically the recipient for me. Technically he is the recipient, not the third person. Right? The person whom they are calling it as recipient is not my recipient. I don't know who is he. I don't know what the name of the person who's sitting in Maharashtra. So there's a technical error in the wordings, drafting of place of supply is all fine. But the technical error is in the wordings. So in our example, when I am sending the goods to a person sitting in Delhi, but on his behalf, the goods are finally destined to Maharashtra. Where is the place of supply for me and the person in Delhi? Where is the place of supply? What is the place of supply answer? It is principal place of the business of third person, which is my recipient. Who's my recipient? Person sitting in Delhi. Now, where is the principal place of supply of the person sitting in Delhi? It is Delhi. It is Delhi. So, for a goods which is moving from Tamil Nadu, the customer is in Delhi. He is asking me to dispatch at. I may send the goods from Kerala. Let us forget that point for the time being, but I can do that. Right. Location of supplier is Tamil Nadu. Place of supply is principal place of business of the third person. Third person is actually the recipient for me. For transaction 1, location of supplier is Tamil Nadu. Place of supply is Delhi. Now, for transaction 2, it might happen, not always, it might happen that the goods are in fact going to Maharashtra. This is the movement. This is supply 1. It might happen there is supply 2. It might happen. When it is supply 2, you go by section 10.1a, where the movement of the goods terminates. Now, for the second transaction, assuming that it is a supply, location of supplier happens to be in Delhi. Place of supply happens to be Maharashtra. Here you are applying section 10.1a. Here you are applying section 10.1b. This transaction for surely answer will be in 10.1b. The second part of the transaction may not always be supply. It may be supply. If it is supply, apply section 10.1a. It may not be supply. It may happen that the person in Maharashtra is not the customer of Delhi. He may be job worker of Delhi. In that case, there will be no supply of goods between the Delhi person and the Maharashtra person. Clear? There may be supply in the second transaction. There may not be supply. It is not necessary that the second transaction will always result in supply. The second transaction may be supply, may not be supply. First transaction is surely supply. Second transaction may be supply, may not be supply. If the person sitting in Maharashtra is job worker of the Delhi person, there is no supply of goods between Delhi and Maharashtra. Yes, there is supply of service, that is job working service, that is a different part. But there is no supply of goods between Delhi and Maharashtra. So that is section 10(1)(a) and 10(1)(b), which has to be read together. That will happen in case of bill to ship to transaction, which we have discussed in the section 10(1)(b). Now what is section 10(1)(c)? In both the cases, there was movement of goods. There was movement of goods. In the very 99%, it will be section 10(1)(a) because there is only one movement, clear cut movement. I am selling you the goods, movement is happening to you. Place of supply is where the movement of the goods terminates. Only when it is via bill to ship to, you are going to read 10(1)(b) if required along with 10(1)(a). 10(1)(b) surely you will read. If required, if the other transaction is also supply, you will also read 10(1)(a). Now what is the third case? Where there is supply but no movement. Where there is supply but no movement. Is it possible that there is supply of goods but no movement? Highly possible. I have given you the goods on rent. I have given you the machinery on rent for 10 years. It is not supply of goods, it is supply of services. We are going to see section 12, section 13. Right? Suddenly after 10 years, I give you the ownership. I tell that, okay, you purchase it. Now, after 10 years, there is transfer of ownership, that is supply of goods, but there is no movement of goods. Machinery is already with you. Machinery is already with you. What is the place of supply? Location of goods at the time of delivery, which means constructive delivery. Where the constructive delivery, the ownership was handed over, which means technically where the machinery is there. So if at all I am in Tamil Nadu, you are in Maharashtra, I gave you the machinery on lease for first 10 years. It was a supply of service where you are going to evaluate section 12, section 13 for place of supply. After the end of 10 years, I said that, okay, I am selling you the machinery, you keep the machinery. Now only there is supply of goods. Now what is the place of supply? Location of goods at the time of constructive delivery to the recipient. Where is the machinery located? Maharashtra. So place of supply will be Maharashtra. I am handing over the ownership to you when the goods are there in Maharashtra. Constructive delivery. Constructive delivery. Next, where the goods are assembled or installed at site. Supply of goods where they are assembled or installed at site. Big projects, big plant and machinery, this provision will be applicable where, because the final goods are assembled or installed at the site. We are not talking about installation services, by the way. If it is installation services, we are not seeing section 10. We are going to see section 12, section 13, depending on what is applicable. So this we are talking about supply of goods where the assembling or installation will be at site. Then what should be the place of supply? Where the assembling is happening or installation is happening. Now understand that I may be a supplier in Tamil Nadu, you may be a customer in Maharashtra. You are asking me to assemble a big plant and machinery which I am sending in installments at West Bengal. At West Bengal. Where is the place of supply? West Bengal. It is better that the customer gets registration even in West Bengal. And obviously he has to get a registration in West Bengal. Please understand that if he is doing a business, he is having a place of business even in West Bengal, because the machinery is going to be assembled or installed at West Bengal. Right? I am not going to take place of supply as Maharashtra because I got the order from Maharashtra. My place of supply will be West Bengal. You know, government projects, this issue is very common. Right? You've practically seen cases where one department of the government will tell that, supposing the customer is the government, they'll tell that no, you put place of supply as Maharashtra because we gave you the order. If you put place of supply as West Bengal. Technically, I should put as West Bengal. We will not get the revenue. We will not get the revenue. The project started at our instruction. So finally, if you put place of supply as West Bengal, we may not get the revenue. Maharashtra is not going to get any revenue. So from government point of view, no, please try to put POS as Maharashtra. Technically, which is not right. It should be West Bengal. See, at times, there will be cases where there will be no requirement of this recipient to get registered at site. Supposing I am a person who is putting electrical posts everywhere, right? So this person in Maharashtra will not be required to get any registration in other places, right? But still, as a supplier, technically I am going to put place of supply as the place where the post is assembled or installed. This particular person is losing the revenue. This state is losing the revenue. I think I have been telling right from the time when 2017 GST started, wait for 10-15 years. You will see state versus state fight, central versus state fight. Time is yet to come. It will come surely. When you see that cases, you will surely remember that it was said right from the beginning that this will happen. It's only a matter of time that it is going to come up. These are all cases. They are trying to tell, why are you worried? You put IGST. Anyways, it is IGST. You don't put POS as West Bengal. You put POS as Maharashtra. Technically, you are not doing any error. It is IGST only. But technically, there is an error. The revenue is going to a different state because part will be kept with central government, part will be given to the destination state. So, I am technically making some mistake. I am allowing government to fight between themselves. So, this issue will be there. Next, section 10(1)(e), where the goods are supplied on board a conveyance, which means supposing you are traveling by airline, very common in airline, very common in airline, that they have nowadays started selling all the goods, right? You can get your pillow or watches, etc., right? Where is the place of supply? Place of supply is the location at which the goods are taken on board. It does not mean if an airline company decides to take 100 watches inside the airplane, supply is not of 100 watches. Supply is not of 100 watches. Supply is only of 1 or 2 watches which are being sold. Only of those 1 or 2 watches which are being sold. So, only for those 1 or 2 watches, your place of supply will be the location where the watches were taken on board, the starting point. The starting point. This is place of supply. Then you have obviously compare it with location of supply. Decide whether it is CS or I. That's all about your section 10 and section 11 when you talk about your goods. Section 10, 5 scenarios for goods when the movement is within India. Section 11, only 2 scenarios, either physically coming in India, import of goods, or physically going outside India, export of goods. Now you are talking about your place of supply for services. It is either section 12 or section 13. When is section 12 applicable? Section 12 is applicable only if both LOS and LOR, both the location of supplier and location of recipient is in India. Then you find out place of supply in terms of section 12. If either location of supplier or location of recipient is outside India, you go with section 13. If both LOS and LOR in India, go with section 12. If LOS is outside India or LOR is outside India, find out place of supply in terms of section 13. In terms of section 13. Now, what we have done is, if you see section 12, section 13, you will have different categories and you might not be able to compare that for a particular service, what is the treatment in section 12 and what is the treatment in section. So, this comparative analysis will give you what will happen for particular services. If a particular service is not covered anywhere, residuary category. So, let us compare 12 and 13. Keep one thing in mind when you see 12, LOS plus LOR in India. When you see section 13, LOS or LOS, LOR, LOS or LOR is outside India. Either LOS or LOR is outside India. So, keep that in mind, then start comparing. What is the residuary provision? Residuary provision means if at all it is not covered anywhere in section 12, then your place of supply for B2B transaction is the location of recipient. Your place of supply for B2C transaction is actual address of the records of the recipient. Whatever is the address on records available of the recipient, address of the recipient. If you don't have address of the recipient, then place of supply will become location of supplier. See, B2B, surely you will know who is the recipient, where he is located. So go with location of recipient. B2C, initially try to go with location of recipient, whatever address is available on records. But if you don't have address, you don't have an option. B2C is very common. You might not have address. Then what to do? Your own location. Location of supplier is place of supply. Location of supplier is place of supply, which means by default it will become, the chances of it becoming IGST will be not there. It will be only CGST, SGST. Right. I have given certain examples where it will be covered. Say for example, your CA, CWA, CS, advocate services, management consultancy services, software services. All these services will be covered in the residuary provisions because you don't find them being specifically covered anywhere in section 12. What if it is a residuary category in section 13? Not covered anywhere in section 13. What you are required to do? Your place of supply is location of recipient. Understand that in section 13, make one thing clear. Section 12 will try most of the times to give answer based on two scenarios. B2B, B2C. B2B, B2C. B2B, B2C. Section 13 will not do that efforts, will not take that efforts. Section 13, either LOS or LOR is outside India. It will not take that efforts to segregate the transaction between B2B and B2C. It will try to give a simple answer. So it is location of recipient. But if location of recipient is not available in ordinary course of business, which means you don't have his address on records in simple language, then go with location of supplier. Prima facie, you find the answer same if you see the second part of the transaction. The first part of the transaction was B2B, location of recipient. B2C, indirectly it was location of recipient. When you talk about address on records of the recipient is nothing but location of recipient. If not available, go with LOS. You'll find it is very similar to that. The only thing is they don't try to segregate that into B2B and B2C. Now, if you see the examples, it will cover your CA, CS, CMA, advocate services, management consultancy services, software services, but it will not cover intermediary services. Here, it covers also intermediary services, job working services, OIDI services. Here, it will not cover these services because in section 13, specifically for intermediary services, there is a separate formula. Specifically for your intermediary services or your real estate agent services or OIDR services, there is a separate formula which was not there in section 12. When giving the examples, I am trying to differentiate. Residuary services in section 12 is not always equal to residuary services in section 13. In section 13, there are certain services which I have given in examples. Be it intermediary services, be it job working services, be it OIDR services. For them, there is a special formula in section 13, which is not there in section 12. So, in terms of examples, it is discussed here. So, when we see all these three specific services, you'll have more clarity. Second category. Now, we are talking about specific categories. Now, we'll be comparing. We are talking about specific categories. Immobile property related services, boat or vessel related services. Immobile property related services, boat or vessel related services. If it is section 12, if a service is directly in relation to immobile property, and they give the example, architect services, interior decorated services, expert services, estate agent services, grant of right to use immobile property is nothing but renting of immobile property or leasing of immobile property, construction services. These are only examples. They are all directly in relation to immobile property, starting from architect, interior decorator, estate agent services, expert services, including surveyor, expert services, renting of immobile property, leasing of immobile property, construction services. Then they talk about your lodging or accommodation services, including houseboat or vessel. Initially, it was all about immobile property. Now, when it talks about lodging and accommodation services not only at immovable property but also at houseboat or vessel, or accommodation services for organizing various functions and ancillary services that too. What is meant by ancillary services? Related services. If that is a service, and our ancillary services may also include event management services for that particular place. For in that scenario, your location of immovable property, if it is in India, then place of supply is location of immovable property. If your location of immovable property is in India, your place of supply is location of immovable property. If location of immovable property is outside India, government does not want to lose the revenue. So place of supply is location of recipient. Understand that when we are seeing section 12, both LOS and LO are in India. Both LOS and LO are in India. So what they tell? If the immovable property, obviously when they talk about vessel and houseboat, they are in India. So they are very specifically to immovable property, because you may go for a trip where immovable property may not be in India. So if immovable property is in India, then what they tell? No worries. We'll go with location of immovable property. But if it is not there in India, then we will not tell it is outside India. We want place of supply in India. Then they focus on location of recipient. Now it might be a case where you get multiple answers. Now start getting multiple answers. There are scenarios where you want to get multiple answers. I am going for a trip, a combo package trip where my stay will be in 3 different states. Right, I am going to a trip for say Himachal Pradesh, Jammu and Kashmir and Sikkim. Or say Himachal Pradesh, Jammu and Kashmir and Uttarakhand. Maybe geographically they are nearby. I am trying to go for a trip in all these 3 places through one person. Now it is an accommodation service. Accommodation service directly related to immovable property, but and both LOS and LO are in India. Immovable property is also in India, but in 3 different places. The moment you get that, if your place of supply is in multiple states or union territory, then you will be trying to get multiple answers. You are going to try to apply rules. Place of supply each of that state or union territory in proportion to the value of the service of as per the contract. If the contract clearly bifurcates the value, no worries. It tells that for stay in Jammu and Kashmir, this is the value. Stay in Himachal Pradesh, this is the value. Stay in Uttarakhand, this is the value. No worries. I'll go as per the contract. If it is not telling, I have to go as per rule 4. We'll see rule finally. I'll get multiple answers. I have to go as per rule 4. But if the contract is very clear, I need not even touch rule 4. The contract tells us this is the value for Jammu and Kashmir accommodation. This is the value for Himachal Pradesh accommodation. This is the value for your Uttarakhand accommodation. I need not worry. Now, if you see correspondingly section 13. Now, what you have to understand, either the location of supplier is outside India or the location of recipient is in India. Understand this way. Either the immovable property is outside India. You are going for a foreign trip. Recipient is of India, but you're talking about supplier outside India, or ulta, property is in India, but a foreign tourist is coming. So either LOS or LOR is outside India. Section 13 will be touched. Again, they start with the same kind of language. Services directly in relation to immovable property. Examples, architect, interior decorator, same set of examples. Right. Here, the place of supply will be location of immovable property. No ifs and buts. There are 2 bifurcations. If immovable property is in India, then it is location of immovable property. If immovable property is not there in India, then it is location of recipient. See, location of supply should be a last resort. Why they told location of recipient? But because they know that recipient is in India. Only then you are going to apply section 12, because both LOS and LO are in India. But here they are very, 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 very clear. They are telling that no worries. We'll go with location of immovable property. See, in section 13, there's a possibility of export of services. So they have to draft section 13 accordingly. So they tell that it is location of, there's a possibility. It's not always export of services. There's a possibility of export of services. So it is location of immovable property. Again, if you see one clear-cut difference, in 12, in addition to immovable property, they also talk about houseboat and vessel. Whereas in section 13, they focus only on immovable property. And here also, there's a possibility that you get multiple location. Now look at the way they tell. If multiple location is such that few immovable properties in India and few is outside India, then they tell that we will treat that everything is in India. First they make it very clear. If you get multiple answers, where few answers is outside India, you are going for a trip where a particular property in the entire package, few properties will be touching outside India, few properties will be touching in India. Then they tell that forget about properties outside India, then we'll treat it as place of supply as location in taxable territory. We'll forget about the immovable property outside India. Supposing you're staying 3 days in an immovable property in India, 10 days in an immovable property outside India in the same package. You're not talking about two separate packages. In the same package, they'll forget about outside India. Place of supply is location in taxable territory. Location in, which means they want to make it fully in India. They don't have any intention to lose the revenue. Lose the revenue. So they clearly tell that we are not ready for pro rata if it is between India and outside India. Yes, if within India you have multiple answers. There are two steps. If within India you have got multiple answers, then we are ready. Then you can go as per the contract value or go as per Rule 8. Rule 8 will again give reference to Rule 4. Rule 8 will again give reference to Rule 4. Look at the irony. They talk in two steps. First step is very clear for them. If you get multiple answers, part in India, part outside India, forget about outside India. Focus only on India. Within India, if you get multiple answers, split as per contract value. If the contract is very clear, split as per contract value. So POs for one contract value will be one state, another contract value will be other state. Split the contract value. So for one part of the value will be one state, another part of the value it will be other state. But if the contract is not, the contract value cannot be split because it was not specifically mentioned in the contract. Then go as per Rule 8. But don't worry, Rule 8 will again give reference to your Rule 4. So the formula is the same. That is for your immovable property, boat or vessel. Boat or vessel was touched only in your section 12, not in section 13. Next is a scenario where you're talking about performance-based services. Now, what is performance-based services? You're going to perform something on the goods or on the person, individual. On the goods or on the individual. So, when you're talking about performance-based services, they do in section 12, they do specially mention in two different places. Now, one type of performance-based services is your restaurant, outdoor catering, personal grooming, fitness, beauty treatment, health services, including cosmetic and plastic surgery. If you look at all these performance-based services, performance is on the individual. Performance is on the individual. In such cases, they tell that the place of supply is the place of performance. Place of supply is the place of performance. There is a possibility that you get multiple answers, but law does not tells what will happen if at all there is a multiple answer. It is silent. That's a possibility. Same simple example. Your friend's wedding is going to be there. That's a person who is going to take care of his grooming. Correct? And his wedding is there. I mean, a part of the events of your friend's wedding is there in Tamil Nadu and part of the events. The main functions are there in Maharashtra. Don't you think that performance happened in Tamil Nadu as well as Maharashtra? Clearly. But law is silent about it. Law is silent about it. Right? So, it is a possibility because part performance of that grooming happened in Tamil Nadu and part performance happened in Maharashtra. Law is silent about it. But wait, in section 12, this performance-based services is split in multiple parts. This is the first part. The second part, they talk about training and performance appraisal services, which is again on individual. Giving trainings to, say, employees of a particular company. There, they tell, if it is B2B category, place of supply is location of recipient. If it is B2C, place of supply is place of performance. A company wants to give soft skill training to its employees. And while going on a vacation, they are trying to merge both. Normally that happens, vacation plus training. Right? The company is of Tamil Nadu, but the vacation is in, say, Goa. If it is B2B, place of supply is Tamil Nadu. But if it is B2C, Place of supply is Goa. Don't you think that it can happen that the training can happen in multiple places? There's a long vacation come training. It's highly possible. Part of that happened in Goa and part of that happened in Maharashtra. As far as it is B2B, you don't have an issue. Place of supply still remains Tamil Nadu. But if it is B2C, your performance happened in the soft skill trainer came with the team in Goa as well as he went with the team in Maharashtra. So the answer should be Goa and Maharashtra. Unfortunately, law is silent if the place of supply is in multiple states and union territory. There is one more performance based category, other performance based. Any other performance, by the way, any other performance is covered in residuary category. Any other performance is covered in residuary. When I tell residuary category, I am not going to tell the answer again because we started with residuary category. If it is B2B, location of recipient. If it is B2C, address of recipient on records. If not available, then it is location of supplier. And for that reason, for that particular reason, you had an example of job work services. For that particular reason, you had an example of job work services here. But you did not have that example corresponding in section 13, you'll understand now. Job work services nothing but performing on goods. If you see section 12, they have split your performance base into 3 parts. First 2 parts is basically performance on individuals. The next part, which is performance on goods, is not specifically given. It will go in residuary category. It will go in residuary category if LOS and LOR are both within India. What if I tell that LOS and LOR are either LOS is outside India or LOR is outside India? Then they split between 2. 1, you're talking about performance on individual. 2, you're talking about performance on goods. Performance on, here also we split that into 2. Performance on individuals were covered, but 2 different answers. Correct. For training and performance appraisal, 1 answer depending on B2B and B2C. For other performance on individual, no B2B and B2C. Directly location of performance. Be it your beauty treatment, cosmetic plastic surgery, be it restaurant, outdoor catering, directly it is location of performance. They were split into 2 parts. Here there's only 1 part. If at all services supplied to an individual, whether acting as recipient or a person on behalf of recipient. When I am giving training to you and you are employees of say Reliance Limited, performance is on individual, but you are not the recipient. Recipient is Reliance Limited. You are acting on behalf of Reliance Limited. In that case, where when you talk about performance based services, it is but obvious where the physical presence of the individual is required. Only if you come physically, I can perform the services on you. Only if you come physically, I can perform the services on you. In that case, your place of supply is location of performance. But unlike section 12, section 13 recognizes the fact that you can get multiple answers. But just like immovable property, they are very clear, very clear. If you get multiple answers, part in India, part outside India, what to do? If you get multiple answers, part in India, part outside India, they tell that forget about the part outside India, place of supplies, location and taxable territory. In taxable territory, if you get multiple answers, go with contract value or go with a rule called as Rule 7. Now the problem is, performances can be in multiple states even under section 12. But there they don't have any rules. But in section 13, if you get multiple answers, understand that if it is partly outside India, partly in India, forget about outside India, focus only on India. They will totally ignore outside India. Within India, multiple answers, go with the contract value split or go with Rule 7. That is all about the individual part. Now talking about the goods part. Here, the goods part, performance base is specifically addressed. Therefore, if you see the residuary provision, job working was not taken as an example of residuary services. Why? Specifically for performance on goods, there was a specific provision. There was a specific provision where you're talking about supplies on goods which are required to be physically made available by the recipient to the supplier. Only if you give me that goods, I can work on that goods and return you back. For me to work on the goods, you have to give me the goods. You have to hand over the goods to me. I'll work on the goods. I'll going to give back to you. Which means goods does not belong to me. The goods belongs to me. It is not a job working services. Goods does not belong to me. Goods belongs to the recipient. He gives me the goods. I'm doing some work on the goods. I'm doing some work on the goods. And for me to do some work on the goods, physically the goods should come to me. In that scenario, general case, your place of supply is place of performance. And just like this, if you get multiple answers, they are very clear with the two steps. What are the two steps now? If you get multiple answers where part lead is India, part lead is outside India, focus on only the entire thing will be treated as place of supply will be location and taxability. They will totally ignore, they will not go pro rata basis. They will totally ignore the performance outside India. And if within India there is multiple states union territory, go as per contract value or go as per rule 7. Go as per rule 7. But there are certain special cases. This was a general case. What are those special cases? If the performance is from a remote location outside India or from India but from a remote location by electronic means. See, the goods can be outside India but remotely I am monitoring from India, or the goods can be in India remotely, the performance is done from outside India. Either or, which means goods are at one place but the control of performance is at other place. Focus should be on goods. Focus should be on goods. In that case, place of supply is location of goods. In that case, place of supply is location of goods. If performance is done from a person sitting in India, but the goods are physically outside India, place of supply is outside India. Or if a performance is done by a person sitting outside India through remote control, but the goods are in India, place of supply is India. Right. And the last scenario, for because they want it to be treated as export, the goods are temporarily imported in India for repair or any other treatment or process, which means you are importing in India, you are doing some work and you are re-exporting. See, normally speaking, when you import, work and re-export, where was the work done? Where was the performance done? The performance is done in, this is one of the favorite question of ICA. The performance is done in, whereas if you look at this entire transaction, it is very clear that location of supplier is in India. Location of supplier is in India. Location of recipient is outside India. Very clear. It is not clear in other places. But in this case, it is very clear. LOS is in India. Because I am getting the goods and performing in India. LOR is outside India. How you find out? Because the goods are imported, worked out and given back. Which means recipient is outside India. Recipient is outside India. Now they are very clear that if I go with general rule, LOS is very clearly in India, LOR is very clearly outside India. This clarity is not there in other provisions. It may be ulta. But here it is evidently clear that LOS is in India and LOR is outside India. If they go with normal place of supply, which is location of performance, it will be in India. It may not qualify for export. It may not qualify for export. Therefore, they tell that go with residuary provisions. Go with, they don't give an answer here. They tell that go with residuary provision. Now, what is residuary provision talking about? If you go back to residuary provision, what is residuary provision talking about in section 13? Location of recipient. If not available, then it is location of supplier. But what is the prima facie answer? Location of recipient. Don't you think that when I import, work and re-export, I know the location of recipient? Right? If it is location of recipient, which is outside India, now there is a very high probability that it will be treated as export of services. All that I need to satisfy is get foreign currency. Get foreign currency. It will qualify as export. Right. So when you talk about goods performance, it is split into three parts. One, general part. Second, electronic means. Third, a very specific situation where for the first time government shows an intention to give the benefit to the person, assessee, telling that we are ready to treat it as export of services. If we go with general provision, it may not be treated as export, but if we give an exception, it may qualify to be an export with the condition that you receive foreign currency. That being the case, they give a separate formula. Right. So here in section 13, performance is entirely discussed in a special provision, be it individual, be it goods. Yes, in one place in goods, they ask you to go back to residuary provision to give the benefit of export of services. Right. So first was general case, second was immovable property related, third was performance based, and we are trying to see the differences, what happens in section 12 and what happens in section 13. Now it is event based. Now when you talk about event based, in section 12, admission to any event, they specifically talk about admission to any event, be it a park or ancillary services to admission. Place of supply is location of that event or park. Again, they fail to understand that it might be multiple answers. How? In a combo contract, you might be paying for a package where you will be allowed to go to admission in different places. Say for example, you have purchased the tickets for World Cup where there's a combo package if you purchase the World Cup tickets to be held in all the places in India. This is recently going on. Now, where is the admission? Is it in one place or multiple places? Location supplier is in India, recipient is in India, but events are there in multiple places. They fail to recognize that if there is multiple places, what will be place of supply? This failing to recognize multiple places happens in performance based and event based with respect to section 12. In section 13, they recognize it. It is with respect to section 12. There may be other category where you are talking about organization of any event, including ancillary services to organization, including even sponsorship service to an event. Then see in 12, there are places where they categorize as B2B, B2C, and there are places where they don't categorize as B2B, B2C. So here they categorize it as B2B, B2C. If it is B2B plus event is in India or outside India, place of supply is location of recipient. If it is B2B, they don't worry. Whether event is in India or outside India, it is location of recipient. If it is B2C, they now start worrying. If event is in India, it is location of event. If it is B2B, B2C, event outside India, it is location of recipient. But in one place, they do realize the fact that the answer can be multiple places. Where? When it is B2C and when the event is in India, where place of supply is location of your event, there they tell that, okay, if it is multiple states, then we'll have a particular thing. That was not there for admission, by the way. This recognition of multiple answer was not there for admission to an event. For your tickets, it was not there. It is for what? Organization. The people who are organizing it, they will organize in multiple states the same World Cup. The people who are organizing it will be organizing in multiple states for them. If it is B2B, don't worry. Need not worry whether event is in India or outside India, it is location of recipient to give the benefit of ITC. If it is B2C and location is in India, it is location of event if it is multiple states. If I am organizing an event for my client which is not registered and the events is happening in multiple states, then they give a solution for me as an organizer. Split the answer based on contract. If not, go with rule 5. Split the answer based on contract. If not, go with rule 5. Basically, they tell that go with contract value. If the contract value has split the values clearly. If not, go with rule 5. This solution is given for whom? Only for an organizer of an event, not for when you talk about admission to events. Not for admission to events. Let us take the World Cup match. Right. Admission services is done by BCCI. But organizing, where BCCI is the supplier and common public is the recipient. Whereas when you talk about organizing work, supplier is someone else and recipient is BCCI. Recipient is BCCI. You getting the difference? So they realize this fact for organizing but not for admission. But when you start seeing a section 13, they make your life very simple. They tell that we don't want to go with this admission separate answer, organizing separate. Here you have different answer. For admission, they don't ask any question. It is location of event. For organizing, they ask multiple questions. B2B, one answer. Whether in India, outside India, LOR. B2C, if event is in India, one answer, location of event. B2C, event outside India, then they tell that we'll go with location of recipient. Another answer. There are 3 multiple answers. But if you see section 13, life is very, very simple. Why? Now they tell that whether it is admission or organization or ancillary services, they make things very, 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 very simple. And they tell that we will go with location of event. Location of event. But the moment they make it simple, they are very clear with one point. What is that point? If you get multiple answers, and if part of the answer is in India and part of the answer is outside India, we'll focus on only location in taxable territory. We'll ignore in totality whatever happened outside India. And within India, if you get multiple answers, go with the contract split up. If not, go with rule 9. Don't worry, rule 9 will give reference to back to rule 5. Your rule 9 will give back reference to rule 5. Rule 7 gives back reference to rule 4. So rule 9 will give back reference to rule 5. It will not give a separate answer. It will tell that, okay, whatever was said in your rule 5, same thing will be applied. But the difference is, rule 5 with respect to section 12 talks only about organizing. Whereas, rule 9 which gives back reference to rule 5 in section 13 talks both about admission and organizing. But when section 13 will be applicable? When either LOS or LOR is outside India. Either LOS or LOR is outside. It is highly possible. Think of this situation. What if the organizers of this World Cup event are a supplier who's outside India? It is highly possible. BCCI may decide that, okay, let us have organizers outside India. Right? It is highly possible. Or it is highly possible that few organizers, there may be multiple contracts entered by BCCI. Few of the organizers are within India. For them, you are going to apply section 12. LOS, LOR both in India. Few of the organizers are outside India. For them, you are going to apply section 13. Because LOS is outside India, LOR is in India. Now, but if you look at this particular point, there was one specific point, sponsorship services. Organizing including sponsorship services. But when you talk about sponsorship services here, they are not specifically mentioned about sponsorship services. Sir. You have to go back to residuary provision. What is the residuary provision in section 13? Location of recipient. If it is not ordinarily available in ordinary course of business, go with location of supplier. So in section 12, there is admission, one formula, organizing including sponsorship, another formula, split into 3 parts. Whereas in section 13, whether it is admission or organization, one formula. But for sponsorship specifically, they have not mentioned. It will go in residuary category. It will go in, believe me, only if you have a comparative analysis of both, you will be able to give, if at all ICA decides to give a question where they want to check whether you are aware of the provisions of the same type in section 12 and section 13, which ICA does with respect to immovable property. Which ICA does, but with respect to a very particular category, immovable, it keep doing. But if it start doing with other services, say for example sponsorship services, you should be aware where it is actually covered. What was the situation when it is in section 12? What is the situation when it is section 13? Now, main services were your immovable property related services, we have done, performance done, and event based done. For immovable property, be it section 12 or section 13, when you get multiple answers, that is a solution. For performance based multiple answers, that's no solution in section 12, that's a solution in section 13. For even based, there is no solution in section 12 with respect to admission, but solution with respect to organizing. In section 13, for every cases, whether it is admission or organizing, there's a solution if you get multiple answers. Now you are talking about transportation of goods services. Transportation of goods services, where LOS and LOR both are in India. If there is a transportation of goods services, including by way of mail or courier, including by way of mail or courier, if it is section 12, and if it is B2B, B2, the moment they try to bifurcate B2B, B2C, B2B means location of place of supply is location of recipient. If it is B2C, place of supply is where the goods are handed over for transportation. Handed over for transportation, which means origin of goods, which means you can understand this as origin of goods. There is one more category here which was added later on. If the transportation of goods is outside India for export of goods, whether B2B, B2C, forget the fact whether it is for B2B or B2C. In that case, your place of supply is destination of goods. It does not mean that it is export. This is a transaction which will be surely IGST, but it is not export of services. Why? Why? Place of supply will be outside India because the goods are transported for export purposes, means the goods are going to go outside India, and place of supply is, and the place of supply is destination of goods which is outside India. So your POS is outside India. But what is required for export of services? LOS in India, true. LOR, not true. You are seeing section 12, where both LOS and LOR are in India. So that will not be satisfied. It is a transaction which is a short IGST transaction. Short IGST transaction, but not export. But not export. A transportation company can give you services as a supplier, exporter of goods in India. I am taking the services from a transporter as an exporter of goods in India. Who's the supplier? Transporter. Who's the recipient? Exporter of goods in India. Both are in India. Where is the place of supply? Outside India. Whether it is export of services? No. Whether GST will be charged? Yes. What GST? IGST. What GST? Both the transporter and the exporter of goods can be in Tamil Nadu. Can be in Tamil Nadu. Still it will be IGST transaction. Still it will be IGST transaction. Now, when you talk about the same transportation of goods category in section 13, where either LOS is in India or LOS is outside India or LOR is outside India, there's a small difference here. First, they talk only about transportation of goods other than by way of mail or courier. Now, you may wonder, what about mail or courier? Mail or courier will go in normal category, general residuary category. For transportation of goods by way of mail or courier, you are going to resort to section 13 subsection 2 residuary category, where the answer will be LOR. If LOR is not available in ordinary course of business, then it is LOS, residuary category. There it is a common answer. There it is a common answer. Multiple answers, but common provision. There's a common provision. You have multiple answers. B2B one category, B2C one another category. Transportation of goods for export purposes another category, whether it is B2B or B2C. Here, the situation itself was split into two. One, normal transportation of goods. Other, transportation of goods by way of mail or courier. If it is by way of mail or courier, go to general category. If it is other than mail and courier, then there's a separate answer. Then the answer is destination of goods. They want it to be treated as export. If at all LOS is in India, LOR is outside India. POS, they want it to be outside India. POS, they want it to be outside India. Now understand that they are not always focusing on export. It can be reverse also. It can be reverse also. Supposing you are importing the goods, LOS outside India, LOR you are in India, place of supply, destination in India, then it will be import of services. So here there's no clarity. See, in certain places I have given that there's absolute clarity what they want. In this case, it can be either or. It can be either or. Now, the moment we see transportation of the goods, the next thing obviously which will come in your mind is transportation of passenger services. So, when you talk about transportation of passenger services, if at all transportation of passenger happens in section 12, which means both LOS and LOR in India, normal category. If it is normal category, B2B, answer is very clear. LOR. B2C, it is passenger embarking the conveyance, which means origin of passenger. Which means origin of passenger. That is embarking the conveyance for continuous journey means, it does not mean if the train is starting from say Kanyakumari and it is going to say the last part of Kashmir. It is not Kanyakumari. It is the location where the passenger enters that conveyance. Where the passenger enters that, he may have entered that conveyance at Bangalore. So place of supply is Bangalore. Right. But if you're talking about a special scenario, what is that special scenario? Travel pass. You have passes. You have discussed about bus pass. Everyone is aware of bus pass. When you talk about bus pass, you pay a lump sum amount and you continuously keep traveling. If you talk about metros, there will be a pass. If you talk about even trains, people who are traveling to Tirupur from Coimbatore, they don't do think that they will be taking pass. Yes. Now, in case of pass, what is even for airlines, if you are a regular visit customer, you will be getting a passes where you will tell that okay, you can within this year you can travel 20 times subject to certain conditions, ABC conditions, right? You get a pass. What is difficulty with respect to pass? Difficulty with respect to passes, you don't know your entry point. Every time it will change. There is a one contract, but you are going to travel multiple times. So here, with respect to B2B, there's no issue. It will be LOR. Whether it is a normal case or special case, B2B, they want to give you the credit, it will be LOR. But with respect to B2C, it will be the address on the record, address of the recipient on records. If not available, go with location of supplier. So B2B, whether it is a normal case or a pass case, the answer is very simple. It is location of recipient. B2C, in a normal case, you do know that it is one ticket, one travel. Then you talk about when you are entering that conveyance. But if it is B2C and it is a case of pass, you will be using that pass for multiple travels. Then go with what? Address on record, address of the recipient on records. If it is not available, go with location of supply. It is very similar to your residuary provision of section 12. Though the answer is given here separately, the answer is taken from your residuary provision. What if it is section 13? Either the airline example is outside India and passenger is of India, or the airline is of India, passenger is of outside India. LOS or LOR is outside India. You are going to take section 13, transportation of passengers. Now, no bifurcation. They tell that it is the place where passenger embarks the conveyance for continuous journey. To put in a simple terms, they have not recognized here what if it is a pass case. There might be travel pass even for a foreigner who is using Indian Airlines. But they have not recognized that in section 13. It may not be much, but it is possible. They have not recognized that in section 13. It's a very simple answer, straightforward answer, that where you enter the conveyance for a continuous journey. Now, when you talk about passenger transportation services, the related services which will come is services on board during transportation. Services on board a conveyance during passenger transportation services. A classic example of which you can take is when you are going by, say, airline, services on board a conveyance might be food services. Correct. If it is services on board during passenger transportation service. Now, if it is section 12, which means LOS as well as LOR is in India, place of supply is the first scheduled point of departure of that conveyance. The same is true in section 13 as well. Now, they cannot see which passenger entered the conveyance. All of us can be the passenger in that particular conveyance. I may have entered the first point of that conveyance. You may have entered the third point. Someone else may have entered the fifth point, etc., etc. So it is not possible to find when that passenger entered the conveyance. So what is the simple thing? Go with the first scheduled point of departure of that conveyance of that journey. The same is the answer for the first time, even in section 13. Go with what? First scheduled point of departure of that conveyance. Supposing the journey starts from Coimbatore via Bangalore, via Mumbai to Delhi. The answer will be, this journey starts from Coimbatore via Bangalore, via Mumbai, finally to Delhi. Few of the passengers may have entered the journey at Coimbatore, few of them Bangalore, few of them Mumbai. But for all these three passengers, whether he has entered in the conveyance in Coimbatore or Bangalore or Delhi, if they have taken the services on board a conveyance, POS will be, see, for their travel, POS is different. For their ticket, POS is different. For their travel, POS, if it is B2B, it is location of recipient. If it is B2C, it is a place when we are entering the conveyance for continuous journey. We are not talking about past case in section 12. In section 13, when you are entering the conveyance for continuous journey. Answer is different. Answer is different for your ticket. But what about the services consumed on board a conveyance? For all the passengers, that's one single answer. The airline company or the trains, they cannot keep track which passenger entered at what point of time. Correct? I mean, why I'm taking example of airline? Train. They'll come and take your orders. What is the place of supply for them? Very common that when you're traveling in train, 110%, you'll surely see a person who's coming and taking your orders. That is a classic example of services on board a conveyance during your journey. What is the place of supply for them? Are they going to differentiate whether you are from India, whether you are from outside India? They are not in a position to differentiate. Then they'll go with what? The first scheduled point of departure of that conveyance. Now, when you talk about the next category, telecommunication services. Telecommunication services. Please understand that the bifurcation of telecommunication services that we are going to discuss is given in only section 12. In section 13, it will go in normal category. If at all LOS or LOR is outside India for your telecommunication services, be your telephone connection or mobile phone connection or internet services, in section 13, it will go in residual category where place of supply is location of recipient. If not available in ordinary course of business, it is location of supplier. The entire discussion, the entire detailed discussion which is there is only in section 12 where both LOS as well as LOR are in India. If at all, you have to split. First category, if at all, you are talking about fixed telecommunication line, lease circuits, internet lease circuit or cable or dish antenna. That is the first category. Second category, you are talking about your mobile connection or internet services. See, one is with line, with particular telecommunication line, one is wireless, one is with wire, one is wireless. So categorize them as wire and wireless. Wire and wireless. The first category is of wire and second is of wireless. If it is with wires, then your place of supply is location where such line or circuits or cable connection or dish antenna are installed, because it is with wire. Installation of that. And in case you get multiple answers, what do you think about big corporates? They'll have all these services together. Right? They will have a discussion with Jio company and tell that, see, we are having multiple places across India. I cannot pay you for different services, different time. I want a big discount. You give me internet services in one package, not only for my branches in Tamil Nadu, but also for my branches in different parts of India. But don't you think that Jio company will have installation of wires in different places? What do you think? How that big companies get internet connection at a very faster pace compared to we who are getting at a normal pace? Why? There will be specific installation for these companies. Initially, they have to pay a big price because special installation will be for only for them. And when I tell special installation, it's not that only fully special installation. Already there will be routes. In addition to those routes, they'll be giving you dedicated line. Simple terms. There will be dedicated line only for your company, where you will never face this normal issues where the net connection is now slowed down, because there will be dedicated lines. Right? You will be premium customers of them. Now, when there is a dedicated lines, circuits are installed in multiple states. Circuits are installed in multiple states for you. Don't you think that your place of supply will be multiple states? In that case, if place of supply is in multiple states, then place of supply each of that state in proportion to, see, first thing that they do in all the cases, the moment you get multiple answers, go with contract value. See whether the contract has split that answer. If not, go with rule 6. If not, go with rule 6. As a rule where it tells that how you are going to bifurcate that. Go with rule 6. The first part will tell that go with the contract bifurcation. If no bifurcation in contract, go with rule 6. That is the first part. Now, second part, you are talking about wireless. The first part is all about wire. Wire means where the wire is installed. In simple language, wireless. Now, in wireless, they talk about multiple split ups. If it is postpaid, billing address of the recipient. Billing address of the, which will enable him to take the credit. Which will enable him to take the credit. If it is prepaid, through a selling agent, reseller or distributor of SIM card or recharge also. If it is via someone, prepaid through someone, then place of supply will be address of that selling agent, reseller or distributor. Now understand that there is another prepaid by any person to the final subscriber. Let us understand both together. Place of supply is location where the payment is received or the vouchers are sold. And if payment is made by internet banking or electronic mode, then it is the address on records of the supplier, whatever this address is available on records. Now try to understand both together. You are getting wireless connection through an intermediary. See, nowadays directly we make the payment. But don't you remember that even today there are a lot of you who will go via an intermediary. So you are talking about a Jio, then there is a seller or distributor or reseller, then there is a final subscriber. Now, what they are trying to tell? Between Jio and seller, distributor, reseller, what is the place of supply? What is the place of supply? For them, they tell that they want to give the credit to the seller or the distributor or the reseller, right? They tell that it is location of that seller or the reseller or the distributor. They want to give the credit to him. But there is a second possibility where you are talking about directly Jio to final subscriber. So in this second case, where you are talking about Jio directly to final subscriber or selling agent, reseller, distributor to final subscriber. To final subscriber. They have a separate answer. They have a separate answer. They are telling that where we receive the payment or where the vouchers are sold. Basically their address. But if the payment is made via electronic means internet, then they tell that whatever location of recipient is available on the records. Then they tell that okay, if you make cash payment, POS is location where the payment is received or the vouchers are sold. It is nothing but the location of the supplier. It is nothing but the location of the, if at all you are making the payment via internet banking, then it might be your location. It is the location of recipient on records, which means they want to promote payment via electronic means. Why? Only when you make the payment via electronic means, at times you might be able to get the credit. This is more real when you're talking about the seller being in a different state and you file subscriber being in a different state. We can connect to it easily because we are on the borders of two states. Being in Coimbatore, I can get the recharge done from my friend in Kerala. Now, if I am making payment every now and then when I meet him by cash, right, or by check, but not via internet means, not internet banking or any other electronic means. What will happen? POS is where the vouchers are sold, where the payment is being received. Kerala, I may not be able to take the credit. But if the payment is made via internet banking or electronic means, then POS is location of recipient on records of the supplier. Clear? Any other telecommunication services, support services. Here they are talking about the support services. Place of supply is address of the recipient on records. If not available, location of recipient. Now when I talk about any other telecommunication services, what it means? Support services. You are not talking about the wire services, wireless services. You have some issues in your connection. There's a support service being given to you for which an amount is being charged. Then it is address of the recipient on records. If not, go with the location of supplier. Go with the location of. This detailed discussion is there only for section 12. Wire, wireless, support services. That's detailed discussion only in section 12. In section 13, if telecommunication service comes, go to residuary category. What is the answer in the residuary category? Location of recipient. If not available in ordinary course of business, location of supplier. Location of supplier. The last few services which we are discussing are related to specified services. The last few set of services. Banking services, intermediary services, short-term hiring up to 1 month of any means of transport. Of any means of transport. Excluding aircraft or vessel but including yacht, recreational ships. Now what are the services being discussed here? Banking, intermediary, short-term hiring services up to, if it is more than 1 month, go to normal category. Up to 1 month of any means of transport. I mean, we are talking about if you are going for a vacation, you will be taking short-term hiring of vehicles, any means of transport, but it should not be. What about aircraft and vessel? General category. But if it is recreational ships, yacht, then it is covered. But when it is covered, be it any means of transport other than aircraft and vessel, but including recreational ships, yacht, the condition is it should be only up to 1 month. If that is a scenario, all in this actually is discussed in section 13. In section 12, they have a special formula only for banking related services. For banking related services, including stock broking, place of supplies, location of recipient on records of the supplier. If not available, location of supplier. At times for few banking services, your address will not be available. Supposing you are taking the services of DD charges are taken. It is highly possible that bank is not having your address. Then they'll go with location of supplier. Now all the other services, including intermediary services, real estate services, other than stock broking service, because stock broking services is covered along with banking services. For all of them, if it is B2B, you are going for general category. B2B, location of recipient. B2C, address of the recipient on records. If not available, it is location of supplier, because it goes in your residuary category. It goes in your. So in section 12, they address only banking and financial services. But they include one more extra services there. What is that? Stock broking. Banking and financial services along with stock broking. There they give a separate formula that we will go with the address of the recipient on records. If not available, we'll go with location of supplier. For all the other services that is discussed here, you go with the normal provision. B2B, location of recipient. B2C, address of the recipient on records. If not, location of supplier. But in section 13, you have all the banking services to the account holders. They very clearly tell we don't want LOR. We cannot focus on where is the recipient located, because either the supplier or the recipient is outside India. They want to make their job very simple. They tell that place of suppliers, location of recipient. For other banking services, which is not to account holders, it goes in residuary category. If it is residuary category, go with location of recipient. If not available, then go with location of supplier. For banking services to account holders, one formula, simple formula, LOS. For banking services to other than account holders, they tell that go with normal category, go with location of recipient. If not available, go with location of supplier. Now for intermediary services and for hiring services, which is for short term, including all means of transportation but excluding aircrafts and vessels but including yacht, they again want to make their life very simple. They tell that we'll go with location of supplier. See, in section 13, they cover banking services to account holders, intermediary services, short term hiring up to 1 month of all means of transportation including yacht but not aircraft and vessel, where they tell that we are not going to take any headache. We are not going to see recipient and all. Understand with this logic. They are talking about short term hiring within 1 month. If you are going to Goa for say 10 days, will they take efforts to see where you are located? Don't you think that they will have your address? For sure. The first thing that you have to give is your license. The first thing that you have to give is your license, which will surely contain your address. But they are telling that we will not take headache and all. If it is only for 1 month, why to take all this headache? We'll go with location of supplier. We'll go with location of supplier. Right? This example is more important when a foreigner is coming, because LOs is in India, LOR is outside India. They don't want to take the headache. But what if a foreigner has come out from outside India, which normally they do, staying in Goa for more than 1 month, which normally they do. Their vacation is very long. Then they tell that no. Now you have to go with normal provision. If, because it is not for 1 month, it is for more than 1 month, you will go with normal provision. Normal provision tells what? Place of supplies, location of recipient, location of, if it is not available in normal course of business, then it is location of supplier. Don't you think that the foreigner who is coming to India and taking the vehicle on hire for 2 months, don't you think that that supplier would have taken the proofs? Don't you think that address is already clearly available on records in ordinary course of business? So it will be location of recipient. It will be location of recipient. Right. Now, insurance services. Insurance services specifically is given in section 12, not given in section 13. If it is insurance services with respect to section 12, it tells that B2B LOR, B2C address of the recipient on record. In both the ways, it is LOR. If it is B2B, location of recipient which is registered. If it is B2C, again it is location of recipient which is on records. And here they don't give an exception that what if it is not available. Surely it will be available. Surely it will be available. Now, if it is section 13, they go with residuary provision. They don't have a specific provision. They go with residuary provision. What is the residuary provision? It is LOR. Understand that that exception will not work out, because surely it will be available. When that exception comes, only if it is not available in ordinary course of business, you will go with LOS, but this will not be clearly there in this particular scenario. Now, last two categories where we are talking about your advertisement services. Advertisement. Now, understand that this advertisement services is very specific to your section 12. Section 13 goes with normal category. Normal category. What is the normal category in section 13? Location of recipient. If not available in ordinary course of business, location of supplier. Simple. Section 13 does not have any special portion. Even in section 12, it goes in normal category if it is advertisement to other than government. Advertisement to other than government. With normal category. What is the normal category? What is the normal category? What is the normal category answer? If it is B2B, location of recipient. B2C, address of the recipient on records. If not available, go with location of supplier. Normal category. Then for what there is a special category? Only for a special scenario where advertisement services is to central government, state government, local authority, or a statutory body, or a statutory. Supplier is not government, recipient is government. Recipient is government, where the advertisement service is given to a government. We are talking about recipient being the government, central government, state government, local authority, or a statutory body. Understand in very simple terms. You will see advertisements on Indian Railways. One such example. don't you think that that advertisement which is on Indian Railways is advertised at multiple places? The train is going to go to multiple places. That advertisement services will be received by government not only in one place but also in other places wherever the train is going. Wherever the train is going. So they tell that for the first time you will find that they start with this answer telling that place of supply is each of that state where advertisement is done. They by default know that high possibility that there will be multiple answers. High possibility that there will be multiple answers. So they tell that we will go with multiple answers, and if at all there are multiple answers, first step always contract bifurcation. If not, rule 3. If not, rule 3. So when you're talking about advertisement to government, it is very common. Okay, just take another example. When you watch television, you'll find advertisement of Delhi government. When you're watching a channel sitting in Tamil Nadu, don't you think that that advertisement service was received even by a recipient in? The reach was even to a recipient in Tamil Nadu. So they will tell that answer is multiple states. Now how to bifurcate that multiple states? Basically it will be based on contract value, which is possible in some cases, not possible in many of the cases. You have to go with rule 3 formula. You have to go with, which means the supplier will have a big headache. Supplier of advertisement services to government will always have a big headache because we will have multiple place of supplies. For one value, you will have multiple place of supply. The broadcaster of the advertisement of say Delhi government, say for example any television channel. If that television channel is advertising for a particular government, they will, and they obviously will get that. What is the main revenue for the television channels apart from your subscription? It is only the advertisements. And that being the case, most of the times when you are watching television, you see more of advertisement than of the content. Correct? They'll come in 2 minutes and again tell that we'll go for a break. Right? That is the main service. Now here we are going to go with multiple states, and how to bifurcate in multiple states will be discussed in rule 3. By default, they understand it will be multiple states and that bifurcation will be there in rule 3. And the last category is OIDARS category. In OIDARS category, they don't talk anything about anything in section 12. If at all you are a supplier of OIDARS in India and recipient is also of India, it will go in residuary category. It will go and sit in your residuary category. If you see initially, OIDRS was covered in your residuary category. What will be the answer? Residuary category, what is the answer in section 12? If it is B2B, LOR. If it is B2C, address of the recipient on records. If not available, LOS. This is discussed only for whom? This is discussed only for, and this is actually discussed in section 13 read along with section 14. We are reading both. Section 13 read along with section 14. It is discussed for a supplier of OIDRS outside India and recipient being in India. Place of supply will be location of recipient. Place of supply will be location of recipient. Now, location of recipient shall be deemed to be in taxable territory. They first tell that place of supply is recipient. Then they tell that this location of recipient will treat it is in India. If any of the two tests are satisfied. What are the two tests? Either address of recipient is in taxable territory or billing address is in taxable territory. Normal address or the billing address, or the card through which payment is made is in taxable territory, or the bank account through which payment is made is in taxable territory, or the IP address of the recipient is in taxable territory, or the SIM card through which you are getting this telecommunication OIDR services is in taxable territory, or the fixed landline is in taxable territory. 2 plus 2 plus 3. First two address, next two payment modes, last three it is all about your IP address. Either your IP address or your SIM card if at all you are using your phone to get the services, or your fixed landline in taxable territory. If any of these two are in India, they will treat it as in India. Now why they tell it? If OIDR supplier is outside India, And if recipient is in India, place of supply is also in India, it will be treated as import of services. It will be treated as import of services. And mind you, in this case of import of services, normally it is RCM, but in this case it will be FCM. OIDARS supplier outside India will be paying GST. They'll be filing a special return. They'll be taking a special registration. They'll be filing a special return called as GSTR 5A. They'll be filing a special return called as GSTR 5A. Right. They want to make sure that there is no differentiation between OIDRS in India because he is going to pay GST. Even if this OIDRS, all the apps that you have is nothing but online information and database access and retrieval services. What is meant by OIDRS services? Two important criteria. It is automated. It is an automated service through information technology with minimum or no human intervention. With minimum or no human intervention. All the apps that you use are OIDRS. Automatically rated. Be it any app you take it in on your phone, it is OIDRS. Even including Facebook, WhatsApp, they're all OIDRS category. Automated through information technology. Without or with minimum or without any human intervention. YouTube, OIDRS. It's all OIDARS services. If it is OIDRS services from outside India to a recipient in India, it is importation of services. Place of supply is location of recipient, and they will treat that recipient as in India. First they tell place of supply is LOR. Then they tell that they will treat that recipient is in India if any of the 2 out of 7 condition is satisfied. Initially they don't tell that LOS is in taxable territory. They tell that it is LOR. POS is LOR. Then they tell that LOR will treat it to be in India if any of the 2 out of 7 conditions is satisfied, to make sure that there is a maximum possibility that it will be import of services and that OIDS supplier who is sitting outside India needs to make payment in India. See, it can be ulta also. It's not always free. It's ulta also. OIDRS can be app creator can be in India and the customer base can be outside India. Then also the same concept will apply. Place of supply will be LOR. And if the customer base is outside India, that LOR will always be outside India because they will not satisfy any test out of 7. They will not satisfy any test out of 7. So that is all with respect to your place of supply in terms of section 12 and section 13. So when you talk about your other provisions of your IGST Act, we have already seen what is section 15, which is supply of goods to international tourists. Section 16 talks about your zero rated supply. What is zero rated supply? We have already discussed in your ITC that it means what? Export of goods or services or supply of goods or services to special economic zone unit or developer of SEZ. What is the speciality of SEZ? Normally, if you don't make any payment of output tax, you will not get the credit. But when it is zero rated supply, even if you are not paying output tax because you are going with letter of undertaking or bond, even then all the credit other than block credit you can avail. Not only that you can avail, you can even apply for refund. For zero rated supply under section 16, you do have 2 options. First option, supply under bond or LUT. Normally bond will not come for normal assistance. Only LUT will be there. Letter of undertaking, a simple letter will be there without payment of output IGST, which means you will not have any output, but still you have input tax credit. On your export or supply to SEZ, you will not have any output tax because you have supplied under LUT. Still you will be taking input tax credit. Then on the basis of rule 89.4, apply the formula and get the refund of unutilized credit. Refund of unutilized credit. That's the first option. Second option, what you can do is supply on payment of output IGST. Pay the output IGST. When you're paying the output IGST, you will use the available credit. If not, you will pay by cash. Balance portion you will pay by cash. So when you're paying your output IGST on export of goods or services or supply of goods or services to SEZ, you will use the credit. So your credit will decrease. If not available, balance portion, if required, you will use the cash. So pay output IGST by using the credit ledger or cash ledger. Then get the entire output IGST as refund in your bank account. Which means here also indirectly your credit ledger is refunded. Indirectly. How? When you paid your output IGST, what you have done? You use your credit ledger, whatever was available, then you went with your cash ledger. Right? Suppose your output IGST is 10 lakhs, your credit is 8 lakhs. So you used 8 lakhs credit ledger, it got reduced and you paid it 2 lakhs by cash. But when you get the refund, you will get the refund of what? Entire 10 lakhs. Entire 10 lakhs. That is the speciality of your zero rated supply. What is happening in the entire transaction when you talk about your zero rated supply? What is happening when you talk about your entire transaction and talk about zero rated supply? The goods or services are going outside India. Therefore, there is no payment of taxes in India. Simultaneously, you need to understand that whatever taxes was collected in India before the sale, that is at the purchase point, that also got refunded. So the goods or services when they're going outside India, it is tax free. It is tax free. That is all about your section 16. Then you have certain provisions with respect to your transfer of amount between governments. Mainly, if you see, there was section 17A which you already completed. 17A. 17A was dealing with what? Cash ledger to cash ledger. 17A we have already completed. Section 19. That also we have already completed. So what is actually left out? It is section 18 and section 17. Now what are these two provisions? First let us understand section 18. When you are paying your output tax by using the credit. When you are paying your output tax by using the credit, at times what you will do? You will use IGST credit for paying CGST. See, IGST will be with central government but acting as custodian. If IGST credit is used for CGST tax, then finally what will happen? That amount which central government was having in the account of IGST will be permanently given to central government account. Central government supposing is having IGST amount, say of 10 lakh rupees and 10 lakhs credit, out of which 5 lakhs is used for paying CGST. Please understand that IGST is always there with central government as a custodian, but it does not belong to the revenue of the government. It is not actually the revenue of the government. So now what will happen? To make it permanent revenue, central government will transfer from IGST to CGST. Now it becomes permanent revenue of central government. Now ulta case, ulta scenario, IGST is used against SGST or CGST, SGST or UTGST. Now understand that IGST revenue, when I tell credit, obviously central government would have got that amount earlier. When IGST ITC is used for output, this IGST ITC, that revenue in the earlier chain, the first previous chain would have gone to central government pocket, but that now amount is used for what? Paying the state government's output tax. Don't you think that now central government should transfer the amount from IGST pocket to the respective state? So that transfer will happen. When IGST input is used for CGST output, central government will make that amount permanently transferred to CGST. When IGST input is used for SGST or UTGST output, central government now will transfer that amount from IGST pocket and give it to, now it is not only just doing the book entry, now it has to give it to state government or the union territory. Now understand there's one more possibility. SGST credit used for IGST output. SGST credit used for IGST output. What will happen when SGST credit is used for IGST output? State government has to transfer that amount to central government. State government has to transfer that amount to central government. So when SGST credit is used for IGST output, state government will transfer to central government. Now the last part, section 17. What if IGST revenue is there in the balance? There will be certain IGST credit which will never be taken. If IGST credit is taken, we are going to discuss section 18. And how transfer will be done, we can easily understand. IGST credit used for CGST output, permanently go to central government. IGST credit used for SGST output permanently transferred to state government. SGST credit used for IGST output, state government has to transfer it to central government. So that is understandable. What if I tell that ITC itself is not taken? Now when this will happen? If at all there is IGST being paid on interstate supply including import of goods. But that is by whom? That is by unregistered person or composition taxable person or a registered person where ITC is ineligible or a registered person where ITC is not available. In all such cases, we find that ITC is not taken. Correct? That is IGST amount by the recipient is unregistered. He cannot take the credit. The recipient is composition scheme dealer. He cannot take the credit. The recipient is registered person but not eligible for ITC. Not taken. The recipient is registered person eligible for ITC but he has not availed for some reason. Now this amount for the time being we have always discussed that IGST amount will be there with central government as a custodian. Now this amount is an extra amount with the central government. Correct? It will never touch the section and never enter section 18 so that it will be finally transferred. Now this amount is an excess amount which remains with central government. Now what will happen? Central government finally this is untouched amount which is now excess amount with the central government. Central government will take its share 50%. Balance should be given to whom? Balance should be given to whom? State government or union territory. But if they are able to find the state government or union territory, they will give. If not, they will not be giving. So what is the steps or sequence? First, if the taxable person is identifiable and if place of supply is determinable, give it to that state where actually supply went. If you know who supplied it and where was the place of supply, give it to that particular state. Give it to that particular state. If taxable person is identifiable, place of supply is not determinable. I mean, you know that this supply was made by so and so person. You're not now talking from the angle of the recipient because recipient did not take the credit. But you are able to trace the supplier. You are able to trace he is identifiable, but place of supply is not determinable. Then what to do? That taxable person would have paid to governments. That supplier would have paid to different governments. So as per the ratio of total supplies made by taxable person to each of the states in that financial year. In that financial year, that supplier would have paid to different governments, right? So go in that ratio and give to different. If that supplier has paid only to 3 governments, give it only to those 3 states. If the supplier has made supplies only to 3 states, within his state and outside his state only 2 states, distribute it among only those 3 states in that ratio based on that financial year. Now, the last and final possible scenario. If taxable person is not identifiable, forget about place of supply. If you cannot even find out taxable person, there is no question of finding out place of supply. Then the tax, such excess amount of tax will be given to all the states, union territory based on the ratio of immediately preceding financial year. They'll see how many what was the revenue of the states in the preceding financial year. That final residual amount will be given to all the states, union territory based on their revenue collection in the preceding financial year. Based on the revenue collection in the preceding financial year. And if at all that needs to be determined for the time being, they'll be giving ad hoc amount 50%. Till they know very clearly, they'll give 50% they'll give. But final settlement will happen in what way? Final settlement will happen in this step. If you know 50% will be taken by central government, 50% by state. If you know that particular state, give it to that particular state. TS and POS is known. If you know TP, if you know the taxable person but not POS, give it in the ratio to those states where you're talking about that taxable person paid to the respective states in that year. If you are not aware even of taxable person, give it to all the states and union territories based on the revenue collected during the preceding financial year. The same formula will be applied for interest, penalty, other amounts. So same thing will be applied for that also. The same formula, whatever you discuss, exactly the same formula will be applied. If at a later point of time that IGST which is distributed to different states is refundable, that amount will be again collected or appropriated. This was an excess IGST amount which was there. If finally you find that excess IGST amount which was given to the particular state or multiple states or all the states, is finally that is again refunded back, what will happen? Again that apportionment will be done. So that is all about your section 17 read along with section 18, where you're talking about transfer between the governments. Accounts and records. The provisions are discussed in your section 36 and 37 read along with corresponding rules 56, 57, 58. Let us focus only on the important concepts or the principles of your accounts and records. Who are all required to maintain your accounts and records? Basically only registered persons. Few unregistered persons are required to maintain your accounts and records. They happen to be the warehouse keeper and the transporter. Warehouse keeper and the transporter. So who are required to maintain accounts and records? Registered person, unregistered person, only two categories, warehouse keeper and the transporter. Now till how long you are required to maintain your accounts and records? Normally you are required to keep your accounts and records till 72 months from the due date of filing your annual return. If the due date is extended, you have to maintain your accounts and records beyond that. From your due date of filing annual return, which means if it is financial year 23-24, 72 months, which is nothing but how many years? 6 years. 6 years will start from where? If at all you are talking about financial year 23-24, 6 years will start from 31st of December 2024. 31st of December 2000. From that 72 months. For which year? For financial year 23-24. 23-24. Right? It is actually more than 72 months because it starts from where? Due date of filing your annual return. But if at all your books of accounts pertains to a subject matter which is pending in appeals, revision or any other proceedings or investigation even by an officer, not necessarily in appeals, it is pending for any proceedings at adjudication level or at appeal level. In that scenario, you have to maintain your accounts and records. The first concept remains the same. Your 72 months from the due date of filing annual return remains the same. Or 1 year from the disposal of that matter. 1 year from the final disposal of that matter, whichever is later. If at all there is any issue which is pending for financial year 23-24, any proceedings, not necessarily appeal proceedings, any proceedings pending for that financial year 23-24, the first principle is the same, 72 months from the due date of annual return compared to 1 year from the time when that proceedings stopped and attained finality. It stopped and attained finality. Compare both the dates, whichever is later. Now, what to maintain will be discussing in the next page. Basically, commissioner has got powers to tell that you have to maintain certain extra records for certain special categories, and commissioner also has powers to tell that okay, certain persons are required to maintain certain lesser records because of difficulty. So there are certain normal set of records. Commissioner for certain persons can tell that apart from this, maintain extra records. For certain people can tell that okay, you are going to get a concession, you need not maintain all these records. Now when you talk about the place where you have to maintain the records, please understand that records are to be maintained at each place of business, not only at your principal place of business, but also at all other places of business pertaining to that particular godown. Supposing there is a godown and you have goods there, the goods are being transferred from head office to branch office. In godown, you are not required to have the financial statements there. You are required to have what? The inward delivery challan and the outward delivery challan from that godown. What goods came in for that inward delivery challan, what goods went out for that outward delivery challan. Record documents have to be maintained at all the places of business. And assume that officer is coming and is finding certain records in your place. There is a general presumption that whatever records are found at your place, it is presumed that it is maintained by you. You cannot tell that no, these records does not belong to me. It is presumed that these records are belonging to you. Now, there are concepts of hidden deemed supplies in many places. Now, one such case is here. If the registered person fails to account for goods and services, which means he is not having proper records. There are goods, but he's not having proper records. Then proper officer shall deem that they have been not accounted and they have been supplied. It will be treated as deemed supplied. It would have been treated as deemed supply, and provision of sufficient 73, 74 are there. For example, there is a go down where officer finds that there is 1 crore stock of goods, for which he finds that there is no registration taken for that place. It is not added as additional place of business. Also, he finds that there are no documentation, inward DC and outward DC. What he will do? He will tell that these goods are not accounted, and he will tell that I will assume that it is deemed to be supplied. Deemed to be supplied, and 73, 74 will come. Now another question will come. When they are actually supplied, then again you have to pay GST? Yes. This is for non-accounting that you have to pay. Deemed supply. They'll assume that you are doing this for a continuous long point of time. So whatever stock we have found, it is deemed to be supplied. Deemed to be supplied. And when you actually supply them, again you have to make the payment. So this is a hidden concept of your deemed supply. Hidden concept of your deemed supply. Now what all accounts are, records are to be required by every registered person. All associate, every registered person. Simple records which you will find in any software that you maintain. Most of the details you will find in any software that you maintain. You will find all these details. Inward supply, outward supply of goods and services. You will have the track of that. What are the goods and services that have been imported and exported? If they are asking you to tell that these are the goods that have been imported and exported, you will be having separate line item for that in your software. Supply which are attracting your RCM. You have to tell out of these supplies, these accounting that you have done, what supplies are attracting RCM. Obviously, you will have either it will be there in the software itself, or you will be having working papers for that. Then details of tax payable, tax collected, paid, and ITC. Please understand that these details, tax payable, tax collected and paid, and ITC avail, will not be applicable for a composition taxable person, because composition taxable person cannot collect tax, and composition taxable person will not have any ITC. And finally, when you're talking about inventory details, this inventory details is also not required to be given by composition taxable person. The advantage, the main advantage of composition taxable person, if you remember when we discussed, was not maintaining the stock. See, this was not an advantage. It does not collect tax, therefore there's no question of having the records for tax collection. It cannot avail ITC, therefore there's no question of having the records for ITC availed. But this is an advantage. A composition scheme dealer need not maintain the stock records, stock details, which is required to be maintained by all the other types of person, regular persons, be it RTP, be it CTP, be it NRTP. They have to maintain all these records. What are the stock records? Goods received and supplied, starting from opening balance, what is received, what is supplied, what is the closing balance. At times, when you talk about what is supplied, it will have extra details like what goods are lost, stolen, destroyed, written off, disposed by way of gift samples, scrap and wastage. In all these cases, you have to reverse your ITC also, except scrap. Except scrap. This information will be available with you. What was my opening balance? What was my opening balance? What I received, what I sold, and what is the closing balance? Ideally, it should match. But if there is a difference between the calculated closing balance and the actual closing balance, it might be because of scrap, it might be because of lost, stolen, it might be because of goods being destroyed or written off or given as gifts or free samples. So that information should be there, maintained by you. And these are all the details of the goods and services that you get along with the stock details. Now, in addition to it, you are required to maintain the name and complete address of all the suppliers from whom you purchase, all the customers to whom you sell, except where relaxation is there. When you see a document chapter, you will find that if at all, if it is B2C case, and if the value is up to 50,000, you will not have name and address of the customer. You will not have name and address of the So normally customer details also everything is required. When it is not required, B2C 50,000. B2C 50,000. In that scenario, you will not have the customer details. You will not have the customer details. And you have to give the list of all the premises where you have stored the goods, including store the goods in transit. Simple reason we have already discussed the following part. If at all it is found that the goods are there without proper documents, not accounted for, it will be treated as deemed supply. So this is again repeated here. Deemed supply concept is again repeated here. Now advances. For advances in a document chapter, it is said that you have to maintain receipt voucher and refund voucher. So when you talk about your advances, you are required to maintain receipt voucher and refund voucher. Also adjustment of advances. Refund voucher will be very rare. It is receipt voucher and that has been adjusted against the invoice issued. That has been adjusted against the invoice. What is advance, what advance is received, whether it has been adjusted or whether it has been refunded. Please understand, when you talk about advances, the details are required to be maintained only for service sector. Only for, not for goods sector. Not for goods sector. It is required to be maintained only for service sector. The reason is your time of supply. The reason is your, for goods time of supply is normally, forget about composition scheme. Normally it is actual date of invoice or due date of invoice. They don't pay any GST on advances. And documents issued and received. This you will find in the document summary which you have to report even in your GSTR 1. What are the invoices raised, credit note, debit note raised, bill of supply, delivery challan, receipt voucher, refund voucher, payment voucher in case of RCM. All these things will be there in your software if you are maintained properly. All the details will be there in your software. You just look at this entire point. Just think of a very basic software. Don't go to SAP level. Very basic software. QuickBook or Tally or whatever it is. You'll find that you'll get all these details in the software that you maintain. All the details. That if at all you are maintaining all the details properly, you can easily find all the details right directly from your software, including your stock details. Including your stock details. Now, there are few persons who are required to maintain special records. This is the list of records that is to be maintained by all assessees. That is to be maintained by all assessees. Now, there is a list of records which is required to be maintained by specified assessees, special assessees. Now, if at all you are talking about a manufacturer, he has to maintain monthly production details. Monthly production details. Raw materials, what was opening balance, what came in, what was issued for production, what is the wastage and what is the closing stock. Whatever is produced will go and sit in your finished good stock. So you have to maintain your monthly production details where you will be giving the details of your manufacture. Manufacture means your raw materials, opening balance of raw materials, purchase of raw materials, production of raw materials into finished goods including wastage, and closing balance of raw material which is yet to go for manufacture or production. So that will be there, but important point is monthly production records. Before GST, manufacturer was required to maintain daily production records. After GST, it is monthly production records. Supplier of all services, this was not required at all because this automatically is covered there. What is the goods and services that you receive and what is the service that you supply. See, if you see the earlier list, that automatically was covered. Inward supply and outward supply. This was unwarranted. This was already covered here. Inward supply and outward supply of goods and service already covered. So that was not so important. Now when you talk about an agent, now agent is required to maintain certain special records. Authorization from the principal that he is acting as an agent. If he is having multiple principals, each of them separate authorization. He has to tell the description, value, quantity of goods, what is received and what is supplied. Basic accounts, what he has received on behalf of the principal and what he has supplied on behalf of the principal. He has to give the accounts, which means he will be having the stock on which he is not going to make any payment because the goods does not belongs to him. Finally, when he is giving the accounts, he has to make the payment of only what? What he has sold. What he has sold after deducting his commission. After deducting is, we'll prepare accounts in that manner. And tax paid on receipts of supply on behalf of the principal. This becomes very important if he's a special agent. This becomes very, very crucial and important if he's a special agent who's authorized to raise invoice under his own name. This has been said a number of times. Books of accounts of both principal and agent will not match with GST records. Will not match with GST records. And it again becomes very important for the proper officer to understand who's the real owner and compare your books, compare both principals and agent books with the GST records. And if there is a difference, don't worry. We have something called as GSTR 9C. Give the reasons for reconciliation. Give the reasons for your reconciliation. And finally, a builder or a works contractor. Here also he has to maintain the record separately for each of the works contract. If a builder is doing 10 works contract, separately for each of the works contract, he has to maintain the details separately. What details? Name and address of the persons on whose behalf the work is being done, which means his client. Which means his client. Description, value, quantity of goods and services received and used. In contract 1, what was the goods received, what was the cement received, sand received, and what has been used. The details of payment received in respect of each contract. What is the amount that he has received from the customer? What is the amount that he has received from the customer? And even the list of the suppliers from whom he has received the goods. Now this is actually very important because normally what will happen is he will try to take that extra goods or services and shift it from one contract to another contract and present to the officer in a way where he is satisfied that all the goods and services are proper. Correct? If think of a builder who's doing, think of G Square, who's having multiple projects across the city. Don't think of the plots that they are selling, think of even the projects that they are, construction that they are doing. Now what will happen? If they give it together, they'll manipulate it. What is expected for them? Give it for each works contract. The name and address of the customer and the name and address of the supplier from whom we have purchased. The payment which is received from the customer. And what was the goods, including the quantity. They are not only restricting to description value. They are even talking about the quantity. What you received at that site and what you have used at that site. What is the balance goods lying at that site? Give the list. Give the list. You need to understand that these categories, forget about service provider, manufacturer, special details are very important. Agent special details are very important because GST records will be different and books of accounts will be different. More importantly for a special agent. Works contracted again very important, otherwise a builder will try to give the details consolidatedly and he may try to manipulate. So these are the special details to be maintained by special persons. Apart from the details given above. These are all extra details. These are all extra details. Now, if you recollect, we have discussed initially that there are records to be maintained by few unregistered persons. Who are they? Warehouse keeper and transporter. Warehouse keeper and transporter have to maintain the records even though they are very simple understanding. Why? The goods of the assessee will be going via transporter and warehouse keeper. So they have to maintain separate details. Even if they are unregistered, they have to maintain separate details. So you are talking about warehouse keeper, you are talking about a transporter. Obviously, there will be one more person, custodian, who is having the goods on behalf of other person. Similar to warehouse keeper. Now, warehouse keeper's role is more important. Warehouse keeper will have details of what? Who's the consigner? Who's the consignee? So, when you talk about highways, you'll find out lots and lots of big warehouses. Most of them will be registered. But even if they are registered or unregistered, these details have to be maintained. Extra details have to be maintained. In your premises, whose goods are there? Who's the consignor of the goods? And if the goods are to be sold, consignee is free, also give the consignee name. Who's the consignee? Details of the goods. When it came inside, when it was dispatched from the consignor, what was the movement? When it received and when it is giving. The entire movement details. When consignor dispatched it, when you received it, when you are going to dispose it. All the details should be maintained by the warehouse keeper. And it should be in such a manner that if proper officer in real time is coming for physical verification, real time, he should give the details item wise and owner wise. Think of Flipkart, think of Amazon. They'll be having warehouses having goods of multiple persons. So the goods should be kept, they'll be having racks, rack 1, rack 2, rack 3, rack 4, rack 5. So it should be kept owner wise. It should be kept owner wise. Or also it should be kept item wise. Owner 1 is having dealing with 10 items. So it should be kept item wise. So all the warehouse keeper, Flipkart, Amazon are only examples. It is not necessary that they should be electronic commerce operator. Not mandatory. They can be pure warehouse keepers. Not having any electronic commerce operations. Pure warehouse keeper. Even then they have to maintain the details. Why? They are going to have the goods of multiple persons. So they have to keep owner wise and item wise, so that when officer is coming for physical verification, he will verify. And by the way, please understand that this warehouse will be registered by each of the consignor as their additional place of business. Each of the consignor as their additional place of business. If I am having my goods in a warehouse, where the warehouse keeper maintains my goods and other goods, should I add that place as my additional place of business? Yes, mandatory. I don't have an option. I have to add that place. So why? What is happening? The inspection is coming to me. I might have been asked that what are your goods details and what is the stock? I tell that total stock is 1 crore. When the physical verification is done in my premises, they find only 80 lakhs. I tell that yes, it is 80 lakhs in my premises, 20 lakhs is kept at warehouse keeper's place. So they'll go and verify with the warehouse keeper, and warehouse keeper should be having that information readily available. And transporter at each of their branches, it should give the details of goods being transported, description of goods being delivered. Final transportation is done, goods in delivered, which means starting of transportation and end of transportation. The beginning of transportation and the end of transportation, even goods in transit, along with the GST number of both consignor and consignee, which means both warehouse keeper and transporter are required to maintain the details of consignor and consignee. Transporter surely will have details of consignor and consignee. Warehouse keeper may have only details of consignor, may not have the details of consignee immediately because it is not yet been sold. But when it is sold, he should have the details. When it is sold, he should have the details. Transporter real time will always have the details of consignor, consignee. Warehouse keeper will surely have the details of consignor real time, but consignee, when it is finally dispatched, he'll have the details of consignee as well. He'll have it, but not immediately. Maybe not immediately. So that is the difference when you see. And by the way, if you understand documentation chapter, GTA has to maintain extra details on the invoice called as consignment note. That invoice with extra details on the invoice by GTA is nothing but all these details. Who's the consignor? Who's the consignee? Origin, destination, description of the goods, in which vehicle it is being transported, goods carriage number, and who's going to pay GST, whether the consignor or the consignee or GTA himself. So that extra information will be readily available, not as a separate record. It will be there on the document itself. It will be there on the document itself. Obviously, that is one document. You have to put that in your software and make sure that you get the entire report. You get the entire report. And custodian, who's merely acting as clearing and forwarding agent on behalf of registered person. Custodian is a bit different from a warehouse keeper. He is having limited role. He'll handle the goods on behalf of registered person for a very limited point of time. He is not keeping the goods for custodian for a very limited point of time. Supposing the goods are T estate is there. Auctioneer will be there. That auctioneer will be auctioning the tea, and it might take some few days. So by that time, the goods are under control of auctioneer. He is not acting as a warehouse keeper. For the time being, the goods are with the auctioneer. So that will have the details of all the details of the goods, when it was received, when it is dispatched, true and correct details of the goods which is handled by him, basic minimum details. You might find their details very similar to the warehouse keeper, but it is lesser than that. Basic minimum details, because there it was specifically said that owner wise, item wise, when we come for physical verification, keep it ready. Here, produce the details when required by proper officer. Just basic minimum information that you are acting as custodian or clearing and forwarding agent. When you receive these goods, the goods belongs to whom and when the goods were dispatched. Another difference. Warehouse keeper will be always added as additional place of business by the registered person. But custodian, not always that place will be added as additional place of business by the registered person. Now, when you talk about these special persons, mainly warehouse keeper and transporter, they may be registered, they may not be registered, but these details are to be required to be maintained. If they are registered, no worries. But what if they are not registered? What if they are not registered? If they are not registered, they have to go for centralized enrollment mandatorily. This is not registration, this is centralized enrollment. Registration is state wise, enrollment is pan India wise. Why? Officer tells that the goods movement is all controlled by them. The goods, entire goods movement is all controlled by them. So we should have a track of them. Though they may not be registered, but we should have a track of them. How to track them? If you are unregistered transporter, unregistered warehouse keeper, don't worry. No GST number, don't take it. But mandatorily take centralized enrollment. Centralized, when I tell centralized enrollment, pan India, one enrollment. Pan India, one enrollment. They have to get centralized enrollment by filing a form called as GST ENR 1. They'll get a unique enrollment number which is valid for all the states. It is easier for the officer to have a control. Many times you will see that enrollment number when you are talking about e-way bill number. If the transporter is not registered, when you are filing your part A of e-way bill number, you will not give the GST number of the transporter, you will give the enrollment number of the transporter. Enrollment number of the transporter. This is for unregistered transporter and unregistered warehouse keeper. Now, there is an optional centralized enrollment number for a registered transporter. This option is not for registered warehouse keeper, and once you complete it, you'll understand why it is not there for registered warehouse keeper. They tell that transporter and warehouse keeper, if you are unregistered, mandatorily centralized enrollment. Warehouse keeper, if you are registered, nothing, not required. Transporter, if you are registered, you still have an option. What you can do? You can go for optional enrollment number. Again, the form number is different, ENR 02. Optional enrollment number. Now, you may think when he is registered, why optional enrollment number? This transporter, though is registered in multiple states, multiple GST number, is going for centralized optional enrollment because he will manage all his e-way bills, only through centralized, unique centralized enrollment number. Unique centralized, then the control of all the e-way bills will be at one place. Which transporter will go for it? The transporter which is very high corporate and having high tech softwares, they will go for this unique centralized enrollment number, which is optional because they are registered. If they are unregistered, it is mandatory. Even though they are registered in different states. So if a transport is registered in 5 states, in each of the 5 states, e-way bill will be through that particular GST number, routed through that particular. If they want that all the e-way bills of all the 5 states to be routed through one number, it will be unique centralized enrollment number, which is optional. Now, finally, what are the records to be maintained? Can you maintain electronic records, or can you maintain even manual records? You can maintain manual records as well as you can maintain electronic records. Now, certain special points about manual records. Make sure that there is no cancellation erasement. If at all it is there, please put a valid signature. Manual records can be maintained. No one is asking you, because if you see the definition of records per se, document or records includes written document, printed document, or even electronic document in terms of IT Act. Either it is written, or you have taken the printout, or you keep it in your software, take even printout. So there are certain aspects that you have to understand. If it is manual record, make sure that there is no scribbling. It is neat and clear. If at all you have strike down and you have written something, make sure that corresponding person is putting cross signature that this change happened on my authority, under my control. This is the care that you have to take for manual records. Electronic records. What is the care that you have to take? You have to take proper backup. Tomorrow when office is asking and telling that please give your books of accounts, you should not tell that gone, tally is corrupted, or QuickBook is corrupted, or my SAP is corrupted. You have to take proper backup. Proper backup. Second special point. If at all, department is asking for printout and giving them, take it and give it. Don't tell that I am going by go green policy, I am not going to take printout. Your go green policy will not work though. If department officer is asking you, give us the printout, you have to give a printout after signing all the documents, give them, attest it and give them. You cannot tell just because you are maintaining electronic records, you are not going to give hard copy. If it is asked, give it. Third, certain high-ends or mainly SAPs, there will be a lot of codings that is there, passwords that is there, share everything. You cannot tell, no, these codings are very secret to us, passwords and all will not share. What you have asked, electronic records, take it, now you do your work. No. All the codings, all the passwords, whatever is required, give us. What is required, give us. These are the due cares of all these records that you have to take care of. But both is allowed, manual records as well as your electronic records. That's all about your accounts and records. So when you talk about your audit and assessment, what do you mean by the term audit? Audit means EVA, examination of your records and other documents maintained under this act, verification of the correctness and assessment. EVA, examination of all the records and returns and other accounts maintained under the law, verification of the numbers, be it turnover, taxes, refund, ITC, etc., and assessing the compliance of that particular law. That is your audit. Now, what is assessment? Assessment is a very simple term which is very restricted to determination of your tax liability. Very specific. Very specific. Finding out your tax liability. It includes different types of assessment, be it self-assessment, reassessment, provisional assessment, summary assessment, best judgment assessment. If you see the terms make it evidently clear that assessment has got a very narrow scope and audit has got a very wide scope. Assessment is finding out your tax liability. Self-assessment, reassessment, provisional assessment, final assessment, summary assessment, best judgment assessment, it is finding out your tax liability. Finding out your tax liability. What is audit? Detailed. Examination of all the records and accounts that you have under the law. Verification of the numbers, be it your turnover, be it your tax payable, be it your input tax, be it your refund, and even going to the extent of assessment of your compliance, all other things that you have done properly or not. So audit is a very wide term. Now when you talk about your audit, there are two types of audit that you have. First we'll take a wider term which is your audit. Section 65 audit, departmental audit, and section 66 special audit. Now what has started recently in all parts of India is section 65 general audit. Section 65 general audit. Now why section 65 general audit will come into picture? Commissioner or any officer authorized by the commissioner, either by way of general order or specific order, can ask the officer to do audit of a registered person either at his premises or call him at your premises, which means call him in the department, either at his premises or at the office of the commissioner or the authorized person. Now that general audit can be taken for a particular financial year or a group of financial year or even part of financial year. 1 financial year, 3 financial year, it can be even 1.5 financial years or 2.5 financial years. So general audit is against whom? A registered person. How it starts? By a general or special order given by the commissioner or the authorized person. It will start at which place? At the place of assessee or at the department for which year? Financial year or part or group of financial year. Now who is going to do the audit for that? The auditee is a registered person. Who is going to do the audit? Commissioner or the authorized officer. Audit is going to be done by the commissioner or the authorized officer. But what about special audit? The special audit is very special. Special audits, the name itself suggests, it is because of some difficulty that it has started. Now what is the situation? AC with the prior permission of commissioner. So which means by default it is not happening. Assistant commissioner will take the prior permission of the commissioner. Tells that there is a registered person for whom special audit is required. Why? Because he is already doing some scrutiny, some work is going on already against that registered person. Some work is going on, be it scrutiny, inquiry, investigation, or any of the proceedings. But officer is not able to understand. Now, how to tell he is not able to understand? He tells that the nature of the work is such that it is not possible to find whether the value is properly declared or the ITC is properly availed. That is the complex nature of the work that officer doubts. Value is undervalued. ITC is overavailed. ITC is overavailed. Now, why the special audit comes again? Assistant commissioner is already doing some work, be it scrutiny or inquiry or investigation or any of the proceedings. But he finds the work is such that the nature of the work is such that it is highly complex. He is not in a position to find out what exactly is happening, but he is sure either there is some problem with the valuation, undervaluation, or problem with ITC, over availment of ITC. But because of the complex nature of the work, he is not in a situation to understand. Classic example. All the gaming apps. Right. Gaming apps notices also being served in 42,000 crores and all. Why? Because it is highly complex. They are not in a position to understand what will happen. So what they will do, they will go to the commissioner and tell, let's see, we have done our basic work, but we are not able to conclude finality. We are not able to arrive at a conclusion. Please help us. Now what commissioner will tell? Commissioner will tell, don't worry, I am there for you. He'll tell that I'll appoint a CA or CMA and I'll ask him to do the special audit. And a very important point for special audit may be done even if general audit is already over. You cannot tell that no, general audit was already over. Now why suddenly special audit? Even if general audit is already over, even if your income tax audit is over, forget about that. Special audit can still be started. So the situation which is there is discussed. Now whether there will be any fees for officer doing his own departmental audit or general audit? No, there won't be any fees. But whether there will be any fees for special audit which is done by CA, CMA under the instruction of commissioner? Yes, it will be determined and paid by the commissioner, and that amount will be final. Now, what is the time limit which are there in your general audit? Section 65 general audit. So there is an advance notice that will be given to you. So how it will start? It will start with a advance notice. 15 days minimum notice will be there that we are going to come for your audit. Keep all these details ready. They'll give the list of the details and they'll give even the contact details. This is our mail ID. This is our phone number. Please contact us for any doubts. Keep all these details ready. Minimum 15 days notice will be given, and audit needs to be completed within 3 months plus 6 months extension by the commissioner. 3 plus 6. But what is the starting point? The starting point is when they actually start the audit, or when all the accounts are made available to them. The time limit of 3 months plus 6 months will not start from the time limit which is mentioned in the advance notice. It will start when they might have said that we'll be coming on so and so date. 99.99% they will not come on that date. They'll come later. Because they'll be doing audit at different places as well. So if they are coming late, that time limit of 3 months plus 6 months will start from that, subject to you have made all the accounts records available. If they start the work but they find that balance details are yet to be given, then it will start when even all the other details are given. Put it in simple words. Actual starting of audit or all the records made available, whichever is later, from that time calculate 3 plus 6 months. Now here, what is the time limit for the CA, CMA to complete the audit? It will be 90 days plus 90 days. See, who is doing the work here? Officer. 3 months plus 6 months. Who's doing the work here? Be proud. 90 days plus a 90 days extension given by the commissioner on the request by the auditor at times suo moto. At times suo moto because of the material insufficiency. AC himself tells 90 days is not sufficient. Please extend it to the another 90 days. Generally, the request will be made by the auditor, that is CACMA, to ask for extension. At times, commissioner will suo moto extend it because of the sufficient reasons. So 3 plus 6, 90 plus 90, 90 plus 90. So when you talk about the audit report, general audit, section 65 audit is a friendly audit. It's a friendly audit. Proper officer will share all the discrepancies to the registered person and ask for his reply. He'll tell that these are my observations, please reply. Final audit report will be done after the reply is given. Within 30 days of completion of audit, auditee will be informed about the findings and what actions he can take. So first there will be a draft audit report, then there will be a reply by the registered person, then there will be final audit report, then there will be final audit report. Within 30 days, this should happen. Everything should happen within 30 days. Draft audit report, reply and final audit report. And in the final audit report, they will tell that these are my findings and these are the actions that you can take. It is not necessary for the assessee to make the payment of taxes. Then the next step officer will do is give notices. Right. Now, that will even complete here itself. The follow-up action for the officer will be giving a notice under section 73-74. This itself will not create a liability. The audit report finalized by the officer will not create a liability. The final action will be again give a notice under section 73-74. Again, there will be an opportunity given to the assessee for explaining his point of view. Audit report, though it was discussed, though there was a draft audit report, reply being shared and final audit report was given, that doesn't mean that it becomes an order. Again, officer has to start from notice level. Section 73 notice or section 74 notice, then PONJ, principle of natural justice, then finally the order. Here, just tell me why the special audit started. It started because AC was having a difficulty to do the work that he was doing, scrutiny, audit, inquiry, investigation, something. So what will happen on the completion of audit report, which is duly signed by CACMA, will be given to the assistant commissioner, also the assessee, also the registered person. He will be also shared. It is not only to assistant commissioner, even the registered person also will be shared. Now, why it is mainly shared to assistant commissioner? Because assistant commissioner can complete the work which was pending, complete the scrutiny, inquiry, investigation or any other proceedings that was there, and finally when he arrives at a conclusion, he cannot give the final order. He has to discuss his observations with the assessee and give the final order if at all it was at notice level. If at all it was at notice level. CACMA will give the report to whom? AC and registered person. But he will not discuss anything with the registered person. Now, the case will go back to AC. AC will complete this pending work. Be it scrutiny, inquiry, investigation or any other proceedings, whatever work was pending, he'll complete his work. But when he's completing his work, just because there's an audit report by CACMA, he cannot decide on the decision. He cannot finally arrive at a decision. He will tell that this was the audit report shared by CACMA. This is my final understanding. You please explain your point of view, principle of natural justice, and then finally, if at all it is at a notice level, then finally I'll give you an order. So that is all about your general audit or department audit under section 65 and special audit under section 66. Now let us talk about the different assessments that you have. First is a case of self-assessment. All the tax laws that you see now are all going on the concept of self-assessment. So when you talk about self-assessment, you have to read section 59 read along with section 61. That will be scrutiny. What is self-assessment? Registered person. By the way, both the audits, general audit and special audit, was only against registered person. Was only against registered person. So even when you talk about self-assessment, it is all against registered person who has self-assessed the tax and filed the return. Now officer, he might find some discrepancy. He might think that there are some details which is not given correctly. So he'll inform the discrepancies. What assessee has to do? Either accept discrepancy or correct them, or offer explanation within 30 days plus extension. He has to take an action within 30 days plus extension. What possible actions will be there? First possible action, he is accepting and correcting the mistake, the chapter is closed there. If he is giving an explanation which is okay for the officer, nothing will be taken ahead. If he is giving an explanation, if he is accepting the difference, he is telling that yes, there is a mistake, I am ready to rectify my mistake, nothing will happen. See, within 30 days, what is required to do? Either accept the mistake, close the chapter, pay and close the chapter, or give explanation. If he is accepting the mistake, paying the dues, the chapter is closed. If he is giving an explanation, officer satisfied, chapter is closed. When issue starts, if he is not accepting his mistake, he is telling that there is no mistake. If he is offering an explanation which is not found to be acceptable, or if he is not taking any action, neither reply nor acceptance or discrepancies is accepted, but he is not correcting in the next month. All these means that he is not ready to go ahead. Either he did not give any reply, or his reply was not satisfactory, or he accepted that there is a mistake but he is not correcting it. But he is not, what officer will do? Officer, please understand that audit and assessment will not create liability per se. Thumb rule of audit and assessment, it will not create liability. Now officer will take further action. Officer may go for general audit under section 65, special audit under section 66. He may start inspection under section 67. He may directly give notice under 73, 74. Rather, you need to understand, even if he is going for general audit or special audit or inspection under section 65, 66 or 67, again he has to come via route of section 73, 74. Either directly he'll give notice under section 73, 74, or first he'll do his groundwork. Section 65 audit or section 66 audit or section 67 inspection. Collect more information. Collect. Then start with notice. 73, 74 notice. 73, 74 notice. That is all about your self-assessment and scrutiny of returns in terms of section 59 read along with section 61. Now you are talking about your provisional assessment and final assessment given in your section 60. Now when assessee will opt for your provisional assessment, when he will think of provisional assessment, only two reasons. Only and only, he is not sure of the value, he is not sure of the rate. Assessee is having doubt with valuation or doubt with classification. He is not sure. Is not sure of the valuation or the classification. But this time they have used the term taxable person. Taxable person. Now what he'll do? He'll make an application to proper officer for doing provisional assessment. For doing, he'll tell officer, you decide. Officer, I have doubt with my value, you decide. Whether the subsidy given by holding company should be added because it is not a subsidy linked to the price, it is a general subsidy. Now you decide. Now you decide. Proper officer will do provisional assessment. And he has to do provisional assessment quickly. Within 90 days of the request. Within 90 days of the request. He'll decide a rate or he'll decide the value. Let us assume that assessee is having doubt with 5% or 12%. Now you might wonder why the term taxable person is used. It can be a case where he is having doubt whether it is 0% or 5%. 0% or he is not registered, thinking that it is 0. But he is having doubt. It might be 0, it might be. Therefore, in section 65 audit, registered person. 66 audit, registered person. Self-assessment, scrutiny of returns, registered person. Suddenly you find here the term taxable person. Taxable. Now let us assume that he is having doubt with respect to say 5%, 12%. Officer may tell that provisionally, as of now, you go with 5%. As of now, you go with provisional assessment is on lower side or higher side. Whenever it is on lower side, you have to give a bond. You have to give a bond along with surety or security. Now, in GST as well as customs, what is preferred is only security, not surety. And the security value should be less than or equal to 25%, which means if the difference is between 5% and 12%, if the difference is coming, say, to the extent of 70,000, in terms of tax, it is coming as bond value will be 70,000. But security will not be 70,000. It will be 25% of 70,000. Your promise, your written promise will be 70,000. But your security paper will be, security generally preferred security is bank guarantee, BG. BG will not be for 70,000. It will be for 75,000. 70,000 multiplied by 25%. Whether this issue will come when provisional assessment is on higher side. If provisional assessment is on higher side, say in our example, say 12%, lower side, say 5%. If it is on higher side, there is no question of any bond. There's no question of any bond. Obviously, there's no question of any bond. Why? He has paid the higher value. There's no risk to the government. There's no risk to the, so there is no need of bond. Provisional assessment will be done, but understand that officer did it in haste within 90 days. Now, finally, officer is required to do final assessment within 6 months plus another 6 months extension by joint commissioner, additional commissioner plus another 4 years extension by commissioner from the date of provisional assessment order. From the date of request, 90 days, provisional order. From provisional order, 6 plus 6 plus 4 years. 6 months plus 6 months plus 4 years. From the date of provisional assessment order. Which means they can decide finally, they can take easily 5 years to decide a final assessment order. But normal time limit for them is 6 months. If they want to extend it for the next 6 months, go to higher officer, JCAC, Joint Commissioner, Additional Commissioner. Additional, not assistant, Additional Commissioner. They want to extend it for another time. After 1 year, go to Commissioner. He will extend the time. He will extend the time. Now, there are multiple situations or scenarios possible. Let us focus on the examples and try to understand it very quickly. If provisional assessment was at 5%, final assessment is also 5%. Nothing to worry. You have paid 5%, finally it is 5%, nothing to worry. You have given a bond, that will be cancelled. You have given a bond, that will be, if your provisional assessment was at 12%, final assessment is also at 12%, nothing to worry. Bond was never given. There's no question of any cancellation of bond. So if it is 5 and 5, it is 12 and 12, nothing to worry. But if it is 5 and 5, initially you gave bond because it was on lower side, now you are going to cancel the bond. If it is 12, 12, nothing to worry. Bond was never given, there's no question of any cancellation of bond. But what if provisional assessment was at lower side? Provisional assessment was at lower side. Provisional assessment was at 5%. Final assessment is 12%. Or what if provisional assessment was at higher side, final assessment is at lower side? What will happen in the first case and what will happen in the second case? In first case, provisional assessment 5%, you have paid 5%, but finally you have to pay. Should you pay? Yes. Should you pay? Yes. So that is a tax that you have to pay along with interest. Interest will start from where? Interest will start from where? Interest will start from the date tax was originally due. Assume that this transaction pertains to April 2023. Transaction pertains to April 2023. And final assessment order, assume that it has gone to commissioner, is given in somewhere April 2027. April 2027. You have to pay interest. Yes. Interest has to be paid at 18%. So that will be differential amount. Differential amount in our example, let us take 70,000 multiplied by 18% per annum multiplied by the number of days of delay. For April month, what was the due date of payment normally? So it will start from 21st of May 2023 till the actual date of payment, which will be somewhere in 2027. Somewhere. If after you get final assessment order, you can pay immediately or you can take 1 month time and all. So it will be somewhere in 2027. Imagine 4 years. Imagine the interest will be for 4 years, 72%. If the tax amount is 1 lakh, you are going to pay interest of 72,000. Interest of 72,000. So that is the difficulty in provisional assessment. Though you are a genuine assessee, though you went for provisional assessment, there's no relaxation in interest. There's no relaxation in interest. Are we clear with this understanding? Are you guys clear with this understanding? Interest will start from the actual due date of payment till the actual date of payment. But what if it is the other case? What if it is the other case? Refund. What was the other case? It was the case of refund. You are paid 12 but you have to pay 5. Now you are going to get a refund. You are going to get a refund. Refund is always subject to doctrine of unjust enrichment, which means that you should not have passed on the burden. If you pass on the burden, you will not get the refund in your pocket. They will take in consumer welfare fund. If you want to get the refund in your pocket, make sure that the burden was not passed, or if it was passed, you reverse the burden. You reverse the burden. Now refund, when you get refund, will you get interest? Yes, they are very clear that we'll have equal policy. But how far equal policy is there? Let us see. Interest will be what percentage? That differential amount, interest will be there when it is refund. When it is refund, that differential amount, interest will be there. At what percentage? When government gives you interest, it is 6%. Wait. Starting from which date? After expiry of 60 days from the, not after expiry of 60 days from final assessment order. What was our understanding? The transaction pertains to April 2023 and final assessment order came in April 2027. The transaction pertains to April 2023. Then you will apply for refund application. After that, 61st day will be the first day for interest. So interest will be given, but what amount? You decide. The amount for interest will start from date from the 61st day of refund application. After 61st day of refund application till the date of actual refund given by the government. Till date is always simple. From date is the question. From date is the question. 61st day. Comparatively, the rate is reduced. The period is also reduced. 18 is reduced to 6. Period is drastically reduced. Somewhere in most of the cases, if government is giving you refund within 60 days, no interest. If government is giving you refund within 60 days of your refund application, there's no interest. There's no interest. So that is all about your provisional assessment. Now, general audit, registered person. Special audit, registered person. Self-assessment, scrutiny of returns, registered person, but provisional assessment, taxable person. Best judgment can be against registered person, also against unregistered person. Registered person, also again unregistered person. Against registered person. Against registered person. Why it will start? You're talking about a scenario where you have not filed your returns. You have not filed your returns. First step is you have not filed your returns. Then what officer does? Second step. Officer gives you notice under section 46 to file your return within 15 days. First step is you did not file your returns. Officer gave you notice under section 46 to file your return within 15 days. Even after getting the notice, you did not file your returns. You did not file your returns. Then officer can start best judgment assessment under section 62, which is against registered person, within 5 years from the due date of annual return of that financial year to which the liability pertains. The time limit for doing best judgment assessment against registered person is 5 years. 5 years from where? From the due date of annual return of that financial year to which the liability pertains. Very well. Second opportunity. First opportunity was given to you. You did not file your returns. You got a notice under section 46 to file within 15 days. You did not file. Then they will start best judgment assessment. Now understand that when officer starts best judgment, it is very dangerous. Best of the judgment means whatever he thinks he'll put. Now they give a relaxation. If at all assessee is not satisfied with the best judgment assessment order, he can file his returns. He can file his returns within 30 days of the best judgment assessment order, pay the taxes along with interest and late fees. Best judgment is deemed to be withdrawn. Automatic withdrawal. You need not do anything. It is deemed to be, which means you are getting a second opportunity. First, you got a notice under section 46 to file your return within 15 days. You did not file. Then they started best judgment assessment, which they have time till 5 years from the due date of your annual return. If they have started, even after doing best judgment order, which is you, the moment you see the best judgment order, you're surprised. The liability there runs in hundreds of crores. Your turnover has never crossed 1 crore. But the liability there is hundreds of crores. What do you do? Don't worry. Don't worry. File your pending returns within 30 days of best judgment assessment order. Pay the tax, interest, late fees, everything. Automatically, the best judgment assessment order is withdrawn. The purpose of best judgment assessment order here was you're not filing your return. You file your return, okay, no worries. Automatic withdrawal. You need not even inform the officer. Technically, practically, better to inform the officer. Technically, you need not even inform the officer. Automatically, the best judgment assessment order is withdrawn. This is best judgment against registered person, section 62. Now it is best judgment against unregistered person, section 63. Now, best judgment against unregistered person will start because of two reasons. Either, in both the cases, you are a fraudulent person. You are liable for registration, you did not take the registration. You took the registration, but you are doing fraud, proper officer cancelled your registration. You are liable for registration, you did not take the registration. You are unregistered. You took registration, doing activities which is not allowed in terms of section 29. Proper officer suo moto cancelled the registration, which is totally possible in 14 cases. Totally 14 cases, proper officer can suo moto cancel the registration. He has cancelled your registration. He has cancelled your, but cancellation of registration will not relieve you from your liability. Just because registration is cancelled does not mean that your tax liability is not there. Still your liability will be there. Now, what will happen? What will happen? Proper officer initially will give you a notice telling that I am going to start your best judgment assessment. Unregistered, and the same time limit is the same. 5 years from the due date of annual return to which the liability pertains. So he'll initially give a notice. There will be reply by the person, and finally he'll pass the why reply, because best judgment assessment is based on the records and facts available. So assessee might try to give some records and facts. Thereafter, proper officer will pass best judgment assessment order under section 63. Under section 63, telling that this is the final assessment. Please understand, unlike your best judgment under section 62, there is no concept of withdrawal. Now, which type of persons are we talking about? Fraud persons. They were liable for registration, never took registration. They took registration, but proper officer suo moto cancelled the registration. So here there is no concept of withdrawal of best judgment assessment order. Once it is done, it is final. All you can do is go and challenge in appeals. Now, normally, what is the steps to be followed for best judgment under section 62? Is a theoretical point. They are telling that department should give reminders for filing your notice. Then if you don't file your notice, then they'll give a notice, file within 15 days. Then after 15 days, again they'll give you notice for best judgment. If you don't reply, they'll give you best judgment assessment order. Then within 30 days of best judgment assessment order, you can again file your returns. It will be withdrawn. But if you don't do that, then 73, 74. Then officer will proceed with 73, 74. So this is entirely explained. I mean, the recovery will happen in 70, not 73, 74. By the way, one small catch here. When you talk about your best judgment and summary assessment, it is different from other audits and assessment. It is different from other audits and assessment. How it is different? In audit and other assessment. What was other assessment? Your self-assessment, scrutiny of returns and provisional assessment, final assessment. In all these cases, the follow-up action was 73, 74 notice. Finally. But in best judgment assessment and summary assessment, finally it is the order. Finally it is the order. Just few minutes back I was telling that if you don't like it, please go for appeals. Please go for appeals. Both are highly dangerous. This is not only true for best judgment, also true for summary assessment. That is the final order. If you don't like it, go and challenge in your appeals. Go and challenge in your appeals. And finally, you're talking about a more dangerous assessment. If you think that best judgment assessment is a dangerous assessment, there's something called as more dangerous assessment, which is a summary assessment, which is a summary assessment under section 64. Now, against whom this summary assessment will be started? Proper officer has evidence to believe that a taxable person has incurred the liability, and he has sufficient grounds to believe that if at all he is going by normal route of section 73 notice, section 74 notice, then passing the order, this person will run away. This person will run away. So, what are the two criteria for starting this dangerous assessment? Proper officer is having evidence, not reasons to believe. Normally, you will find the term reasons to believe. This time, the term is evidence that there is a liability on that person. There is a liability on that, and he is very, very, very clear. If at all he is going by normal routes of section 73, 74, government is going to lose revenue. It is adversely impact the revenue, which means he is going to run away. In a very simple language, they have not used the language run away. In a very simple language, they are trying to tell that this assessor will run away, like all the persons who have run away from India. So what to do now? What to do now? Now what will happen is, he will give a summary assessment order. This is the first step. Second step, summary assessment order. He will go and take the permission of additional commissioner and joint commissioner. First two criteria are satisfied, then the third criteria. He will go and take the permission of a higher officer because he is doing something which is very serious. Additional commissioner or joint commissioner. Then he will give directly a summary assessment order. Summary assessment order. Normally to a taxable person, at times to deemed taxable person. At times it will be given to a deemed taxable person. Deemed taxable person. There are 4 hidden deemed supplies. First, when you're talking about if the goods are found in a place where proper accounting is not there, it is deemed to be supplied. It is deemed to be supplied. Second, sale on approval basis. If acceptance rejection does not happen within 6 months, it is deemed to be supplied. Third, in job worker case, if the goods given to job worker does not come back within 1 plus 1 year extension, 3 capital goods, 3 plus 2 years extension, it is deemed to be supplied. Fourth, this place where you're talking about, there's a taxable person whom liability pertains is not ascertainable, which means he is not found. He is not found. Such liability pertains to supply of goods, which means you are talking about dealing only with goods. The person in charge shall be deemed to be the taxable person. In simple language, they are talking about warehouse keeper and transporter. Both these people, they are having the control over the goods. Now, officers are telling that, tell me whose goods they are. But they are not opening their mouth. They are telling that no. We are going to get a good amount if you don't really reveal the name of our owner. So we are not going to tell these goods belong to so and so company. Now, officer can tell that, okay, if you are not sharing the details of the taxable person to whom the liability pertains, we will treat you as deemed taxable person. And the goods that are kept here, it's deemed to be supplied by you. You face the consequences. And the consequences are directly, straight away, very dangerous consequences. Summary assessment. Right. Normally, it is against a taxable person. Normally, you will find this against only a taxable person. At times, it will be against a deemed taxable person. Why? Warehouse keeper, transporter. If you read this again and again, you will find that they are talking about whom? Person in charge means whom? Warehouse keeper and transporter are not disclosing the identity of the real taxable person. They will be deemed to be taxable person of the goods. And when you talk about warehouse keeper and transporter, will they deal with any services? Obviously, it is only goods. And the goods that they have in their control will be deemed to be supplied by them. Though they are not supplied, but it is deemed to be supplied by them. And Not only that, they'll face the dangerous consequences directly. There will be a summary assessment order. Summary assessment against which the only remedy is appeals. The only remedy which is available is appeals. Now, understand that concept of summary assessment is over, but they give a relaxation. At times, this action of summary assessment is taken by the officer because of grudge against the assessee. And understand, summary assessment is so rare that throughout the lifetime experience of an officer, he might never have used it. He might have used all the other things, but he might never have used it. So it is very rare. And if it is against the company's reputation is at stake. It clearly means that if I am the officer, if I am initiating summary assessment against a company, it means that I am trying to tell that this director or the managing director is going to run away. It's not a normal assessment where the company will easily say, okay, we'll take care, we'll go for appeals and all. So what will happen? What will happen? Such companies will make an application for withdrawal of summary assessment order within 30 days. Now understand that this is not automatic withdrawal like best judgment assessment under section 62. They have to make an application. They have to make an application to JCAC. Who started, by the way? Officer started by taking permission from JC, Joint Commissioner and Additional Commissioner. The assessee will make a request to Joint Commissioner, Additional Commissioner, telling that, see, I am here. You see my past performance. You have given me tens of notices. To all the notices, I have replied. Either the matter is closed, or I have paid the dues, or the matter is pending in appeals. I have never run away. Therefore, you allowing your officer to start with summary assessment is not fair. It's not. Withdraw the summary assessment order. Ask him to come via normal routes. AC, Additional Commissioner, Joint Commissioner will understand it. Either on its own motion. At times, Joint Commissioner, Additional Commissioner will be afraid. Okay, they have started summary assessment against Reliance Limited. JCAC, when he signed, he did not see the company's name. Now finally he realized that okay, it is against Reliance Limited. On his own motion or on receipt of application from Reliance Limited, he'll tell the officer, you come. Why the hell you started summary assessment? You have normal procedure. Go with section 73, 74. Go with your section 73, 74. That is summary assessment. That is summary assessment. But mind you, this withdrawal of summary assessment order is not automatic, though you might find that 30 days similar. This 30 days similar. In case of best judgment assessment order against section 62, if you file your returns within 30 days of best judgment assessment order, automatically best judgment assessment order is withdrawn. But summary assessment, if order is received, it is not automatically withdrawn. You have to make an application within 30 days. A Joint Commissioner, Additional Commissioner should be satisfied that yes, this summary assessment was not the right action. Officer should have followed the normal process of 73, 74 and asking him to go by normal route of 73, 74. Right. Now, what are the differences that you clearly find? All the other audits and assessment, the follow-up action is 73, 74. At least the final follow-up action is 73, 74. In between, you can also try other things. Audit, inspection, etc., etc. But the final follow-up action is 73, 74. But. Summary assessment, best judgment assessment, directly it is an order. You don't have 73, 74 coming in picture. Directly it is an order. The only thing that you can do is go for appeals. First. Second thing, all the audits and assessment are generally started against registered person. What are the differences? First, provisional assessment, taxable person. Second, best judgment assessment against section 63. It is unregistered person, basically taxable, liable for registration or suo motu cancellation. And third, summary assessment. Summary assessment. They don't use the word registered person, they go with taxable person. They go with taxable person. So that's everything about your different types of assessment and different types of audits under your GST. So when you talk about demand and recovery, the first part is your demand, basically starting at section 73, 74, 75 a common provision, 76. The first part is all about your demand. Then we'll have recovery. So when you talk about your demand, it is basically section 73 and 74. You will first get a show cause notice followed by a demand order. So the sequence of that would be proper officer will be first giving a show cause notice under section 73 if it is a bona fide case. Show cause notice under section 74 if it is a mala-fide case to the assessee. Now what is a bona fide case? What is a mala-fide case? If at all you are talking about a scenario where show cause notice is given for any reason other than fraud, misrepresentation or willful misstatement, then it is a bona fide case. If show cause notice is given because of fraud, willful misstatement or suppression of facts with an intention to evade tax, then it is a fraudulent case. So you are going to get a notice. By the way, the notice will have 5 reasons, whether it is 73 or 74. Either the first point would be tax not paid, or tax short paid, or tax erroneously refunded. Non-payment, short payment, erroneous refund. Taxes. Then ITC. Wrongly availed, wrongly utilized. So there are 5 reasons for you to get the show cause notice. Non-payment, short payment, erroneous refund, availment, wrong availment of ITC and wrong utilization of ITC. And for these 5 reasons, you can get a notice either under 73 bona fide case or under 74 fraudulent case. Now understand that suppression of facts, which is one of the fraudulent case, non-declaration of a fact which is required to be declared in anything, whether written statement or report or any other document, or not providing an information asked by the officer, that is meant by suppression of facts. 2 things, either you are required to give it but you do not give, or you are called for giving that information but you did not give. That is suppression of facts. Willful misstatement is wrong. You have said something which is clearly wrong. Suppression means silence. You are asked but you did not give. You had to give but you did not give. That is suppression. Now, when you talk about this show cause notice, assessee can either represent himself or via authorized representative, being assessee himself or advocate, CA, CS, CMA or retired officer or GST practitioner. Right. And he will be given maximum 3 judgments. Obviously, the moment you are talking about notice and order, there will be opportunity of being heard. Finally, you will get an order. After notice, you are going to get an order. So when you are going to get an order cannot be on certain things, certain important points of orders. Order cannot have new grounds. The grounds that are raised in notice can be the only grounds. Order cannot have a new ground which was not raised in show cause notice. The amount in order, basically the tax amount in order cannot be more than tax amount therein show cause notice. So 2 important points. Your order cannot have new ground. The tax amount in order cannot be more than the amount in show cause notice. What about interest and penalty? They are all automatic. Interest is mandatory. Even if it is not mentioned in the order, you have to pay it because it will keep changing. Penalty will differ based on which category you are falling. Tax amount should be there in order, and that tax amount in order cannot be more than the amount in show cause notice. Now there is something called 2 special points about your notice. One, something called as deemed show cause notice and something called as change of show cause notice. Now what is this deemed show cause notice? If at all a show cause notice for a old period is already issued and subsequent period you find the same matter being repeated. It's not about the fraud case. It is a genuine bona fide case. Then, instead of giving a detailed show cause notice, you can just give a statement and tell that refer the earlier show cause notice. What are the criteria? There's already show cause notice which is given, already proceedings which is happening. It is not ended. It is in process. process. And on the same grounds, exactly same grounds, you want to extend the period. You want to extend the period. It should not be a fraudulent case. Because for fraudulent case, you have to give another notice. You want to extend the show cause notice. The notice is for 1 year, you want to extend it for 2 years. Because while investigating, you found that the same issue is that for the other year as well. So what you can do? Either again draft a detailed show cause notice or a simple manner. Give a statement. Give reference to the earlier show cause notice. It will be called as deemed show cause notice. Deemed, but make sure that even the statement should be within the time limit. Even the statement should be within the time limit. So that is very clear. There is no relaxation for the time limit. That is the first part. Now the second part. Here is officer started this matter as a show cause notice under section 74. Finally, it was decided by appellate authority, appellate tribunal or high court or supreme court that there is no fraud involved. Therefore, basically prima facie, the moment they tell that, it means show cause notice is void ab initio. But the provision tells that even though we started with a show cause notice, treating it as fraudulent show cause notice, section 74, later on it was held by appellate authority, appellate tribunal, high court or supreme court that it is not a fraudulent case, it is a bona fide case. The same show cause notice is still valid, but treated as a show cause notice issued under section 73. The period which was covered will be reduced. It was covering say last 4 years, now it cannot cover last 4 years, it will automatically get reduced. Why? In bona fide case, you cannot go back up to 2 years. I mean, the time limit for giving show cause notice is 2 years, 9 months. So that period will be automatically reduced. You might have taken the case for last 4 years, but now the period will automatically get reduced. The good news is for the department is the show cause notice is still valid. Treat it as a show cause notice under section 73. Though you would have initially taken an action for say last 4 years, but now it will not be valid for the last 4 years. It will be valid treating it as a show cause notice under section 73. Accordingly, you have to reduce the coverage of the show cause notice. Reduce the coverage of the show cause notice. So that is change in your show cause notice. Now, certain special points. There is no need of show cause notice and there is no need of demand in two special cases. This is given here. It's also given in the next page. There is no need of notice and order in two cases, which means there will be directly recovery under section 79. Direct recovery. What are the two cases? Where you don't require any notice and all. Notice and order. If at all it is a self-assessed tax which is not yet paid. This is clearly self-assessed tax, but you have not yet paid. Or if it is interest. Or if it is interest payment, which you are liable but you are not paying. Lot of assessees don't pay interest, they wait till the notice coming. The notice can come up, there is no need of notice. You can be asked this amount even after 10 years, 15 years, 20 years. There's no time limit. And also importantly, there will be no notice. They'll directly recover it. For self-assessed tax which is not yet paid, plus for interest. Two important things. No need of notice and no need of order. No time limit. Now, self-assessed tax which is not yet paid will include a scenario where you have declared the sales in GSTR 1 or IFF but not declared in GSTR 3B. You have declared that in GSTR 1 or IFF but not declared in GSTR 3B. So that is an example or classic scenario which is covered in self-assessed tax which is not yet paid. Now, talking about the other aspects. Now, first let us discuss about the time limit for issuing show cause notice. Time limit for issuing demand order. What is the time limit for issuing show cause notice and time limit for issuing demand order? If it is a section 73 case, first you will be giving show cause notice. What is the time limit for giving show cause notice? 2 years, 9 months from relevant date. 2 years, 9 months from relevant date. What is the time limit for giving order? 3 years from relevant date. For notice it is 2 years 9 months. For order it is 3 years. What is that relevant date? If it is a case of erroneous refund, relevant date is date of erroneous refund. If it is any other case, that relevant date is due date of annual return for that financial year. See, relevant date is basically due date of your annual return. Due date of your annual return. Put it in simple terms. If it is financial year 23-24, what is the due date of annual return? 31st of December 2024. From that time, 2 years, 9 months, you can give show cause notice. 2 years, 9 months, you can give show cause notice. Within 3 years, you can give demand order. So, notice should be given within 2 years, 9 months, and order should be given within 3 years. From which time? For financial year 23-24, this 2 years, 9 months, and 3 years will start from 31st December 2024. But if it is a case of erroneous refund, 2 years, 9 months, and 3 years will start from the date of erroneous refund. Will start from the date of erroneous refund. Right? So, for financial year 23-24, what is the time limit for giving show cause notice? Entire 2025, entire 2026, then 9 months, which means 30th of September 2027. 30th of September 2027 is the last date for giving show cause notice. 31st of December 2027 is the last date for giving order. Assuming it is a bona fide case. Assuming it is a bona fide case. What if I tell it is a fraudulent case? For show cause notice, 4 years, 6 months from relevant. What is the relevant date? Normally, it is due date of annual return. For erroneous refund, it is the date of erroneous refund. What is the last date for giving order? 5 years from relevant date. What is relevant date? Normally, it is due date of filing annual return. Erroneous refund, in case of erroneous refund, it is the date of erroneous refund. So, for financial year 23-24, what is the last date for giving notice under section 74? From where? Assuming it is a normal case. 23-24 means annual return due date is 31st December 2024. From that, 4 years, 6 months. Entire 25, entire 26, entire 27, entire 28. 30th June 2029 is the time to give show cause notice. 31st December 2029 is the time to give order. Is the time to give order. That is the time limit to give notice and order. Now, in that time limit, what are you going to add? What are you going to add? You are going to add the stay period. The stay period on the notice and the stay period on the order. Whenever there is a stay period, your hands are tied. You cannot do anything. Can you? No, next question will be that. So, can we take stay on the notice? Yes. You can take stay on the notice, you can take stay on the order. Stay is not always on the order. The moment you get to know that this officer is going to give you a notice because of the grudge he has against you, you can go to courts and take stay on the notice also. So, stay period is excluded. Stay period is, so don't go with this exclusion and all. Calculate the time limit that you work out. 2 years, 9 months, 3 years, 4 years, 6 months, 5 years. Calculate normally. Add stay period. Add stay period. So, what you do? Better calculate the normal time limit. Then add stay period. Add stay period. Very simple way. Stay period of notice is added. Stay period of order is added. By the way, the moment stay on notice is given, there is no question of order. So, either the stay of notice for giving notice, and if the stay is removed, then you can give order. If at all the notice is given, but order cannot be given. That's a stay on order. So, you are going to add stay period on the order for giving, for calculating the time limit for giving the order. Stay period is added back. Stay period is added back. Now, one thing is that only in case of order, it is not there in the case of notice. Let us first understand that, which is discussed elsewhere as well. If at all, there is an issue on which appellate authority or appellate tribunal or the high court has given its decision, which means the matter is already pending, but not for your case. It is pending for some other case, some other proceedings, not for the company's case, but for some other company's case. Who has decided? Appeals. Either first appeals or second appeals or third appeals. Either first appeals or second appeals or third appeals has decided. And if first appeals has decided, the matter is pending in second appeals. If second appeals has decided, the matter is pending in third appeals. If third appeals has decided, the matter is pending in the last appeal, that is Supreme Court. Right? And an appeal against that has been preferred to the next level. If it is order of appellate authority, appeals at appellate tribunal. If it is order of appellate tribunal, appeals is at High Court. If it is the order of High Court, appeals is at Supreme Court. This point we have already discussed. It is an indirect stay. It is an indirect stay. Now, the period between the order of these two things, which means first appeals order to second appeals order, or second appeals order to third appeals order, or third appeals order to last appeals order, or directly first appeals order to last appeals order if the matter is going to go till Supreme Court. That you have to add back. But this adding back of which we call it as indirect stay is only for order, not for notice. It's not for notice. Read it carefully. And this we practically experience when we see in our practice. So what will happen? They will open the show cause notice. The same is pending. They know that this issue is already pending in some other company's case at higher appeals. But they have to open the show cause notice. They have to open the show cause notice. So what they will do? They will issue show cause notice and keep in a book called as log book. Log book. Obviously not find in an isometal. Practically they'll keep it in a log book and they'll refer it that this is pending. The order is not being issued because similar matter in some other company's case is there at higher level. By the way, who are we talking about? We are talking about adjudicating authority. All the appeals authority are higher than this adjudicating authority. Can this adjudicating authority pass an order? No. Though it is not for this company's case, it is for some other company's case, same issue. What they'll do? They'll give notice, keep it pending, keep it in log order. So notice to be given mandatorily. But order will be on hold. And that hold is because there will be an extension in time limit for passing the order. There is no extension for notice. You have to give notice on time in such cases. But you can wait and give order leisurely after that some other company's case appeals is decided. So this extension is only and only for order, not for show cause notice. Not for show cause notice. Now, the moment you are not following these limits, you cannot give any show cause notice and all. Forget about show cause notice and all. If at all these limits have gone, nothing can be done. Nothing at all. All the limits that we have discussed, if these limits have passed, they cannot do anything. Though that's a clear-cut liability against assessee, they are not in a position to do anything. Now, one more special point, where any order you are required to pass because of the direction of appellate authority or appellate tribunal or high court or Supreme Court, which means you are not interested in passing the order. You are passing the order because of the direction of appellate authority or appellate tribunal or high court or Supreme Court, then that order should be issued within 2 years. That is special time for order. Then that order should be issued within 2 years. Notice was already opened. Notice was already opened in time. But you have passed an order for a particular amount. Now appellate authority, appellate tribunal or high court or Supreme Court has increased that amount. You are going to now increase that amount because of the order of appellate authority, appellate tribunal, high court or Supreme Court. For that extra amount, you have to convert that into order within 5. See, notice was only for 1 crore. You are in a position to give order only for 1 crore. Now appeals have increased the amount. Again, you have to give an opportunity. So they are telling that because of higher authority is happening, within 2 years, for the higher amount also convert that into order. So that is given here. Now, all the other small aspects and more importantly, the penalty aspects. 73, 74, all the important aspects we have discussed except for the penalty aspect. So what will happen with your penalty? Please understand that for understanding penalty, you split your timeline into 4 cases. Before show cause notice, within 30 days of show cause notice, after 30 days of show cause notice, but within 30 days of demand order. Finally, after 30 days of demand order. So it is before show cause notice, within 30 days of show cause notice, after 30 days of show cause notice, but within 30 days of demand order, after 30 days of demand order. If at all it is a bona fide case. If at all it is a bona fide case. If you pay the dues before show cause notice, no penalty. We are talking about a bona fide case, section 73. Bona fide case, section 73. No penalty. No penalty. Even if it is within 30 days of show cause notice, no penalty. If it is after 30 days of show cause notice but within 30 days of demand order, 10% of tax or ITC or rupees 10,000, whichever is higher. Whichever is higher. The same will be there in the last case. After 30 days of demand order, 10% of tax or interest or rupees 10,000, whichever is higher. Whichever is higher. If at all it is a fraudulent case, section 74. Before show cause notice, 15% penalty. After show cause notice within 30 days, 25%. 25. When I tell 15%, 25%, that is all tax. That is all tax. After 30 days of show cause notice, before 30 days of demand order, 50% penalty of tax amount. And after 30 days of demand order, penalty is equal to 100% of tax amount. 100% of tax amount. Please understand that the benefit of this reduced penalty will be received if you pay full tax, full interest and reduced penalty. Full tax, full interest and reduced penalty within that time. Either before show cause notice or within 30 days of show cause notice or within 30 days of demand order. Full tax, full interest plus the reduced penalty. You cannot just pay reduced penalty and take the benefit. You have to pay full tax, full interest and reduced penalty within this particular time. Within this particular time. So that is given here. So that is exactly explained here. Now, other aspects which you have not discussed. If at all you have paid all the amount, all the proceedings will be deemed to be dropped. All the proceedings will be deemed to be dropped. But when you talk about all the proceedings shall be deemed to be dropped, it will not include your criminal proceedings under section 132. It will not include your criminal proceedings under section 132. Also, if for the same proceedings, notice is issued to the main culprit as well as the co-culprit, which means the main culprit is the owner of the goods, co-culprit is say transporter or warehouse keeper. If the main culprit pays the entire amount under section 73, 74, automatically proceedings against the co-culprit in section 122 and 125 will be dropped. If main culprit is closing all the dues under section 73, 74, against co-culprit there will be only penalty. Either a specific penalty under section 122 or a restitutory penalty under section 125. That automatically will be concluded. Now understand that at times officer will give DRC 01A before giving show cause notice. That will result into some benefit. Why? If you are informed before giving show cause notice, opportunity before show cause notice, you can take the benefit of reduced penalty, and this benefit will be there only in fraud case. This benefit will not be there in bona fide case. If you are given DRC 01 before giving DRC 1, which means show cause notice, before giving show cause notice, what will happen? If it is a bona fide case, it really does not make any difference. Why? Whether you pay the dues before show cause notice or within 30 days of show cause notice, there's no penalty. But it will make a difference when it is 74. If you are given an opportunity before notice is given, you might pay all the tax, all the interest plus 15% penalty. If that opportunity was not given, what will happen? You end up paying all the tax, all the interest plus 25% penalty. So there would be savings of penalty, but that savings will be only in fraudulent case, not in bona fide case. And where the appellate authority or appellate tribunal, where the appellate authority or the appellate tribunal or court modifies the tax amount, automatically interest and penalty will stand modified. The moment they change the tax. See, what is the base of interest and penalty? Tax. The tax changes, automatically interest and penalty will get changed. And one important clarification, where there is a penalty which is imposed in section 73, 74. You cannot have any other penalty in series of section 122, 123, 124, 125. Other penalties cannot be there. If there is already a penalty which is given to you under section 73, 74, you cannot have other penalties. You cannot have other penalties. So that is all and all about your section 73 and section 74. The monetary limits and circulars are not so critical. Who can issue show cause notice for what amount and all, not relevant. Now what we will do is, we'll see the other provisions of your demand. We are still seeing demand. The main provisions were section 73, 74 read along with section 75, which is common provisions for both. Now 76 and 77 are the other provisions. 76, you can call it as extreme fraud case. Extreme fraud case. What is this extreme fraud case? There is a levy of tax which is 5%. You are collecting 12%, but you are paying levies of 5, you are paying 5. If you look in that manner, you are actually fulfilling, discharging your liability. Government wanted 5, you are paying 5%. But if you look from other angle, in the name of government, you are cheating the customer. In the name of government, you are cheating the customer. From the customer, you are taking extra amount, 7%. That 7% technically cannot be called as tax. It is surplus amount. You are falling under the category of extreme fraud. So it is not even section 74, it is section 76. For two reasons. It is an extreme fraud case, one reason, and the main reason technically it is not tax. It is a surplus amount. Now for the surplus amount, you need to understand that there is no time limit for giving notice under section 76. This notice can be given after 3 years, 5 years, 10 years, 12 years, 20 years. You cannot at times celebrate in front of the officer telling that I have cheated lot of customers. Now you cannot do anything because 5 years has gone. Now officer will tell, okay, tell me the story, what you have done. No, you wanted 5%, I paid you 5%, but I collected 12. Now come sit here. Welcome. You are not covered by section 73, 74, you are covered by section 76. I can recover that amount even after 5 years, 10 years, 15 years, 20 years. Even when you are gone, I can recover the amount from your successor. So don't worry, that recovery will still happen. There's no time limit for show cause notice. Notice will be given, representation will be done. Finally, you will get an order under section 76, which is for surplus amount. For order, they give a time limit within 1 year, excluding the stay period, which means at the stay period, excluding the stay period. For notice, there is no time limit. You open the matter, then after giving notice, close it within 1 year. Close it within. You can give notice after 15 years. After you have given the notice, please give an order within 1 year plus stay period. Now, what will be asked from you is not only that surplus amount, but also interest on that surplus amount, right from the date you collected from the customer till you are paying to the government. And see the irony. Don't you think that it is an extreme fraud case? So extreme action should be taken. Interest is huge. Don't stop that. Penalty is bigger. No relaxation. 100% penalty. No question of 15, 25, 50 and all. 100% penalty. So it is an extreme fraud case. For surplus amount, no time limit for notice. For order, after you give notice, within 1 year plus stay period. You have to pay that surplus amount with interest right from the date you collected till you are making the payment. Penalty 100%, no relaxation. Now, don't you think that this surplus amount, if it is not belonging to the society, it does not even belongs to government. It does not even belongs to. So what government has to do? Government has to give a notification advertise in newspaper that this assessee is a pakka fraud assessee, collected extra amount from all the customers, those who have purchased from this company from so such and such date, you may apply for refund. So the person who have bought the insurance can go and apply for the refund. Can go and apply for the refund. If it is a balance amount is there, unclaimed amount is there, it will go to Consumer Welfare Fund. But one more special point that they have recognized and put here is, if at all this assessee finally finds that during the tax period, the tax rate was neither 5 nor 12, it was an ad hoc rate, say 10%. You can have special rates. He thought it is 5, he collected 12 but paid 5. But finally it is found that no, it was 10%. It's already collected extra. That out of extra 7% collection, that 5% collection can be adjusted against tax payable. So he has to pay that 5%. He has to pay that 5%. Already that is included in surplus amount. So surplus amount was totally 7%. Adjust that. He has to pay entire 7%. But now that 7%, 5% he can adjust against his tax dues. Balance 2%. What will happen? Either it will be given as refund to the persons who have paid extra. If not, it will go to Consumer Welfare Fund. So it will work out in 3 steps. If the same assessee has got dues for the same period, for the same transactions, he'll first adjust against those dues, because now surplus amount will get converted to tax amount. Balance amount, which is technically surplus amount, what will happen? It will be given back to the customers who have borne the burden. If not, it will go and sit in the small pocket of the government from Consolidated Fund of India to Consumer Welfare Fund. So that is all about your section 76. Now what is your section 77 read along with section 19? Section 77 of your CGST Act read along with section 19 of your IGST Act. It talks about a very special scenario where you thought that the transaction is interstate supply, whereas it was intrastate supply. There was an intrastate supply which you thought it is interstate supply. So what tax you have paid? We'll summarize this in a very simple example because it works in the same manner. Both section 77 of your CGST Act read along with section 19 of your IGST Act. There was a transaction of 10 lakhs which attracted GST at 18%. So there was a transaction of 10 lakhs which attracted 18% GST. Actually, location of supplier was Tamil Nadu, place of supply was say Kerala. What tax should have been there? IGST. But what you did? You paid CGST 9% and SGST 9% amounting to 90,000. What you should have paid? IGST. What you should have paid? IGST 1,80,000. This was actual payable. What you have paid in reality? CGST, SGST. This you realized after say 2-3 years, and in refund correspondingly they have added the relevant date. In refund correspondingly they have recognized that relevant date. You realize this after say 2-3 years. 2-3 years. This transaction happened somewhere in say April 2023. You found out this error somewhere in say December 2025. Now what are you required to do? 2-step process. Step 1, step 2. What are you required to do? Step 1, pay the correct tax. Step 1, pay the correct tax. What was your correct tax? Pay IGST 1,80,000. Important point, without interest. To this extent, government is very logical. Government is telling that we got the revenue right in the beginning. Now we are not going to collect interest because we have already paid the tax, but wrong liability. It is not wrong cash ledger. It is wrong liability. You determined your liability wrong. It was not cash ledger wrong payment. You determined your liability. In simple language, this entire case is wrong determination of liability. Not wrong depositing in cash ledger. This is wrong determination of liability. First, you pay the correct tax. Second, you apply for refund of CGST 90,000 and SGST 90,000, and refund time limit will be 2 years. Will be 2 years. From what date? From the date of payment of IGST, not from the transaction date. Very logical date. From the date of payment of IGST, which means if you have paid your IGST in December 2025, after that you have 2 years time to go for refund. Because if you take the base as April 2023, refund time limit is gone. Refund time limit is gone. So what are the 2 steps? First, pay the correct tax without interest. Second, apply for refund of wrongly paid tax. Apply for refund of wrongly paid tax. And correspondingly refund, they talk very logically that when you are applying for refund, this 2 years will start from the date of payment of the correct tax, not from the transaction date, not from the normal date. It will start from the date of payment of correct tax. So that is all about section 77 of your CGST Act, read along with section 19 of your IGST. It could have been an ulta scenario as well. So therefore you find in both the places. So this basically covers our first part, demand. Now talking about your recovery, section 78 and section 79 are the main provisions of recovery. Section 77 and section 78 are the main provisions for your recovery. Main provisions for your recovery. Now please understand that after you get a demand order, what are the options available with you? Either pay or go for appeals. Not working, I guess. Is my voice audible till the end? Okay. Either pay or go for appeals. Till how much time they are going to wait? 3 months. 3 months is the time for assessee to go for appeals. 3 months is the time for assessee to go for. That's 1 month extensions and extension period. But what is the base time limit? So within 3 months, they have to either pay or decide and go for appeals. If at all they don't do any of these 2 things, if they don't do any of these 2 things, recovery will start. If they have gone for appeals, nothing to worry. There will be automatic stay on the recovery, because the moment you pay the pre-deposit, there is automatic stay. But if you don't pay, don't go for appeals, then there will be recovery proceedings. At times, swapper officer can tell that I want a lesser time. At times, he will tell that no, recovery 3 months is bigger time. This assessee may run away. Please reduce this time. At times, he may start recovery before the expiry of 3 months, but he has to take the permission of higher officer and records the reason in writing. But if you don't pay nor go for appeals within 3 months, direct recovery will start under section 79. Please understand what do you mean by recovery. Recovery means attaching all your assets. All your assets. If at all there is any refund due to you or money owed to you, either under GST or by under any other law or under with any other government. What is meant by specified officer? It is amount is there with the officer of central government, state government, union, territory, local authority, board, corporation, company owned or controlled by government. Which means government is to give you something, not necessarily under GST Act, under any law. It might be even your income tax refund. It might be even your dues from government because you have sold to the government. You might be selling to the government. They can even adjust from that. You might be a supplier to the government, which means government happens to be one of your customer and government is to pay you a big amount. Now, when you are defaulting in paying the dues, GST department of the government can inform that government company telling that don't pay this dues to this assessee. He has to pay GST dues. So what is this will come in your debtors. See, all these items, basically the first point items are going to come in your current assets. Refund receivable or money receivable from government will come in your current assets. Or detain and sell your goods. Not only movable property but also immovable property, which means now they are starting attaching your stock in trade, which is under current assets, also your immovable property, which is there in your fixed assets. Not necessarily immovable property. It can be your movable property, which is there in your fixed assets, which is there under your fixed assets. If that is not possible, they will give garnish notice to your debtors, to your depositors. So if you have deposit in bank, if you are sundry debtors, they will give garnish notice to all of them and tell that don't give this amount to the assessee, pay to us. And if they don't comply, they will be treated as defaulted to the extent of that amount. If they have tried everything, if you see this point, you will find that they have tried attaching all your assets to the extent of going to your surety, to the extent of going to the liquidator if at all company is under liquidation. They try everything. They have tried everything. Finally, if they are not able to recover the amount, what they'll do? They'll go to collector, magistrate, court. Collector, magistrate, court. Tell the collector if at all this person is having any property in this place and not in presently but in future, you can collect it as arrears of land revenue, which is crown debts. So collector will take action if time comes. They will go to the magistrate and ask the magistrate to impose fine on this particular assessee. They will go to the court and ask for an order or decree against this particular assessee that he is to pay so and so amount to the government and issue it everywhere. So this is the last resort. This basically is the last resort. They are not able to recover. They don't find any other assets. So they will go to the collector, magistrate and court and try to get an order against this assessee. Right? Trying to attach all the properties. They don't stop here. If at all, you're talking about distinct persons. This we have already discovered. So distinct person recovery can be done in a different state. If there is a recovery proceedings happening in Tamil Nadu and you are having registration even in Maharashtra, so Maharashtra government can also collect. And when other government is collecting, they have taken care of it. If there are central government dues unpaid, state government can collect it. State government dues are pending, central government collect it and they will give it to the corresponding government. They will give to the corresponding government. They will try to recover as far as possible. So that is section 79. Now section 80 is a special provision where assessee accepts that he has to pay the dues. He is okay. He is telling that yes, I have to pay the dues, but I don't have the amount. I am under financial crunch. I am under financial difficulty. So what he'll do? He'll make an application to the commissioner asking for deferment or installment facility. Either deferment or installment facility. Now, who are all eligible and who are all not eligible? For any dues other than self-assessed dues, you can ask for extension and you can ask for installment facility up to 24. First point, you cannot ask for this deferment facility or installment facility for self-assessed dues. So for self-assessed dues, not possible. Second point, you cannot ask this, you cannot go for this deferment or installment if taxable person has already defaulted payment in GST laws for which recovery, there is another recovery which is going on. Already there he has made a default. For an assessee in default, this facility will not be open. If taxable person was not allowed this facility in previous year there was some other recovery. He already tried previous year for installment or deferment and he was not given that facility. Current year also he will not be given. Because the record shows that previous year when he was not allowed to go for deferment or installment, there is something wrong. There's something wrong. Don't allow even current year. Or the amount is a very small amount, petty amount, up to 25,000. Small amount. Please don't come for deferment or installment. So what are the cases where you cannot go for deferment or installment? Self-assessed dues, assessee in default, not allowed this facility in last year, amount is less than 25,000. You will not be allowed this deferment or installment facility. Now, understand that this deferment facility or installment facility is subject to interest, which means the more you defer, the more you pay in installment, your interest will keep on increasing. So interest will not be reduced. Your interest will keep on increasing. Now, while filing, before passing the order, the commissioner will call for report from the jurisdictional officer to check whether he is financially capable or not capable. It should not be a scenario where the company is fully solvent. The company is a cash rich company, like a restaurant company or a software company, cash rich company, but it is purposefully going for this deferment or installment facility. And this will be discretionary order of the commissioner. We have already discussed in section 121 that it is a non-appealable order. It is a non-appealable order. And even after giving this facility, if the assessee fails to pay any one installment before the timeline, you are thrown out of this facility and the entire amount will be recovered without any further notice. You are allowed this installment or deferment facility. You paid one installment after the due date. Finished. You are totally thrown outside this provision of section 80. Entire balance dues will be recovered without any notice. Now, that is section 80 for you. Section 81, which is for a pakka fraudulent person. 81 and 83 is for a pakka fraudulent guys. Now, before we see section 81 and 83, what is 82? 82 tells a very simple language. They will try to safeguard their interests. Notwithstanding anything contrary contained in any law except IBC code, GST dues will have the first charge on the property of the assets, which means after banks and financial institutions, GST dues will take the first charge. If at all a company is under liquidation, first settle your banks and financial institution dues. Then it will be the chance of GST dues. GST dues. That is given here. That is section 82. Now what is section 81? Section 81 talks about transfer of property to be void in certain cases. Assume that a managing director of a company, say Vijay Mallya, knows that his company is going to go under default and he is going to have huge dues. Before order comes, he sells all his company's properties. Now, what government is trying to tell? If the properties are sold by such companies, the transfer which happened will be treated as null and void, and they can recover the dues from the person who has purchased those properties in terms of taking back that property. So what is the provision? Where a person, after the amount has become due from him, what he does? Willfully creates a charge on the property or sells that property, whether by way of sale, mortgage or any other way, with a clear-cut intention to cheat the government. Such charge or such sale will be treated as void. And such recovery can happen from the buyer of that property to the extent of that particular property. But there is an exception. What is that exception? If the buyer proves that he has taken the previous permission of the officer, he will tell that I was not aware of that particular thing. I took the previous permission of the officer. I asked whether this company is having any dues or not. I repeatedly wrote letters to the officer, but he did not respond. And that means that I was within my rights to purchase that property. I knew that he is selling the property for a lesser price. I had a doubt. I cross-checked with all the departments of the government, mainly income tax department and GST department, to check whether he is trying to evade tax. And I did not get any response. In my final letter, I wrote that I am going to purchase this property. I indirectly took the previous permission of the officer. You cannot touch me now. You cannot take this property from the buyer now. Or he tells that he paid adequate consideration in good faith. He did not purchase for a lesser amount. He paid it for a fair amount in good faith. And he was not at all aware of that recovery proceedings against that assessee. Two criteria. Rather three criteria. He paid adequate consideration. He did not purchase for a lesser price. Fair price. Good faith. Was totally not aware of any such proceedings against the assessee. Then buyer will not be touched. See, where will be a problem, right? Most of the buyers will never communicate to the officer. And most of the buyers, the moment they get it for a lesser price, they will not satisfy the criteria here. Why? The criteria here is, it should be paid for a adequate consideration. The moment you know that the property worth which is 10 crores, you are trying to get for 2 crores, it is very clear that you are aware that something is fishy. Still you went ahead and purchased that property. So you will not be covered in this area. So that is section 81 for you. Now 83. 83 is again against a Paka fraud person. Now 83 comes in a scenario after proceeding starts but before order comes. In between notice and order. In between notice and order, there is a provisional attachment on the property to protect the interest on the revenue. Very, very simple logic. Government or the department fears that this assessee will run away. Order is not yet passed. Order is not yet passed, but proceedings are going on. Only after order is passed, dues will be finalized. Order is not yet passed, but officer has a strong feeling that this assessee will run away. So what he does, after initiation of any proceedings, be it assessment proceedings, be it inspection, search, seizure, arrest proceedings, be it demand and recovery proceedings. So proceedings has started. Commissioner feels to protect the interest of the revenue, provisional attachment of property is required, including provisional attachment of bank account, that of a taxable person, even of a co-culprit, not only of the main assessee but also of the co-culprit under section 122(1)(a). Even that of co-culprit, what they'll do? They'll provisionally attach your properties, including freezing your bank account. Please understand, proceedings are started but not ended. It is between this time that provisional attachment is done. If order is passed, it is not a case of provisional attachment. It is a case of final attachment. And if it is a case of final attachment, you are not seeing the provisions of section 83. You are directly going and attaching under section 79. Provisional attachment will not make government the owner of the property. Owner of the property is still the assessee. But assessee cannot deal with that property, goods or immovable property. For hazardous goods or perishable goods, there will be an option given. What option will be given? For hazardous goods or perishable goods, it will be released either on payment of lower of market value of the property or the dues that may be there. Not dues that are that. That dues may be there. So if it is hazardous property or perishable property, they cannot keep it. So they'll give an option to the assessee. See, we cannot keep it now. Give an option. What you can do? Provisionally, this is not the final tax amount. This is a deposit that you're paying. What amount you have to pay? Market value of that property or the dues that may be there, whichever is lower, not whichever is higher, whichever is the market value of the property may be 10 crores. The dues that may be there may be only 2 crores. So to deposit only 2 crores. If that person is not depositing that dues, what officer will do? Sell those goods and adjust against the dues. The property is worth 10 crores. The dues are only for 2 crores. They will not sell the entire property. They will sell only 2 crores worth property and balance 8 crores property. They will give it back to the assessee. Now, can the assessee ask for release of property? A copy of that provisional order will be given to the person. He may file an objection that his property is not liable to be attached, and commissioner may, after an opportunity, release it. See the irony. There is no principle of natural justice in the beginning. First they will attach it. Then you come. I hear your case. That's no opportunity, by the way. It cannot be called as an opportunity. It has been attached. Then you come. I'll hear to you. If I am satisfied, I'll release that property. If I am satisfied, I'll release that property. Or you may not come. Commissioner himself is so modo satisfied that this provisional attachment is not required. He may release that property. Or last possible scenario, You made an objection, commissioner did not take any action. Commissioner suo motu was not satisfied. But 1 year is over from provisional attachment. A very, very important point. After all, you are playing with the rights of the assessee. You did not pass a final order. They are indirectly telling the department that convert that proceedings into final order within 1 year. Then if you want, you go for final attachment. Don't harass the assessee by way of provisional attachment for more than 1 year. For more than 1 year. So that is section 83 for you. And finally, when you talk about section 84, it tells that if government dues are increased by appeals, they are increased by appeals. We have already discussed this indirectly. If they are increased by appeals, for the increased dues, again a notice has to be given and order has to be passed within 2 years. For the original dues, recovery will start. If the due was 1 crore and higher authority made it 5 crores, 1 crore direct recovery. Balance 4 crores, again notice of demand and convert into order within 2 years. Within 2 years. If the government dues are decreased, 5 crores is now made to 1 crore. Now recovery can happen only of 1 crore. Recovery can happen only of 1 crore. That too without any notice. Direct recovery. Direct recovery. So that is section 84. So that is all and all about your demand, the first part, and recovery, the second part. Yes, we'll start with your appeals and revision. When we talk about your appeals and revision, please understand that there are two different chains of appeals and revision. One for the assessee, one for the officer, where the direction will be given by the commissioner. The direction will be given by the commissioner. Now, appeals will come only after the order of adjudicating authority. Order of adjudicating authority. Who are all adjudicating authorities? You see the entire wing, you'll be having Government of India, Ministry of Finance, Department of Revenue, then the main administrative wing, CBIC for indirect taxes, Central Board of Indirect Taxes and Customs. Below that, you'll be having two wings. One is investigative wing, which is now called as intelligence wing. Technically now it is called as intelligence wing and administrative wing. Now the officers therein will range start from Principal Chief Commissioner, then Chief Commissioner, Principal Commissioner, then Commissioner. In front of Commissioner with having the same type of powers, there will be Commissioner appeals, but that Commissioner appeals will be hearing only appeals. Then there will be Additional Commissioner, Joint Commissioner, also Additional Commissioner, Joint Commissioner appeals. Then there will be Deputy Commissioner, Assistant Commissioner, finally Inspectors. Starting from Principal Chief Commissioner till the Inspectors. This is your administrative wing which will be giving you notices, etc., etc. That is something called as intelligence wing. Intelligence wing, which may come for your inspection, which may do some scrutiny, audit. All these activities can be done by your intelligence wing. Now when you talk about intelligence wing, the nomenclature differs there. That is Principal Director General first, followed by Director General. Then you have Principal Additional Director General, which is equivalent to Principal Commissioner. Then Additional Director General. Till now you will find Director General, Director General, Director General. Then below that you have for your administrative wing, Joint Commissioner, Additional Commissioner. Here it will be Joint Director, Additional Director. Deputy Commissioner, Assistant Commissioner, Deputy Director, Assistant Directors. Finally, Inspectors. Now, orders are only passed by administrative wing. Though the matter can be taken up by intelligence wing, finally they will pass on the matter to your administrative wing and they will pass the orders. So you have the orders of adjudicating authority. Now, if the order is against assessee, what assessee will do? He will go for appeals. What is the first level? What is the first level? Appellate authority. Second level is appellate tribunal. Appellate tribunal. Third level, High Court. Fourth level, Supreme Court. Now when assessee is applicant, which means I'm talking about the assessee person, taxable person or the registered person or the assessee, we'll call it as assessee. Now first level is appellate authority, and the time limit to file an appeals in appellate authority is 3 months plus 1 month. 3 plus 1. For assessee it is 3 plus 1. If assessee loses the case there, he'll go to appellate tribunal. Appellate tribunal. That after the order of appellate authority, if he wants to challenge in the next level, appellate tribunal, it is 3 plus 3 months. Basically time limit for assessee is 3 months. In the first level it is 3 plus 1 month extension. Second level it is 3 plus 3 months extension. Then if he is not satisfied, then he can go to High Court, but High Court will only take question of law, not question of fact. So it is 180 days. Not satisfied with High Court, go to Supreme Court. Not satisfied with the Supreme Court, nothing. Nothing. Either suicide or change the law. If you have powers like Reliance Limited, now even Adani Limited, please change the law. Please change the law retrospectively. Please change the law retrospectively. There's no other option for you. Now, surprisingly, you'll find that the first level order, that is officer's own order, is against the department. Can department challenge its own order? Yes. First level. Now, department challenging the own order first is totally, though it is there in every law, but understand that you are challenging your own order. Might be they are trying to tell that we are trying to supervise our own junior officer's order. But the irony is, at the first level, department is having 2 trains to catch. If they miss the first train, don't worry. They have the second train. For assessee, there is only 1 train to catch. For department, in the first level, they can go for appeals to appellate authority. Do you think the time limit will be lesser or more? For assessee, for the first level, what is the time limit? 3 plus 1. Here it is 6 plus 1. Wait, it's not actually 6 plus 1. If they miss the time limit, don't worry. They can go to revision authority. They are creative. They create something called as revision authority. If you miss that train of 6 months, don't worry. You can go to revision authority, second train, which will take up the case after 6 months time is over, but before. Simple language. Department is having 3 years time to challenge its own order. Within 6 months plus 1 month extension, 6 plus 1. Go to appellate authority, 6 plus 1 month. If you miss the train, don't worry. After 6 months, but within 3 years, go to revision authority. Go to revision authority. Then next, if department loses the case there, they can also go to appellate tribunal. Whether time will be less or more? More. For assessee, it was 3 plus 3. Here it is 6 plus 3. 6 plus 3. See, assessee, it is 3 plus 1, 3 plus 3. First level, second level. For officer, it is 6 plus 1, 6 plus 3. But in the first level, there is an extra time. After 6 months, but up to 3 years. Revisional authority. Then if they lose at appellate tribunal, can they challenge it to High Court? Yes. Within 180 days plus extension, they can challenge to High Court. Finally, if they lose at High Court, by the way, High Court and Supreme Court can take up only question of law. So if they lose at High Court, they are going to go to Supreme Court. If they lose there, they have nothing to worry. They'll start another case. They'll start another case. Now, understand that when you talk about your tribunal, if tribunal is taking up a case which involves place of supply, directly, place of supply matters, by the way, will be taken by national or regional bench of the tribunal. There will be 2 bench. One is national bench, one is state bench. Otherwise called as state bench is otherwise called as area bench, national bench is otherwise called as regional bench. So if the place of supply is there, that matter will be taken by national bench. From tribunal, without wasting any time, the matter will directly go to Supreme Court. High Court will not come in picture in any of the cases. From tribunal directly to Supreme Court, only one possibility. What is that possibility? The question involves place of, the question is that of question of law dealing with place of supply. Dealing with directly from tribunal to Supreme Court. Now, first let us talk about your appellate authority and appellate tribunal comparing vis-a-vis. Appellate authority, then we'll take a revision authority. Revision authority is only applicable for department, if they have missed the first train, they have a second train. So we will not take revision authority now. We will compare appellate authority versus appellate tribunal. First appeals versus second appeals. We will have a comparison simultaneously. First appeals versus second appeals. In first appeals, there is an order of adjudicating authority. If it is not in favor of the assessee will go for appeals. If it is not in favor of department, commissioner will ask the lower officer to file an appeals against its own order. Now, when you talk about your appellate tribunal, how the matter goes to appellate tribunal, second level. Either there is an order of appellate authority or order of revision authority. That second train. Order of revision authority. That second train, the doors of which are open only for the department. So there is an order of appellate authority or the order of revision authority. If it is against the assessee will go for appellate tribunal. If it is against the officer, commissioner will ask the lower officer to file an appeals in appellate tribunal. So that is the comparison. Second, if assessee is going for appeals, the time limit comparison. Let us even make your time limit comparison. What is the time limit for assessee to file an appeals? What is the time limit? First appeals 3 plus 1 month. For the officer, first appeals 6 plus 1. 6 plus 1. Second appeals for the assessee 3 plus 3. For the officer 6 plus 3. 6 plus 3. Again, when you talk about assessee going for appeals, whether it is first appeals or second appeals, assessee has to make the payment of pre-deposit. Assessee has to make the payment of pre-deposit. Now, what is the amount of pre-deposit? Whatever is accepted by the assessee. Whatever is accepted by the assessee. Pay 100% of all the dues, be it tax, interest, penalty, pay 100%. Pay 100%. Whatever is disputed, challenged, pay only 10%, that too of disputed tax. Disputed tax, not interest, penalty, not disputed tax. If at all there is a 5 crore demand, if I am accepting 1 crore, with respect to 1 crore, pay entire 1 crore plus interest plus penalty fully. Balance 4 crores. Pay only 10% of 4 crores, which is 40 lakhs. Only 10% of the tax. No interest penalty. Only 10% of the tax. And that too, there is the upper limit. What is the total upper limit in the second case? See, understand that the first part is actually not pre-deposit. First part is payment of your dues. Actually, pre-deposit is only this portion. Though in calculation you will take both, but actually pre-deposit is only the second portion. What is the upper limit for the second portion? Disputed dues. The upper limit for the second portion is CGST maximum 25 crores, SGST maximum 25 crores, IGST maximum. If it is CGST maximum 25 crores, SGST maximum 25 crores, IGST maximum 50 crores. So that is the upper limit of pre-deposit for the disputed dues. For the admitted dues, pay fully. Tax, interest, penalty, even if it is running to hundreds of crores, pay fully. Not only tax, but also interest, penalty, any other amount. But when it is disputed, there is a first check, that is it is 10% only of disputed tax. Forget about interest, penalty. And that too, it is having an upper limit. When I tell upper limit, which means that it should not cross that amount. Maximum CGST can be 25, SGST 25, IGST 50. IGST in the second level, even when assessee is going up appeals, second level, what will happen? Things will change a bit. Maybe second level means you double it. You double it. Whatever is admitted, there no change. By default, it is not at all pre-deposit. It is paying your dues. 100% of tax, interest, penalty. Supposing you took the first appeals 4 crores. We continued, we started our example with 5 crores. You accepted 1 crore, challenge 4 crores. So first 1 crore you paid entire 1 crore plus interest plus penalty, everything. 4 crores you only paid 10% of tax amount. 4 crores, which is 40 lakhs. Now, when you go to second appeals, you said that no. 4 crores is not valid. I know that I have to pay anyways 2 crores, another 2 crores. So 2 crores you accepted in the second appeals. So for the 2 crores, pay everything. Tax, interest, penalty, everything. For the balance 2 crores, pay additional 20. Do not see whether you are paid in first appeals or not. At times, first appeals pre-deposit will not come. Why? You did not file the appeals. It was filed by the department. It will not come. It is an extra additional 20%. Additional 20%. So you are going to pay additional 20% of disputed tax. Doubling. There was 10%, here it is 20% of the disputed tax. So only this technically is pre-deposit. What is the maximum limit? Double it. CGST 50 crores, SGST 50 crores, IGST 100 crores. IGST 100 crores. Right? But that's one is this particular thing, normal case. There is a special case of pre-deposit. If at all you are having an e-waybill penalty under section 129. There is no tax. There is only a penalty under section 129. E-waybill penalty under section 129. If you want to challenge that penalty, you are going for first appeals. Pay only 25% of the penalty. So if the penalty amount is say 10 lakhs, pay 2.5 lakhs. If the penalty amount is 1 crore, pay 25 lakhs. If the penalty amount is 10 crores, pay 2.5 crores. There is no limit and all. Pay 25% of the penalty. Understand that e-waybill penalty will be always challenged only by SSC. Department will never come. It will always be challenged only by SSC. But in the second level, there is no requirement of any additional pre-deposit for e-waybill penalty case. For a normal case, pre-deposit is there at first level as well as second level. For e-waybill penalty, pre-deposit is there only at the first level. 25% of penalty. When you are challenging that in appellate tribunal, there is no additional pre-deposit. There is no additional pre-deposit. Right. Now, when you talk about other differences, when assessee is filing an appeals at the first level, there is no fees. There is no fees. When one assessee is filing appeals at the second level, there is a fees of rupees 1000 for every 1 lakh of demand subject to a maximum of 25,000. By the way, this amount is CGST, copy paste is GST. 1000 rupees for every 1 lakh of demand. So if there is 50 lakhs demand, 1 lakh demand, 1000, 50 lakhs multiplied by 50. So 1000 multiplied by 50 is 50,000, but maximum limit is 25,000. Maximum fees can be. Do you have any fees to be paid at first appeals? No. Do you have fees to be paid at second appeals? Yes. Do you have fees to be paid at second appeals? So you don't have any fees concept in first appeals, but you have a fees concept in second appeals. And another difference, in second appeals, petty cases will not be heard. There's a point where you'll find that small petty cases will not be heard. Appellate tribunal will tell that we are not interested in this case. We are not going to hear that case. Where it is given? Okay. Appellate tribunal will not hear petty cases if the amount involved is. This is given only to appellate tribunal. You don't waste your time if the amount involved is only up to 50,000. They might reject the case. But that authority is not there with appellate authority. In appellate authority, even if the matter is pertaining only to 20,000 rupees, they have to hear the case. But appellate, two special points now we have discussed. No fees in first level, fees in second level. No rejection in first level, but there can be rejection of petty cases in second level. Now when you talk about appeal at first level and appeal at second level by department, who will direct them? Commissioner is not satisfied with the legality or the propriety of the decision passed by the order. So what he is doing? Commissioner is not satisfied with the legality or the propriety of the decision of the adjudicating authority. Therefore, Commissioner is asking to file an appeal to the first appeals. If Commissioner is not satisfied with the legality or the propriety of the order of appellate authority or the revision authority, Commission will ask the officer subordinate to file the appeals at the second level. Commission will decide whether to file first appeals or whether to file second appeals. But when department is filing the appeals, there is no question of any pre-deposit, there is no question of any fees. Even at second level, there is no question of any fees. If department is challenging whether in first appeals or second appeals, no pre-deposit, no pre-deposit, no fees. Even at second level, there is no fees. If department is going for appeals, by the way, whether assessee will be required to pay any pre-deposit? No. Assessee is not required to pay any pre-deposit because the judgment was in favor of, order of the judgment was in favor of assessee. Department is going for it. Now, understand certain common points. Whenever assessee goes for appeals at first level or second level, there is an automatic stay on the recovery. There is an automatic stay on the recovery proceedings the moment you pay the pre-deposit. The moment you pay the pre-deposit, there is an automatic stay on the recovery. Officer will not start forceful recovery. Automatically there is a stay. The moment you pay pre-deposit, recovery proceedings will not happen. They will wait till the order of appeals. They have to wait till the order of appeals. Now, other small differences. In first appeals, there are two authorities. One is commission appeals. One is joint commission appeals. Commissioner appeals will hear to the matters where the adjudication of authority was additional commission or joint commission. Their matters will be heard by commissioner appeals. But if the officer order was lower than the rank of additional commissioner, joint commissioner, which means if the order was that of assistant commissioner, deputy commissioner or superintendent, the matter will be heard by joint commissioner appeals. Joint commissioner appeals. In the same manner, in appellate tribunal, again there are two types, which you have already discussed when you have seen the bird's eye view. What are the two types? National bench or regional bench, state bench or area bench. If the matter deals with place of supply, it will be decided only by national bench or regional bench. If the matter is not dealing with place of supply, if none of the issue deals with place of supply, that matter will be heard by state bench or area bench. What is the other difference? If the matter is heard by state bench or area bench, the case will first go to High Court, then go to Supreme Court. If the matter is dealt by national tribunal or your regional tribunal, which involves place of supply issue, there are 5 issues. One of the issues is place of supply. It will go to national bench or regional bench. The matter will directly then go to Supreme Court. Directly it will then go to Supreme Court. Now, other differences that you have. In first appeals, there is no concept of cross appeals. There is no concept of cross appeals. You don't have any concept of cross appeals. If assessee has filed an appeals, the matter will be heard. If department has filed an appeals, the matter will be heard. But in second appeals, there is a concept of cross appeals, which is technically called as memorandum of cross objection. If assessee has filed an appeals, department will file cross appeals, memorandum of cross objections. If department has filed second appeals, assessee will file memorandum of cross objections within 45 days plus 45 days. The time limit is same for both assessee and department for cross appeals. Getting that point? The concept of cross appeals is there only in appellate tribunal, not there in appellate authority. Not there in appellate authority. Now, certain common points. These are all common points. There can be adjournment given both by first appeals and second appeals, maximum 3 adjournments to each of the parties. And if at all there is a bona fide reason, additional grounds can be admitted, extra grounds can be taken up. Those grounds which are not heard at the lower level, they can be taken up. So when you talk about adjournments, maximum 3 adjournments, and when you talk about your additional grounds which can be taken up, it is same for your first appeals and second appeals. 3 adjournments will be there at both the places. Additional grounds may be admitted if it is a genuine case. The ground which was not addressed at the lower level can be taken up directly by appellate authority or taken up directly even by appellate tribunal. Additional grounds can be taken up. These are all common points. Now, another difference that you can clearly find, what will be the order of first appeals? Order of first appeals will be either confirm the order of the adjudicating authority, or modify the order of adjudicating authority, or cancel it. Either tell the amount is same 5 crores, or tell that it is 2 crores, or tell that it is 7 crores. Either keep the same amount, or reduce it, or increase it, or even cancel it. Tell that order was totally illegal. Cancel it. This area is the same even for appellate tribunal. But your appellate authority cannot remand back the case or refer back the case. Cannot remand back the case, or they have to work like adjudicating authority. They have to rework the calculations if at all required. They can confirm, modify, annul or cancel. They cannot refer back. They cannot tell that, oh, you take back the case, rework the case. That authority is there only with appellate tribunal. Appellate tribunal, just like appellate authority, will either confirm, modify or cancel the judgment of appellate authority or revisional authority. In addition to it, it can remand back the case either to appellate authority or revisional authority, or directly even to the officer, adjudicating authority. Adjudicating authority. Right. So these are the differences. Additional difference. There is no concept of rectification of error apparent on records in first appeals. But in second appeals, if there is an error which is very much apparent on the face of it, which means there is a clear-cut calculation mistake, they can rectify it within 3 months. They can rectify it within 3 months. They can do rectification within 3 months. This concept of rectification of mistake apparent on records is not there at first appeals. It is there only at second appeals. It is there only and only at second appeals. You don't have the concept of rectification of error apparent on the records in the first appeals. Now please understand whether it is first appeals or second appeals. If assessee wins the case in first appeals or wins the case in second appeals, if at all he has made pre-deposit, that will be refunded with interest. Now for the first time they talk about a logical calculation. Interest when you get, it will be 6% from the date of deposit till the date of refund. Logical calculation. They take mathematics into consideration and tell that, okay, if at all, and this is not only for second appeals, this is even true for your first appeals. If at all assessee wins the case and if he has made the pre-deposit, same thing, it will be refunded back with interest. It will be refunded back with interest. So that is true for both. That is true for both. When this will happen? Appeals was filed by the assessee, won by the assessee, this will happen. If appeals was filed by the department, won by the assessee, there is no question, no pre-deposit, no question of refund. So when appeals was filed by the assessee, pre-deposit was made and won by the assessee, what will happen? There will be refund of pre-deposit. How much? The amount that you have paid on disputed tax, not the admitted. Admitted amount that technically is not pre-deposit. With interest. What rate? 6%. Starting from date of pre-deposit. Ending till date of refund. Are we talking about admitted dues? No. We are only talking about disputed dues pre-deposit. Disputed dues pre-deposit. When you will get two pre-deposit refunded together. In one situation where there was an order against assessee. Assessee went for first appeals. He made pre-deposit. Assessee lost in first appeals. Assessee made second appeals. He again paid additional pre-deposit. He won the case in second appeals. Now there will be refund of two pre-deposit with interest. Interest time limit will be different for first pre-deposit and will be different for the second pre-deposit. From date will be different. From date will be different. So that is the scenario. Now what we have done, we have made our job very simple by comparing both your appellate authority and appellate tribunal. So you will get to know the differences. You will not make silly mistakes. There are evident differences where we have compared and said that, okay, this is different in first appeals, this is different in second appeals. Now, first appeals, there is a second chance. In first appeals, there is a second chance which is only for department, which is called as revision authority. There is an order of adjudicating authority which is against the department, and revision authority. Who will be the revision authority? If the order was passed by AC, DC, superintendent, revision authority will be additional commissioner, joint commissioner. If the order itself was passed by additional commissioner, joint commissioner, principal commissioner, commissioner. See, revision authority is not appeals authority. So you will not have bracket appeals. You will have only joint commissioner, additional commissioner if it is a lower officer. If the officer himself is joint commissioner, additional commissioner, then revision will be done by commissioner, principal commissioner. Commissioner, principal commissioner. Now, how this revision authority work will start? Revision authority, suo moto, or on the information received from the commissioner, will call and examine the records, which means it will call for the orders of the officer and see the quality of the orders. When it sees the orders, on examination of orders by revision authority, at times revision authority will take up the matter not because it has examined the orders. The orders were examined by Comptroller and Auditor of General of India, and it found out that either revision authority directly or CAG found out that the orders were against the government interest of the revenue, plus they were illegal or improper. They were not proper, they were not legal, illegal or improper, or there were material records available which they did not take. Believe me, if this is taken, lot of associates who try to settle the cases at first appeals just by giving some information. An officer is also a part of the collusion and he agrees to drop the order. This will hit. They'll see the orders. They might not find any illegality or improperness, but they'll find that there were clear-cut records available, which means that clear-cut all the details given by the assessee shows the turnover is 100 crores, but the tax payment is clearly made only on 10 crores, clearly. So what is to be done? Revise the matter. So that being the case, you are talking about second innings for the department. Second innings for the, basically, they are doubting that their own officer. They know that at times the officer would be in a compromised position to give the orders in favor of the assessee. Might be he has agreed to take something under the table. Therefore, what will happen? They'll take up the matter, and this quality check directly will be normally by revision authority. At times, this quality check can be done by CNAG, Comptroller and Auditor General, and they will tell that, see, the orders are clearly illegal, improper, facts are not considered, against the government, take up the matter for revision. Now, what will be the action? Revision authority will take the matter of that order and pass the order either enhancing, modifying or annulling. Again, it cannot refer back. See, first appeals cannot refer back. They have to do the work of the adjudicating authority. They cannot refer back the matter. Now, certain orders cannot be revised. These are the cases where you cannot revise the orders. When you see these orders, two are basically the time limit. If you see the first 2 points, they are basically the time limit. The period of filing appeals before appellate authority is not yet over. 3 years have expired after passing the order, which means they can take up the matter after 6 months, but before 3 years. That is the time limit. They can take up the matter after 6 months of the order of adjudicating authority, but before 3 years of the order of adjudicating authority. Simple language. After 6 months, but before 3 years. After 6 months, but before 3 years. Now, other orders which cannot be taken. We'll discuss about the exclusion later on. If the order is already subject to appeals, the same order is already subject to appeals either at appellate authority or appellate tribunal or high court or supreme court, they cannot take up the matter. It is already pending. They cannot take up the matter. If the order sought to be revised is already a revised order, if this is allowed, what will happen? There is no time limit, unlimited time, infinity. They'll revise the order. Again, they'll take up the matter. Another 3 years. Again, they'll take up. There's no end. An already revised order cannot be taken up for second time revision. Or order has been already taken up for revision. You might ask, what is the difference between these 2 points? Second time revision is not allowed. First time revision is already done, or first time revision is still pending. First time revision is already done, or first time revision is still pending. Second time revision not allowed. Second time revision is not allowed. So you cannot go for second revision. The meaning of this is simple. First time revision is already done, or first time revision is taken up but still pending. You cannot go for second revision. You cannot go for second revision. See, what are the simple matters? It can take up the matter after 6 months but before 3 years. Second time revision not possible. If the order is already touched by someone, it cannot touch up the matter. Now there are certain special points that you need to understand. If the order is already touched by appeals, it cannot take up the matter. But if at all the order which is already taken by appeals is issue 1, they have touched issue 1. They have not touched issue number 2. Revision authority in the beginning cannot take up both issue 1 and issue 2. Because it is already pending. What matter is already pending in appeals? Issue 1. Clearly issue 1 will never be taken up. Issue 2 can be taken up, but they have to wait and watch. They have to wait and watch. Why? Issue 2 can be taken up in between. Additional grounds could have been added. So they have to wait and watch. And don't you think that when they are waiting and watching, the time limit will get over? When they are waiting and watching, for this they have to wait and watch. For that, time limit might get over. So they have taken care of that time limit. They have said that they will be taking this issue to 3 years from the date of the original order, same time within 3 years, or 1 year from the date of order in appeals. 1 year from the date of order in appeals, whichever is later. Whichever is. So what are we trying to understand? If a particular case is already pending in appeals, assume that there are 2 issues involved. Issue 1 is already touched by appeals. Revision authority can never take up issue 1. Issue 2 is not touched. As of now, it will not take up. Because at a later point of time, issue 2 could also have been taken up. They will wait and watch. When they wait and watch, they want extra time. What is extra time? After appeals is decided for issue 1, they'll still have minimum 1 year time. They'll still have 1 year. What is the time limit? 1 year time from the appeals order, or 3 years from original order, whichever is later. Whichever is later. They can take up the issue 2. They can take up the not issue 1. Now, when you're calculating this time limit of 3 years, you have to remove the stay order. See, whenever you go for stay, officer is not in a position to do anything. So you remove that stay order. How to remove the stay order? 3 years plus stay time. 3 years plus stay time. Also, if the said order or decision involves an issue in which appellate tribunal or high court has given its decision in some other proceedings, not in your case, in some other proceedings, and appeal to high court or supreme court is pending in that case. Understand, these are all authorities lower than high court or supreme court. So, in this case, the same issue, which is not touched in this case, it is touched in some other company's case. It is touched in some other company's case. It has been touched not in the current company's case. It has been touched by some other officer in some other company's case. Now, the same matter is already pending with your high court, or the same matter is already pending with Supreme Court. Can they take up the matter? No. They are all lower authorities. So what they'll do? The time gap between appellate tribunal order and the high court order, or high court order and the Supreme Court order, at times both the orders put together will be added back. Clear? Indirectly, there was an indirect stay. There was no direct stay. It is an indirect stay, because They have seen that the same issue was pending in some other companies and the matter is not at first appeals. The matter was there at second appeals or third appeals. From second appeals it has gone to third appeals, or from third appeals it has gone to fourth appeals. And all these three are higher than revision authority. They understand that they are lower. So what they do? They'll take the, okay, we'll not touch this case now. Let the higher authorities first decide. Don't you think that the time of 3 years will be running? Don't worry. You take 3 years plus add that indirect stay. What is that indirect stay? From the date of order of appellate tribunal till the date of order of high court, or from the date of order of high court till the date of Supreme Court, or at times from the date of order of tribunal till the date of order of Supreme Court if the matter finally goes up to Supreme Court. Indirect stay. Put in very simple terms. If there is a stay at that time. If there is a stay at that time. So that is all about your revisional authority. Now talking about your High Court and Supreme Court, understand that in High Court and Supreme Court, few special points. First, only a question of law can be taken up by High Court and Supreme Court. If the matter involves only question of fact, you have to stop at appellate tribunal. You cannot go to High Court and Supreme Court. So what questions can be taken? What questions can be taken up by High Court and Supreme Court? They can take up the question only pertaining to question of law. Question of law. So only question of law cases can be taken up. Second, by default in High Court and Supreme Court, whenever you are going to go for appeals, you have to pay entire pre-deposit. Entire amount. Entire tax, interest, penalty. But High Court and Supreme Court has got extraordinary powers to waive it. By default, you have to pay entire pre-deposit. Now, no more 10%, 20% and all. That too only of tax. Now, you have to pay entire dues. Entire dues. Full tax, full interest, full penalty. Whatever spending, paid fully. But can you get a waiver from High Court? Yes. Can you get a waiver from High Court? Yes. Can you get a waiver from Supreme Court? Yes. By default, when you go to High Court and Supreme Court, department will start recovering it. Department will start recovering the dues. Because pre-deposit has to be made fully. If not, they'll start recovering the dues. Can you make a stay application on the dues? Yes. So normally, appeals to High Court and Supreme Court will be not normal appeals. It will be appeals plus waiver application for pre-deposit plus stay application for recovery. It will be three things. Appeals, along with that waiver application to tell that please allow me not to pay any additional pre-deposit. High Court, Supreme Court may agree or may not agree. Plus stay application to tell that please ask the officer. The moment you waive my pre-deposit, they will start recovering. Please ask the officer not to recover any dues. So these three applications will go. Now, what matters High Court will take? High Court will take up the matters of appellate tribunal being state bench or area bench, not involving the matter of place of supply. Not involving the matter of place of supply. By default, you have to pay all the dues. But High Court has the power to waive the pre-deposit and stay the recovery proceedings. What is the time limit that we have discussed? 180 days plus extension, which is allowed by the High Court. Now, High Court will only allow a case to be heard only if it is a question of law. Initially, first there will be an admission day. First, High Court will take up the matter and see whether it can be heard or not, and it will formulate a question. It will not decide on the matter. First, it will see whether it involves question of law or not. It will formulate that question. Then it will tell that, okay, I am going to hear only on this question. Only on this particular question, which is technically called as admission day. Which means people will file appeals and tell that, please admit my case. Please admit my. So on that day, what will happen? High Court will formulate the question of law and try to understand within a few minutes span of time to whether it involves question of law. If yes, what is the question of law? Only on that matter High Court will hear the case. And if at all it is found that it does not involve question of law, chapter is closed. It will be rejected. Appeals per se will be rejected. Now High Court has got extraordinary powers to hear up any other question of law. Not see, High Court and Supreme Court have got extraordinary powers. These are all normal points that they can take up only the question of law which is brought up. But can they bring up another question of law and hear the matter? Yes. They have got extraordinary powers to take up another question of law which None of the parties have taken up. They can formulate another question. They can start hearing. They can start hearing that case as well. Civil procedure code will follow, and High Court will tell that it should be a case which is taken by your state bench or area bench, which means it does not involve place of supply. The moment it feels it involves place of supply, it will give to your Supreme Court. And minimum 2 judges should be there in your High Court. It will be decided by majority. If at all there is any difference of opinion, they will refer to another judge. Again, it will be decided by majority. By the way, we missed to see one point of tribunal. Even in tribunal, when you talk about your appellate tribunal, second level, the matter should be heard by minimum 2 members. A single member bench is possible only and only if the amount involved is 5 lakhs, less than or equal to 5 lakhs, and it does not have any question of law, which means it is only question of fact. This I am telling because we have missed this point. This is another difference. When you talk about tribunal, second appeals, minimum they should have 2 members. Minimum they should have 2 members bench. Can the matter in second appeals tribunal be heard by a single member? Yes, when 2 criteria. Less than or equal to 5 lakhs plus does not involve question of law. And whenever they are hearing minimum 2 members bench, it will be decided by the majority. If at all it is equal, they will refer it to the third member. Now, the members will be split in this particular manner. We will have appellate tribunal case, center, appellate tribunal case, state. Why it is called as national or regional bench? Because it is controlled by the center. Which matters they will take up, which involves place of supply. There will be president, there will be a technical member of the center, there will be a technical member of the state as well. In your state bench or area bench, which is under the control of state, there will be a judicial member, technical member state and center. And technical member center. One is judicial member, one will be technical member center, and one will be technical member state. Right. This concept is not there in first appeals. One person can hear it. Second appeals, 2 members, exception 1 member in a special case, less than or equal to 50,000 and does not involve, less than or equal to 5 lakhs and does not involve question of law. Question of law. Now, finally, when the matter goes to Supreme Court, look at the importance of Supreme Court. Supreme Court will not at all take a case unless otherwise it is certified by the High Court as a fit case to hear. There are 2 possibilities where the matter will go to Supreme Court. One, directly from the tribunal when it is national bench or regional bench because it involves place of supply. One via High Court. Other cases via, in both the cases, they will call High Court and tell that please check whether it is worth my time. It is worth my time. So High Court will give a certificate that it is a worth case to be heard in Supreme Court. And by default, we have already discussed all these points that when you talk about your High Court and Supreme Court, there is full pre-deposit that you have to pay, but you can ask for waiver of pre-deposit. And if you are asking for waiver for pre-deposit, make sure that you also ask for stay application. CPC will apply. So those are all the same provisions. There is no specific time limit given here. It will be decided by Supreme Court rules when you are talking about appeals to Supreme Court. If you see, the moment you go higher and higher, mainly when you go to High Court and Supreme Court, they have written lesser and lesser about High Court and Supreme Court. Why? When you are talking about a person who is of very much importance, the moment you try to open your mouth, you will start talking some nonsense. Better not to talk anything. They will decide for themselves. If you see High Court, they have written something extra. This is all from Barrack wordings. When you see Supreme Court, they have written very minimum. Why? They want to make sure that they are capable enough to decide what to do and what not to do. They are not like your appellate authority and appellate tribunal where you tell that you do spoon feeding. Right from the beginning, you tell this do to, not this not to do, etc. etc. They are capable enough of taking care of themselves. When you talk about your High Court and Supreme Court. Now, certain other small aspects. You are talking about appeals not to be filed by department in certain cases. This concept is given in your section 120. This entire concept is very simple. It is trying to tell that if department is not filing an appeals because of the monetary limits given by the board, CBIC, It does not mean that department has lost the case. Assisi cannot tell that, okay, department accepted that, they have lost the case. So second time when the same matter comes up, department cannot again give notice. That is not the meaning. If department is not filing appeals to higher authorities because of the limit, monetary limit, because of the amount being lesser, because of the instruction by CBSE that if amount is so and so lesser, don't file the appeals. It does not mean that department has agreed to the judgment of the appellate authority or appellate tribunal or High Court or Supreme Court. It does not. The Supreme Court should not be taken. It has not agreed to the judgment of appellate authority or appellate tribunal or High Court. It does not mean that. It can be a scenario where department has not gone to the next appeals because of monetary limits, internal controls. So next time, can they take up the same matter? Yes. Assessee cannot bring, but they have to prove that last time when the same assessee, same department was involved, why did not department go for the next appeals? Assessee will put this point and department has to prove that, see, I was not satisfied with the order of the appeals, but I did not go to the next appeals because of my monetary restrictions, monetary limit restrictions. Then it can be again taken up. Certain non-appealable orders where you cannot go for any appeal. Section 121. Right. You cannot tell that I don't like this officer face, so please transfer the case from one officer to another officer. That you cannot do. You cannot tell that the books have been seized, therefore give me relaxation. Why? Because if you see those provisions, you will understand that when your books of accounts are seized or records are seized, you can always ask for a copy of your records. You can give the copy of your records, your signature, and take your original books. That is always possible. So you cannot challenge that seizure of your books of accounts case. You cannot challenge an order sanctioning prosecution which will be a criminal case, which will be taken as a criminal case. You cannot do that. You cannot challenge an order under section 80 which is you are begging to the commissioner to allow you to pay the dues in installment. Pay the dues in maximum 24 installments. There, commissioner has given you a particular installment slab. You are telling that I do not like the slab. I want a slab according to me. You cannot challenge that. First of all, you are under begging mode. You are going and telling that please allow me to pay the dues in installment. And commissioner has given you a schedule of installment. Go only according to that. You cannot challenge this. These 4 orders, they are all non-appealable orders. They are all non-appealable orders. Non-appealable orders. When you talk about additional grounds, rather additional grounds can be accepted by anyone. Appellate authority, appellate tribunal, High Court and Supreme Court can anytime have additional grounds. What about additional evidence? What is the difference between additional grounds and additional evidence? Additional grounds is the basis on the basis of which you are going to fight your case. Evidence is a fact supporting your case. You are fighting your case based on 5 grounds. That this order is not proper because of reason number 1, reason number 2, reason number 3, reason number 4, reason number 5. If you bring the 6th reason, that is additional ground. What is additional evidence? For the 3rd ground, you have one more evidence. For the 3rd ground, you have one more evidence. So, can you produce additional evidence before appellate authority and appellate tribunal? Here, they are not talking about High Court and Supreme Court because High Court and Supreme Court will not be discussing the case of question of fact. Grounds deals with question of law. Evidence deals with question of fact. So, here your discussion is only with respect to appellate authority and appellate tribunal. You did not bring that evidence at the officer level. Now, you are bringing it appellate authority. You did not bring that evidence at officer level as well as appellate authority level. Now, you are bringing that evidence at appellate tribunal level. You can do it, but there should be certain scenarios. The lower authority refused to admit it. You produced it, but it refused to admit it. The lower authority did not provide you an opportunity. You wanted to give additional evidence, but it did not give you principle of natural justice. The lower authority, normally if it is appellate authority, lower authority is officer. If it is appellate tribunal, lower authority is appellate authority. Either you gave evidence, but it was rejected, or you are not given any chance to give evidence. Or the appellant was prevented from sufficient cause to produce it. Which means you never produced it, or you had a sufficient chance, but even then you did not give it. There was no question of any refusal. There was no question of any opportunity. You are given opportunity, but you never produce it. But still you are prevented from sufficient cause. Might be it can be a situation where there is a serious situation in family and you did not have that time to think and give the additional evidence. So you have to prove that I was prevented from sufficient cause. The lower authority gave me full chance. I never produced before lower authority, but I still have sufficient reasons where I was prevented to give the additional evidence, which might have been called by lower authority, but at that point of time I was not in a situation to give that. If that is the case, your additional evidence will be taken up, but only after recording reasons in writing and allowing the lower authority to cross-examine it. Right. Also understand that these two authorities, suo motu, they can always ask for additional evidence. See, this is when you try to give additional evidence. Can they by default ask as additional evidence? Yes, they can always ask. Why this additional evidence is not discussed in your High Court and Supreme Court? Because High Court and Supreme Court has got nothing to do with additional evidence. They will not deal with question of fact. They will deal only with question of. So this point is totally irrelevant for High Court and Supreme Court. Understand it this way. Additional grounds can be taken up by all four, but evidence can be taken up only by first two, not the last two. Now, can you take up your case in appeals through authorized representative? Yes. You can hear your matter through authorized representative before any officer, appellate authority or appellate tribunal, not in High Court and Supreme Court. Again, High Court and Supreme Court, only advocates can take up the matter. Only advocates can, who can fight a company's case? A relative, employee, advocate who is not barred, CA, CMA, CS who is not barred, even an officer, even a retired officer of commercial tax department, not below the rank of Group B gazetted officer, who has served in that rank for minimum of 2 years, plus after retirement, there is a cooling period of 1 year. So your employee can hear, your relative can hear, take up your matter, your employee, normal profession, that is advocate, CA, CS, CMA, but they should not be debarred. Even officer, retired officer can take up the matter, but there are conditions. A particular rank, Group B gazetted rank, serving there minimum of 2 years, and after retirement or resignation, cooling period at least of. There is actually one more condition. He should not be removed. He should not have been removed from government service. He should have resigned or retired. He should have resigned or retired, not been removed. And people who cannot represent, if at all you are found guilty of misconduct, then you cannot represent. These are the people who cannot represent. If you are guilty of misconduct, you cannot represent the case. If you are convicted under any offense, see, you are trying to represent a case of another person, you yourself are convicted of any offense under the GST law or the earlier indirect tax laws, or you are insolvent. During the period of insolvency, you cannot take up the matter. Who are the persons who can never take up the matter, who can never represent an assessee? Government officer who is removed, guilty of misconduct, convicted under GST law or old indirect taxes forever, and finally when you are talking about person who is insolvent during the period of insolvency, he cannot take up the matter. So that is all and all about your appeals. Everything about your appeals. Now let us see a very simple and small topic called as your advance ruling. Now, advance ruling is nothing but getting consultancy from department itself. Now when you talk about advance ruling, there will be a ruling or decision given by the advance ruling authority of advance ruling, or appellate authority of advance ruling. We can call it as A square R or A cube R. Authority of advance ruling A square R, or appellate authority of advance ruling A cube R, to the applicant. Now, who can be the applicant? Applicant can be anyone, whether he is registered or desirous of getting registration. Not necessarily registered. This time the term used is a bit different. Registered or desirous of getting registration, not liable. Desirous of getting registration. So, applicant will have certain doubts where he will make an application. Now, he might have doubts with respect to goods or services, the supply of which is already undertaken or it is proposed to be undertaken. He cannot ask questions on any matters. So, the question should be specific questions which will be seeing, but two things are very clear. Applicant can be a person who's registered or who's desirous of getting registration. Second thing, that activity on which he is having a question could have been already undertaken or proposed to be undertaken, either past or even future. Now, on what questions he can go for advanced ruling? So, section 95 talks about advanced ruling and the applicant, and 97 talks about the questions which can be asked to advanced ruling. The list of questions that you can go and ask to your A square R authority for advanced ruling or A cube R appellate authority for advanced ruling. You can have questions with respect to your classification, rate of tax, including interpretation of a notification. So, classification is about rate of tax, whether it is 5, 0, 5, 12, etc., etc. Application of notification. Notification includes exemption notification. Any type of notification, whether exemption notification or other than exemption notification. It can be an RCM notification. RCM notification is not an exemption notification. It can be any such notification. That is the first part. Then you can have doubts with respect to your time of supply and value of supply. These two are separate questions. Time of supply questions, value of supply questions. You can have doubts with respect to your ITC, admissibility of ITC, which is utilized or deemed to be utilized. ITC issues. The moment you have any issues with ITC, you can go and ask advanced ruling whether it is eligible or not. You can have questions with respect to your liability to pay tax, your liability to get registered. Whether you get to get registered or whether you are liable to pay tax. Whether you are liable to pay tax. And you can also ask a question where you are challenging the levy itself. Whether a particular thing done by the applicant amounts to supply. Amounts to supply. Basically, you can ask question with respect to levy, classification, valuation, time of supply. These are the main issues. Then small other issues. Interpretation of a notification including exemption notification, liability to pay tax, liability to get registered. Liability to get registered. Now understand that when you talk about liability to pay tax, it includes what type of tax. So even place of supply questions can be asked. Though there are different views, but even place of supply questions can be asked. Why? Liability to pay tax includes liability to pay what type of tax? Whether it is CGST, SGST or whether it is IGST. So even place of supply questions can be asked understanding the term liability to pay tax. Yes, I am liable to pay tax, but what tax? Am I liable to pay CGST, SGST or am I liable to pay IGST? So place of supply can also be asked reading this particular point. These are the questions that you can take to your advanced ruling. Now, as I said, there are two authorities. One is A square R, which is authority for advanced ruling. The next level is A cube R, which is appellate authority for advanced ruling. Appellate authority for your advanced ruling. A square R and your A cube R. Now, when you are going to go to A, first step is always A square R. So, applicant is going to make an advanced ruling application to A square R. Now, that is a particular form where you have to apply in a particular form. Advanced ruling application 1, ARA 1. You can ask only specified question, the list of which you have seen, and the amount that you have to pay is 5,000. CGST 5,000, SGST 5,000. All the amounts that we see here, if it is in terms of numbers, it is all about CGST. The same value will be that in SGST. The same value will be that in SGST. Right. Now your A square R, what it will do first? This is the first process. Applicant will make an application along with the prescribed fees. Then A square R will forward it to the concerned officer and call for the records and returns them after examining. He will forward it. He will tell that, okay, you take this application and if required, he will call for the records and returns and return it them. He will call for the records and after examining, will return it back to the concerned officer. Now, third part. The details are available with now A square R, authority for advance ruling. What it is going to do? It is either going to accept the application or reject the application, for which there is no time limit. But there is an outer time limit for passing the ruling. There is no specific time limit for accepting or rejecting the application. Now there are two types of acceptance rejection. One, there is a mandatory rejection. There is a mandatory rejection, which means A square R has to tell, no, you cannot come. If at all the question that is being asked is already pending for the same applicant or it is already decided by the same applicant, A square R will tell that no. The issue that you have asked is already pending for you or it is already decided for you by some other authority. I cannot touch it. It should be an untouched issue. It should be an untouched issue. If it is an issue which is already touched, whether it is decided or not, even if it is pending, A square R will tell that no, I cannot take it. Obviously, there will be principle of natural justice, no doubt, but it will reject it. It will reject it. The second is a case where there may be acceptance or there may be rejection. It will ask for more application on more records. Here the assessee and also the concerned officer to whom the application was forwarded. Listen to both the parties, applicant and the concerned officer, then decide whether to reject or not. And if it is going to be rejected, obviously principle of natural justice. But in this scenario, if you see carefully, it may be accepted, may be rejected. At times it may be rejected even though it is not pending at the same applicant level, it is pending for some other company which is in highlight. Advanced ruling authority comes to know that the same matter is already taken up by Reliance Limited and it is already fighting the case in Supreme Court. Advanced ruling authority will tell that though it is not pending in your case, which means there is no question of mandatory restriction, but I am using my discretion, I am going to reject it. Why? Tomorrow if Supreme Court tells something, that will be binding and not mine. So it will try to reject it. If it is pending in the same applicant's case, mandatory rejection. If it is pending in some other assessees, optional rejection. It may be rejected, may not be rejected. Right. When the matter is taken, finally assume that the application is accepted. First step is to decide whether to proceed or not. To accept it or not. If it is rejected, the matter closes there. If it is accepted, now it has to give a decision. If it is accepted, now it has to give its opinion or ruling. That opinion or ruling should be given within 90 days of application. Within 90 days of application. Right. In a normal case, advance ruling pronounced after examining all the records placed by both applicant as well as the concerned officer, and to both of them there will be opportunity of being heard. Principle of natural justice will be that. Final order should be within 90 days, which means within 90 days you have to do two things. First, decide whether to accept the case or not. Second, give ruling. Everything should happen within 90 days. Decide whether it should be admitted or not, whether the application should be accepted or not. Then give the ruling. But at times, what will happen is, you might get an advance ruling, authority A square R ruling, where there is divergent views. If the members of AAR differs on any question, one member is telling that no, this should be the scenario. 5% is the right answer because classification can be taken up. Other member of A square is telling that no, 5% is not right, 12% is right. The moment there is difference of opinion. In appeals, we will see that if at all there is a difference of opinion, you go with majority. But in advanced ruling, if at all there is a difference of opinion, there is no question of any majority, it will be referred to the next level, AQ bar. it will be referred to the next level, AQ bar. In appeals, what will happen? If there is difference of opinion, majority will prevail. Whereas in advanced ruling, there is difference of opinion between the members of A square R. Refer it to AQ bar. Refer it to AQ bar. Now, when we are seeing your AQ bar, finally the order will be given. A copy of order will be given to your applicant, to proper officer, also to consent officer. Final order will be given. Now, what is the next level? AQ bar. Now, let us try to appreciate the difference between A square R and AQ bar. A square R entry point is only 1. AQ bar, there are 3 entry points. First, applicant has lost the case in A square R. Now it is coming in AQ bar within 30 days plus 30 days extension. After the ruling of A square R, within 30 days plus 30 days extension, it has to make an application. This time the fees is doubled. CGST 10,000, SGST 10,000. Second, department has lost in A square R. Now department, that is the concerned officer, is going to AQ bar. Again, same time limit, within 30 days plus 30 days extension. But this time no fees. Department is not going to pay any fees, even in appeals. No fees. Third, A square R were having difference of opinion. So there was an order of A square R where there was difference of opinion. Therefore, it was referred to AQ bar. There are 3 entry points. Applicant, consent officer, reference. 2 are appeals and 1 is reference. And for appeals, whether by applicant or consent officer, the time limit is 30 days plus 30 days extension. For reference, automatically it will be referred back. There is no question of any time limit. There is fees, but only when applicant is making an appeals, and this time the fees is CGST 10,000 plus SGST 10,000. Now, what will happen in the normal scenario, normal case? In a normal case, AQ bar will either confirm or modify the order passed by A square R or pass the order referred to by A square R. If it is appeals, confirm or modify the order. If it is reference, finally given order. Finally given order. And that order has to be given within 90 days of appeals or referral. Copy of the order will be given to everyone. To the consent officer, to the applicant, even to your jurisdictional officer. That copy of order is the same point. Again, here also the time limit is 90 days. But 90 days starts from where? From the date of appeals or from the date of reference. Don't you think that the same situation can come in AQR where the members are having difference of opinion? Where the members are having difference of opinion? This time, if the members of AQ bar are having difference of opinion, it means advance ruling cannot be given, get lost. We are not in a position to give advance ruling, there is no other remedy. Can you challenge the order of A square R and AQ bar in your appeals? No. You cannot challenge it. It is binding on you. You cannot challenge it. So if the members of A square R differs in opinion, it will be referred to AQ bar. But if the members of AQ bar are having difference of opinion, full stop. Advance ruling for this matter cannot be given. Cannot be given. It means assessee has to fight his own battle. He has to wait for the notice, get an order, challenge it in appeals, take the matter to Supreme Court if required, finally get the finality from the Supreme Court. Now all the other small aspects. We actually done with A, advance ruling, A square as well as AQ bar, all the other small provisions. There is no cross empowerment, which means whatever A square or AQ bar is there in the state will be same that will be deemed to be appointed even for the center, which means there will be one member of the state and one member of the center. And the officer are going to sit and decide in case of advance ruling should be of an authority of joint commissioner or above rank. JC or above rank. When you talk about JC or above rank, it is joint commissioner, additional commissioner, commissioner, principal commissioner. Joint commissioner, additional commissioner, commissioner and principal commissioner. Only these people can sit in advance ruling. Now, if at all there is an order given by A, and all these points, whatever you are discussing, are equally good for A square R as well as A cube R. If at all there is an order given by A square R or A cube R, which is clearly having a mistake apparent on record, which means there is a number which is written. Finally, entire ruling is telling that 5% seems to be more logical. Final judgment has said that it is 12%. It is a mistake apparent on the record. It can be rectified within 6 months from the date of order of A square R or A cube R. This can be raised. This issue can be raised either by A square R, A cube R themselves, or concerned officer, jurisdictional officer, or applicant. The error could have been pointed out by applicant, officer, that is concerned officer or the jurisdictional officer, or A square R, A cube R, suo motu. Suo motu will find out that mistake and try to rectify it, but that has to be happening within 6 months. But the moment that rectification is resulting into increasing the liability or decreasing the ITC, there should be an opportunity of being heard to the assessee. If it is against the assessee, increasing the tax liability or decreasing the ITC, there should be an opportunity given to the assessee before the final decision or before the final rectification is done in the next 6 months. Now, the most important of all the aspects, what is the binding nature of A square R? A square R or A cube R, binding nature. Who are all bound by the ruling of A square R and A cube R? Only that particular applicant and that particular concerned officer, jurisdictional officer, with respect to that applicant, not with respect to other assessees. Not with respect to other assessees. It is a coverage given only for that applicant. If at all you are talking about Mahabharata, that coverage will protect only Karnan. It will not protect anyone. It will not protect anyone else. Indradev was not in a position to give that coverage to even Arjuna. So it is not going to protect anyone. It is going to protect whom? Only that. It is binding only on that applicant, on an officer, but only with respect to that assessee. If the same matter comes in front of the same officer, but with respect to other company, he is not bound by the advance ruling. He is not bound by the advance ruling. Now, advance ruling shall be binding till the facts are the same and the law is the same. Till the facts, circumstances and law is the same, that is binding. Please understand that if you have gone for advance ruling and I find that your advance ruling is in favor for me, I cannot use that as my protection. But yes, while fighting my case in appeals, I can refer, see, in this matter, A square R or A cube R has given judgment which is in favor of assessee, though it is not a judicial precedent like High Court judgment and Supreme Court judgment. But while putting my arguments, I can add this argument as well. It is not at all a judicial precedent. That doesn't mean that it is not having any value. While putting my argument, I can put this argument also, that in one of the cases of so and so assessee, there was a ruling given by A square R or A cube R, as the case may be, which was in favor of assessee. So it is not binding on appellate authority, it is not binding on appellate tribunal, it is not binding on High Court or Supreme Court. But it will add some goodwill to your case. You may take that as your help. Now, the other small points, what if I went for an advance ruling? This actually happens, and this people think at times they do planning. I went for an advance ruling giving false information. Right? Maybe if time permits, anyone wants to know the real practical case, maybe in the break we'll discuss. I went for an advance ruling giving false information, incorrect information, which means advance ruling was obtained by way of fraud, suppression of facts or misrepresentation of facts. It will be held that advance ruling is void ab initio and all the provisions of the act will apply as if there was no advance ruling given. But obviously, there will be a principle of natural justice given to the assessee to prove that it is not a case of fraud, suppression of facts, misrepresentation of facts. That opportunity will be given. All the other things will happen as if that advance ruling was not given. One more important thing will happen. When you see your section 73 and section 74, there is a time limit to give notice and order. Section 73, Time limit for notice is 2 years 9 months. Order 3 years. And section 74, notice 4 years 6 months. And order 5 years. In calculating that 2 years 9 months, 3 years, or 4 years 6 months, 5 years, the time gap which was lost, from the date of that advance ruling till the date of order becoming void, from the date of the advance ruling pronouncement till the date of order becoming void, will be added to your time limit. So you calculate the same time limit, 2 years 9 months, 3 years, 4 years 6 months, 5 years, plus that time. Plus that, go with this simple step, plus that time. What time? The time gap between the advance ruling order and that advance ruling order becoming void. Supposing the time gap is say 586 days. Calculate 2 years 9 months, calculate 3 years, calculate 4 years 6 months, calculate 5 years, plus add that 485 or 486, whatever the number of days, add that. Add those days. That is a very simple way to find out the final time limit. Now all the other miscellaneous provision, advance ruling authority will have all the powers of civil court by way of discovery and inspection, calling an attendance of a person to examine on oath, issuing commissions, asking someone to produce books of accounts, etc. All the powers of CPC will be clearly applicable. Simultaneously, it can have its own procedure. What will be the timing? What will be the uniform? How many people can come? How they have to address, etc. They can have their own procedure as well. So that is everything about your advance ruling.